Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Yes, indeed, fellas, you read the title correctly. Bitcoin is going to explode. I wanted to make a very fun video for this Friday evening for those of you who are feeling down in the dumps about the Bitcoin price performance lately. We are smack dab in the middle of a bear market. Everybody is depressed, but don't worry, Daddy Wizard is here to give you some excellent news. I want to show you one of the strangest Bitcoin setups I have ever tested because the headline here today comes from an actual statistical experiment rather than some vibes-based seance conducted over a candlestick chart at 3 o'clock in the morning. There will be no astrology for men here today, folks. I'm here to tell you why today is bullish for Bitcoin. Bitcoin is sitting around $63,418 as of filming this today. Now, obviously, we are going down to the $62,000 a little bit today. Regardless, when we look at the 4-year moving average, it is slightly over $62,000. $62,064 right up here. That is a 2% premium to the 4-year moving average of Bitcoin and the 60-day volatility, 28.6%. So we have this very bizarre combination. The price is hugging a brutally slow long-term trend floor up to the right over time, while the asset does still have enough volatility to launch itself through drywall. Now, in relation, relatively speaking, to Bitcoin's price history, this is pretty low volatility, but people often forget what it's like to have a quickly compounding asset like Bitcoin paired with even this level of volatility. People don't even do the math statistically about what that can mean for variance in price moves. So the question I'm going to answer today is very simple. When Bitcoin has historically occupied a state that resembles this one today, what does the forward return distribution actually look like over the next 6, 12, 18, and 24 months? Because rather than assume some fixed 40% or 50% compound annual growth rate and then build a retirement calculator for psychopaths, I built a state-conditioned historical Monte Carlo. This model uses real Bitcoin behavior, real crashes, real rebounds, real volatility clustering, and a moving state that changes inside every single simulated path. And then I tried to murder the result with stress tests, and the results lived. So you guys are going to love the results because what I tried to do was model what Bitcoin tended to do after market states, resembled today throughout history, and then we let those paths evolve using blocks of Bitcoin returns. Every probability, therefore, belongs to that framework with uncertainty carried rather than buried under decimal point theater. If you are bullish on Bitcoin, you are going to love this video. If you're bearish on Bitcoin, you're going to love this video too. Do me a favor, like the video, subscribe to the channel. If you have not, you can support the Bitcoin Wizard by doing so. And look, if you're listening to the Bitcoin Wizard, I'm going to go out on a limb and assume that you are bullish on Bitcoin over the next 5 years. What if I told you you could book a Bitcoin investment for 5 years with full principal protection? That's right. That's what my friends at Solana.io are building. Every single dollar of your investment being secured by a title insured recorded lien on U.S. real estate. You split the upside with the property owner whose home equity is back in your own investment. If you've been waiting for a way to buy Bitcoin or MSTR that allows you to sleep at night, this is it. And honestly, what better time to lock in a 5-year position after the information that I'm going to be telling you today? Go to Solana.io/capital to get started. Scan the QR code. This is fantastic. You will love what my friends at Solana have waiting for you. And you guys know how excited I get about Bitcoin treasury companies and the insane level of institutional adoption that we are seeing. But do not lose sight of the fact that the #1 revolution, the most important strategic reserve, is your own 100% self-custody of your Bitcoin. Run a node, become a sovereign Bitcoiner with the Bitcoin way today. After this latest cold card hack fiasco, essentially, you gotta partner with somebody who knows what they're doing. And my friends at the Bitcoin way had 0 client funds lost after this latest hack. Schedule a 100% free introductory call today using this QR code or go to thebitcoinway.com/Adam to get started. Do not delay, your freedom depends on it. So starting with the setup itself, Bitcoin trading at that 2% premium to the 4-year moving average, almost directly on top of a trend line that moves with the urgency of a federal permitting office. Now, all of these numbers matter together. I just went over them on the last slide, but obviously you have to view everything in context here. A 4-year moving average compresses an absurd amount of history into one slow signal. Obviously, if you take a 4-year snapshot of Bitcoin That snapshot absorbs bull markets, bear markets, exchange failures, rate hikes, ETF launches, leverage explosions, minor capitulations, panic, euphoria, and of course several thousand television signals announcing Bitcoin's death. So we're about 50% below the all-time high, sitting on that 4-year moving average trend line. Yet, Bitcoin's 90-day momentum is now down 19.8%, and 4-year average growth is still running around 21.2% year over year. So that is going to create the core hypothesis. Maybe the 4-year moving average of Bitcoin is acting less like a magical support line and more like a state variable identifying periods where long-term monetization has caught up with the price. If that state historically carried better forward return asymmetry than some random Bitcoin day, we should be able to measure it. So I built the test around state similarity rather than male astrology. What I mean is chart squiggling nonsense. This is a test around state similarity versus where we're at today. And here is the machinery, because this is where the experiment becomes very interesting. First, I calculated the market state. The broader diagnostics of this scenario, we are factoring in all of these different variables about where Bitcoin is right now. And then we are going to search historical regimes that looked most like today, finding analog episodes, and then I sampled real return blocks using actual 14-day Bitcoin return blocks so the fat tails and volatility clustering survive. And then I recomputed every single path, then stress test the conclusion. So this is some very exciting stuff here. Don't want to bore you with the exact details, but after each 14-day Bitcoin return block, the simulation recalculates the price, the 4-year moving average, the volatility of Bitcoin, the price momentum of Bitcoin, the drawdown, and the rest of the state, and then it searches the history again from that new simulated condition, and I ran 20,000 simulated paths for 731 days forward. So these are the findings of this model. This is what got spit out in my CSV file. Now it is giga bullish. The raw state condition model produced a 6-month median price at around $76,000 Bitcoin, a 12-month median price around 101,000 Bitcoin right here, the 18-month median price at around 142,000, and the 24-month median price at around $179,000 per Bitcoin. So at 2 years, 24 months, the median total return was about 182.6%, which translates to a median annualized compound annual growth rate of 68.1%. The middle of this distribution to me is already absurd, and the tails obviously are more entertaining. The 10th percentile range starts at 79,000, and the 90th percentile range is $402,000 per Bitcoin. The raw probabilities came out at 96.7% for finishing above today's price, 83.2% for exceeding a 20% compound annual growth rate, a 67.8% chance of at least a doubling of Bitcoin's price, and a 45.3% at a tripling of Bitcoin's price. Now, those numbers are insane, but they also require discipline, because a Monte Carlo gives you a distribution implied by this historical sampling process. So I treated the raw output as my first layer of evidence. It is giving me some powerful directionality, this enormous modeled convexity of Bitcoin, and a giant flashing sign that was telling me to keep digging. Now, this probability matrix shows the evolution from raw excitement to something I would actually defend in public while being sober. At 6 months, this model gives a 74% positive return probability right here. Now, around 12 months, that rises to 87.6%, 18 months, 93.5%, 24 months, 96.7%. The raw probability of beating that 20% CAGR rises from 62.1% to 83.2% over those 2 years here. And then I applied 2 different reality checks. The first is a brutal annual return drag, which I will hit on in the next slides here, but next comes the rolling origin calibration. I reran the model from 12 semi-annual historical starting dates between 2019 in 2024. And every single historical forecast could only use information available at that starting date. This is the important part. Every single forecast lived inside of its own historical information set. The time machine stayed in storage, kids. So using the coarse empirical calculation, today's 24-month positive return estimate falls in the roughly 73% to 77.4% range. So this slide answers the question that actually matters. Does being near that 4-year moving average of Bitcoin actually improve the distribution, or is Bitcoin simply bullish in every Monte Carlo because Bitcoin has historically gone up? I ran an unconditional recent history comparison using the same general machinery while removing the state conditioning exchange. Over 24 months, the unconditional model produced an 80.5% probability right here of a positive return. The state conditioned version actually produced a 96.7%. So for a CAGR above 20%, we're talking 83.2% conditioned versus 66.3% unconditioned. And this is the important part for all of you who are bearish on Bitcoin over the next 2 years. The downside comparison is where my eyebrows left the building. An arbitrary recent history start produced an 11.6% probability of finishing at least 25% below the starting price after 2 years. Under today's state condition setup, that model probability collapsed to 0.2%. That is the real signal, kids. 0.2%. This is dramatically compressing the terminal downside tail while preserving Bitcoin's right tail insanity. So think about what this actually means, okay? This model that was trained on history, okay, looking at states that look like today, the model still expects chaos along the journey. Bitcoin is still volatile. The price continues to get punched, obviously. But clearly, there is terminal asymmetry when we are seeing a condition 96.7% likelihood of a positive return versus a 0.2% likelihood of being down at least 25% from here. Now, obviously, that's really bullish, so I wanted to abuse the bullish thesis. First, I imposed a deterministic 30% annual drag on every single sampled path here. That is a savage haircut, kids. Imagine taking this historical return engine that I have created, this thing right here, and then strapping a cinder block to it and then throwing it into a lake. The 24-month median still came out around $115,000. Yes, after a 30% annual return drag here. And then I removed every single 2023 observation. Why did I do that? Because that was essentially the starting points after that terrible 2022 bear market. Today's exact state has very few historical matches. That strongest cluster lives in 2023. So with 2023 removed, the 24-month median case is still $185,000 Bitcoin. I also changed the return block length, 7-day, 14-day, 21-day blocks. They produced 24-month median CAGRs from 64% to 68%. The model is sensitive, but obviously the signal remains stubbornly alive here, like a cockroach funded by venture capital. Obviously, we got to talk about the price of the upside. People say that volatility is the price that you pay for performance, and that's actually literally true in the math. Because using Bitcoin's volatility today, even though it's very historically compressed, well, roughly 26.2% of those 20,000 simulations produce a 50% plus or more drawdown. About 9.2% of them experienced a 60% drawdown. So this yellow line right here, probability of a 30% drawdown, actually goes up to a 93.3% over 24 months, okay? So if you're waiting 2 years, chances are 93% you are going to see a 30+% drawdown. The median maximum drawdown, though, actually over 2 years is 42.7%. And because we're actually over a 50% from the all-time high, this tells me that the bottom is close to being in if we're not already. And then the probability of a 50% drawdown is in red here. That's only 2.3% over 6 months. but 26% over 24 months. So I really don't think that we are actually going much lower than we are today, just given how volatile Bitcoin is right now. This is telling us that you could buy Bitcoin near the 4-year moving average, watch the thesis work over 2 years, and still endure a drawdown large enough to make your relatives send you Dave Ramsey clips. This is why volatility and expected return have to be discussed together. This model is saying that the asymmetry looks very exceptional, but the median max drawdown still 42.7% over a 24-month period. So we are looking at the asset that's sitting at a 2% premium to the 4-year moving average. The volatility has compressed quite a bit, but remember, the average itself is growing between 20 to 30% every single year, year over year, even since 2020. The stress tests say that the conclusion survives severe punishment. The calibration says that my probability claims are civilized. So my takeaway is very simple, kids. It's literally just math. It's statistics. This looks like one of the most statistically asymmetric Bitcoin setups that we have ever seen. The upside distribution looks like a clerical error, kids. And of course, the path there looks like a hostage situation. Welcome to Bitcoin. That is to be expected. My name is Adam Livingston. I am the Bitcoin Wizard. I am buying Bitcoin because the likelihood of positive forward returns from this point in history seems like a no-brainer to me. Have a terrific day, everybody. Do not party too hard. Class dismissed. This video is sponsored by Solana, and if you are interested in gaining Bitcoin upside while keeping your principal protected, Solana may have built the most aggressively bullish product available for people who still enjoy sleeping at night. Yes, you as an investor can receive 50% or more of Bitcoin's appreciation with uncapped upside, while the structure is backed by the Bitcoin position itself and a lien on U.S. investment real estate. Basically, Solana is putting Bitcoin in body armor. You still get the moon math, while your principal has a rental property standing behind it with a baseball bat. If you are interested, scan the QR code or use the link below. Solana will help you every single step of the way. They will answer your questions and explain exactly how the structure works. Requesting information carries zero obligation or commitment. Go to solana.io/capital to buy Bitcoin and MSTR with full principal protection. And you know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it.
welcome. I'm Natalie Brunell, author of Bitcoin is for Everyone and host of the Coin Stories podcast. And I'm very happy to be back moderating Strategy's second live investor Q&A. We're live today on X and YouTube, and over the next hour or so, we will get to as many of your questions as we can. They were submitted directly by retail and institutional investors through the company's official question form and on X. We received dozens and dozens of submissions covering a range of topics, and my job today is simply to put those questions to the company's leaders and keep us moving so we can cover as much ground as possible. If you're watching live, you can continue submitting questions in the replies, and my colleague Alex Devani will be looking out for new topics and angles that haven't already been covered by the submissions we received over the last week. And if you can't stay for the entire hour, don't worry, the full replay will be available on Strategy's platform along with mine. Now, before I introduce our guests, a brief disclosure. Some statements made during today's presentation regarding future expectations, plans, and prospects may constitute forward-looking statements. Actual results may differ materially due to important factors, including fluctuations in the price of Bitcoin, and the risks described in Strategy's SEC filings, including its quarterly report on Form 10-Q filed on August 3rd, 2026. This presentation is for informational purposes only. It is not an offer to sell or a solicitation of an offer to buy any securities, and it is not investment, financial, legal, or tax advice. Any offering of securities will be made only by means of a prospectus, and additional information about Strategy is available at strategy.com. So with that, let me introduce Michael Saylor, the founder and executive chairman of Strategy, and Phong Le, Strategy's chief executive officer. Michael and Phong, great to have you back.
Happy to be here.
Thanks for having us, Natalie.
All right, well, we have a lot of questions to get through, so let's jump right in. The first one came from several investors, and it's directed to you, Michael. You recently posted a chart on your X page where you outlined a digital asset monetary spectrum that included digital capital, digital credit, digital money, and digital currency. What is SR-STRC-USX, which you describe in that visual as digital money? And do you disagree that Bitcoin is money?
I think if you're using the theoretical term for money, then you would say money is a non-sovereign store of value bearer instrument like gold. But that's a classical Austrian economist view of money. The current conventional view of money is that money is a US dollar equivalent or a fiat currency equivalent asset like the US dollar that holds its peg against a fiat currency. So I think that 99% of the world thinks that money is a fiat currency, and a money market is a fiat currency that generates yield. I think that there's 1% of the world that are Austrian economists that think that money is gold. Some of them think money is silver and money is Bitcoin. But I think that's an academic debate, and there's not much point in getting mired in an academic debate because about 0.1% of the capital in the world, or 0.1% of the economic value in the world, is actually invested in the Bitcoin network right now. 99.9% of all the capital, all the money, all the stuff of value is invested in stuff other than the Bitcoin ecosystem right now. A lot of that's equity capital, a lot of it's real estate capital, some of it's metallic capital like gold, some of it is credit, hundreds of trillions of dollars of credit. So I think that if you want the Bitcoin network to grow by a factor of 10 or 100, then you're going to have to attract capital from the traditional finance establishment, and that means attracting equity capital flows or credit capital flows or money market flows. So for the people that have not yet bought Bitcoin, the ones that we're actually working to serve, their view is that money is a medium exchange, a unit account, a store of value, and they would think that that's the Japanese yen in Japan or a yen money market in Japan. They would think it's a US dollar money market in the US. They think it's a euro money market or a euro in the European Union. And and so the TradFi or the Keynesian view of money is a fiat currency or a fiat currency equivalent that pays yield. Um, so the chart that I'm illustrating is the digital assets taxonomy. We think that Bitcoin is capital, and so digital capital is Bitcoin, and Bitcoin competes against gold, real estate, equity capital, credit capital, or money markets held as capital or art. Those are all the things that Bitcoin competes against. 99% or 99.9% of the economic value of the capital in the world is not Bitcoin. So if you want to get it, you need to compete against those things. You need to tell people why Bitcoin is better than gold or art or real estate or equity like the S&P index, or bar gold. STRC is digital credit. We've extracted a credit instrument from capital. It's semi-volatile. It's not as volatile as Bitcoin, but it's more volatile than a fiat currency. And the next step is to take STRC and create something that looks like a digital money. And a digital money would be the mythical Bitcoin-backed stablecoin. It's a fiat currency stable asset, whether it's a stable dollar or stable yen or stable euro, but pays yield. So the difference between digital currency and digital money is digital currency is deemed to be stable coins. It's like Tether or Circle or any other digital stable coin in whatever currency system is out there. Digital currencies don't pay yield. So digital currencies are the winners of medium exchange in the crypto ecosystem and the digital assets ecosystem. I think that that's there are some fundamentalist Bitcoin OGs that wish that wasn't the case, or they've been hoping it wouldn't be the case. But I think that at this point in the year 2026, we can see that substantially all the prices in the world, if I were to say 99.999999% of the prices in the world are in fiat currency, I might be understating the case. It's just, to somewhere between 6 and 100 significant digits after the decimal place. All the prices are in fiat currencies, which means that the medium exchange is generally the US dollar. If you're holding stable coins, they don't pay a yield, though. It makes a good medium exchange. It makes a very poor store of value or a weak store of value. The idea behind digital money is to take the best of digital credit and the best of digital currency and merge the two together and create something which is generally stable to a fiat currency but pays a yield. And so if you can actually create a yield on a stable currency instrument, then you've got something which serves as much better store of value. So that particular asset that I put in my chart, that's the first example. Well, one of the first examples, maybe the first example of someone creating a digital money asset. And they're creating a digital money asset by engineering a stable asset that actually has yield. The yield comes from digital credit, and the asset is stabilized through some financial engineering to be stable to a US dollar. I expect there'll be dozens, if not hundreds, of different types of monetary assets that people build. So it's not the only one. I think there's about a dozen different organizations that are building digital monetary assets in the digital assets ecosystem. And I don't think digital money be limited to tokens. I actually think that you'll see digital money funds created as ETFs in the United States and probably as ETPs and other types of publicly traded funds that trade on exchanges all around the world. And I also think that we'll see private funds just like there are money market funds that are private that don't trade publicly. There are money market funds that are public that trade as ETFs, and there are monetary instruments like currencies that are stable coins. So the thing that we think is really important is that if Bitcoin is going to grow by a factor of 10 or a factor of 100, we need to facilitate capital flows from the credit markets and the money markets. And right now, what's going on, if you took away STRC and you took away the digital money tokens that are now starting to develop, then what you have is fiat currency flowing into the stablecoin market, and it's all backed by currencies, by fiat currency like US dollars. And then you have capital flowing into the capital market that actually supports BTC, but there would be no capital flows from the credit markets or the money markets into this ecosystem. If we create good credit, then we will be able to create monetary instruments on top of it. And the companies that create digital credit, like Strategy and Strive, will have equities, and the equities will attract capital flows, which will also flow into Bitcoin. And companies that create digital monetary instruments, the instruments that'll be on top of digital credit, they'll have equity as well, and they will attract capital flows into the ecosystem. So we think that the economy will grow if we actually create credit instruments, money instruments, currency instruments, and equity instruments, all of them that are tied in or backed, but either backed by BTC or tied into the Bitcoin ecosystem. So that was an example of the first of what I think will be many digital money instruments. It's not the only one, and certainly I'm not endorsing that particular one as an investment. It's a security type investment, but I think that it's a seminal event in the same way that when people first created money market funds, that was a pretty important event, and when people created ETFs backed by money market funds, I think that's an important event.
All right, let's turn now to the equity side, to the common stock MSTR. We have a question from Rob. He said, I have 3 children and I invested 73,000 each into MSTR, believing in the long-term potential. Today, that 73,000 is worth 20,000, and the long-term potential is now a function of getting back to break even. MSTR common shareholders seem to be your lowest priority. You defend STRC and pay down converts using MSTR at the market offerings. Achieving BTC per share yield doesn't do much for my kids. I have a decade-long perspective, but I'm worried that you will ATM so much that we'll never get back to $3.25 a share. Have you considered paying out a dividend to MSTR common shareholders simply to do something right by them in the near term?
I can start on that, and Mike can add. And Rob, thanks for being a shareholder and investing some money into MSTR for your children. Of course, the common shareholders and MSTR is our most important priority, and creating value and increasing the price of MSTR is our #1 priority. How do we do that? We do that by outperforming Bitcoin. And since the beginning of our strategy of putting Bitcoin on our balance sheet, that was August of 2020, Bitcoin's been up 32%, MSTR has been up 41%. So we've outperformed Bitcoin over time, and I understand that you came in later and haven't seen that outperformance. What happens over time, right? When Bitcoin's up, we tend to go up more because we have more Bitcoin per share, and we do that via historically leverage, and we've done that more recently via amplification. What that does mean, and what you've experienced, is when Bitcoin goes down, we tend to go down more. So Bitcoin's seen a drawdown of 50% from all-time highs. MSTR has seen a drawdown roughly of 75% of all-time highs. Because Bitcoin's our underlying asset, increasing Bitcoin per share increases the value of MSTR when Bitcoin goes up, and we'll see sharper drawdowns. So how do we increase Bitcoin per share? We increase Bitcoin per share historically through leverage, through convertible bonds, and more recently through what Mike talked about, which is digital credit and amplification through stretch. And so ultimately, if we want the common to go up, we have to increase Bitcoin per share. And increase Bitcoin per share means making stretch work, which is why it may seem like we're talking primarily about stretch right now, getting stretch back to par, but that's what gets Bitcoin per share to go up and MSTR, the common, to go up over time. We're not going to pay a dividend. That's not really the best deployment of capital. The best deployment of capital for us is to get stretch to work, to buy Bitcoin and put it on our balance sheet. And that's ultimately the objective of the company. And so over time, if you believe in the underlying asset Bitcoin, and Bitcoin starts to rise for all the characteristics Mike had mentioned before, then MSTR will start to rise over time. And that's ultimately the goal of the company.
Michael, do you want to weigh in at all on that?
Yeah, what I'd say is if you want a dividend, you should buy one of the preferred stocks, like STRD pays like almost like a 15% effective yield. So if you're looking for a stable instrument that pays a dividend, then I would look to STRC or STRK. They were designed to pay dividends and give some upside. If you know, if your time horizon is less than 4 months, you probably should own a money market. If you are making an investment and want the money back, or want to see a good return on your investment in 4 months to 4 years, you're probably a credit investor, and you ought to consider one of the credit instruments. If you're holding the equity, then you need a time horizon minimal of 4 years, right? Ideal 7 to 10 years. Bitcoin was an all-time high about a year ago. So when we're in a bear market, you're going to get more amplified Bitcoin. So if Bitcoin's down 50%, we're going to be down 75%. And in a bull market, we expect to outperform Bitcoin. So, when you're buying MSTR, you're getting amplified Bitcoin. When you're buying Bitcoin, you're getting on a roller coaster. So if you are going to get on a roller coaster, then probably you want to use a metric that's like a 4-year blended metric. So when we look at Bitcoin, we look at the 200-week simple moving average. And that way we take a 4-year cycle view and we consider how is it trading versus the 4-year average. I think that MSTR is going to be more volatile than that. So I think the whole point of the equity is to generate the amplification. And so if we were to pay the dividend, we would be actually undermining the equity value proposition, and we'd be undermining the credit value proposition. And the reason that the equity is so volatile is because we sell the credit. And the reason that we're working hard to build a balance sheet is because the company's future is based upon the credit. If we can sell $10 billion a year worth of STRC, and if BTC outperforms our hurdle rate, it's about 10%, 10.5% right now, then the $10 billion of credit that we sold starts to look like net income to the common stock equity holders. So that being the case, you'll get a multiple on the credit sales. If there are no credit sales, then there isn't anything to multiply. And so the single most important thing is for us to stabilize the credit business and to build the most sustainable, highest quality credit business that we can. And so the equity will actually come later, right? We're in investment mode to build the credit. If we do the things that are good for the equity in the near term, they're bad for the equity over the long term. And on the other hand, if we do the things that are good for the credit in the near term, that will be good for the equity. So ultimately, the product of the company is the credit. And the better the credit is, the more valuable the company is. And we think the company will be very, very valuable if we make the credit, especially STRC, successful. So we're making a long-term investment. It's not unlike Netflix or Amazon. When Amazon was building out Amazon Prime, they were providing cheap shipping and or free shipping for a long period of time, and people thought it was not great for the equity. But at the point where everybody in the country is subscribed to the product and they all use the product, then Amazon won the market. And our view is the same. We want to win the digital credit market, and ultimately we want to create the world's best credit. And if we do that, then the primary beneficiaries will be the equity holders, of which I'm a big one. I have more than 19 million shares of the equity. So I feel your pain, but I think we have to be prepared to have difficult years. It might be 1 year, it might be 2 years. We wouldn't think it would be 4 years, but we might have to actually ride through some number of months or a year or two in order to get to the point where things start to work to the benefit of the equity.
Multiple investors pointed out that you recently sold Bitcoin and you recently purchased back STRC. Are there any plans to buy back MSTR?
I think we're open to buying back MSTR if it trades at a discount to NAV, or if it's the right thing for the company to do. We evaluate all these programs week by week, day by day. Right now, STRC is trading at a discount to par, so it's a pretty obvious thing for us to do. And MSTR is not trading at a discount to NAV. So we're prepared to do it at some point if we needed to. If MSTR is trading at a very, very deep discount to NAV, then probably you would see us do something like that. But right now, it's not the highest priority of the company. The best thing we could do right now is fix the credit. If we fix the credit, the equity premium should expand, and that will be good for the equity. If we take the capital that we could use to fix the credit and start buying back the equity, that would be equity, that would be credit negative. And if it's credit negative and the credit business weakens, then even if you were trying to buy the equity in the open market, it would be weakening, because the fundamental question is the credit business worth 100 billion or $1 trillion? If there is no credit business, the answer is no, it's worth zero. But if there is a credit business, then there's just a debate over whether or not it's worth 50 billion or 100 billion or 250 billion or $1 trillion. And so the single most important thing for us to do is make the credit work. And right now we're allocating our capital to doing that.
Okay, so fix the credit, fix the equity. Fong, this question is from Johannes Schmidt. CEO Fong Lee has cited JP Morgan as a model for how strategy should evolve for digital credit. Yet Bitcoin's entire philosophy was designed as a direct alternative to the centralized, trust-based banking system that JP Morgan represents. Doesn't modeling strategies business, including STRC, after a centralized institution like JP Morgan contradict the decentralized principles that Bitcoin was built on? And how do you reconcile pursuing a JP Morgan style corporate structure while staying true to Bitcoin's founding philosophy?
Yeah, let me address that. But I do want to follow up on the previous question, because I think there is this misconceived notion that issuing our equity is dilutive to our shareholders. If we sell digital credit, STRC, and we issue equity to pay the dividend, it's highly accretive to our shareholders. If we issue equity that's greater than 1x NAV, MNAV, and we're currently about 1.07 to buy Bitcoin, that's actually accretive to our shareholders because it increases Bitcoin per share. If we issue equity to buy back STRC at a discount at which we issued it, so if we issue STRC at $100, we issue equity above 1x MNAV, and we buy STRC back at $95, that's also accretive to our shareholders. And so it's accretive to Bitcoin per share. That's what matters. So I just want to make sure that that's understood, because a lot of times people are like, sailors hitting the ATM, that's dilutive to shareholders, and that's not necessarily correct on a Bitcoin per share basis.
And the last trade is if we sell the equity at a premium to NAV to buy US dollars, that's also accretive to the shareholders.
Yeah.
So all the trades we're doing are accretive. They're strengthening the balance sheet of the company. They're strengthening the company. They're improving our long-term prospects.
Yeah. We don't want to be JP Morgan. We want to be the JP Morgan of digital assets, right? And which is a big difference, right? Like there are a lot of things to admire about JP Morgan. They're the most valuable bank in the world. We would like to be the most valuable digital asset company in the world, right? They have a great amount of trust, a great amount of equity value. We would love to have the amount of trust and equity value in the digital asset world that JP Morgan has in the traditional banking world. They, are one of the largest players in the repo market, right? They're a bank that the federal government turns to at times for assistance if it's needed. We want to have that level of trust and scale in the digital asset world. But we're not modeling our business after JP Morgan. The analogy is we want to be the largest and most important player in the digital asset world. That starts with holding the most Bitcoin in the world, which we have now at 4%. That continues with building products on top of Bitcoin, like digital equity, which is MSTR, digital credit, which is STRC. And it continues with then having other players in the digital asset world build products on top of ours, like digital money, which Mike mentioned earlier. So we believe that being the largest holder of Bitcoin allows us to have the stature that JP Morgan has, but we're not modeling our business after that. So that was really the point there. It's much like when Mike says that STRC is the iPhone, our iPhone moment. Obviously, we're not trying to build a business modeled after the iPhone or Apple, but the iPhone is the most successful product in the history of the world. And we think STRC can be the most successful digital credit product in the world.
This next question comes from @grainofsalt. Would strategy sell STRC and use the proceeds for a cash reserve and MSTR buybacks in addition to buying Bitcoin? This was suggested in the Q1 earnings presentation, and is it still a viable option?
Sure. Yeah, we could use the capital we could swap STRC for MSTR, we can swap STRC for USD, we can swap STRC for BTC. We could swap STRC for any other debt instrument or credit instrument outstanding. So there are probably other things we could do with it as well, but we're very open-minded about how we use the capital.
Next question is from Garrett. What is your stance on MSCI's recent rule change proposal to remove Bitcoin Treasury companies from their index? And what do you expect this removal would do to the stock prices?
I can start with the latter, right? MSCI indices represent somewhere between 3 and 4% of our current shares. If we were to be excluded from their indices, then you could expect that to create some selling pressure over a period of time. But it's really immaterial to us, right? Like 3 to 4% isn't something that is going to cause a major change in our share price over a period of time. So I would call it immaterial, and to Bitcoin, it's even less important, right? 0.1% perhaps, if you include what we hold in terms of Bitcoin. More importantly, I don't think MSCI is aligned with the US government, the world markets, or other indices. I think the fact that they're taking a second cut at this is a bit ill-advised. They've taken a different approach to it, which is to redefine what an operating asset is. The SEC and FASB have defined what an operating asset is for strategy, and Bitcoin certainly is that. They don't see Bitcoin as an operating asset, so I think they're sort of taking a position against general accepted accounting principles in the SEC. And so we'll go back and we'll respond to them and try to understand better why they're taking this approach that's antagonistic to Bitcoin, the asset class. And I think they will consider our responses and others and be constructive about this and hopefully not move forward with their latest proposal. But even if they do, right, I don't think it's that important to us in the end.
All right, this question comes from Sergio. Could Strategy eventually build a $20 to $30 billion USD reserve, mainly through STRC, to deploy aggressively during future bear markets? And could a larger cash buffer also strengthen the case for S&P 500 inclusion?
I think we'll always carry large cash balances going forward, and over time we expect the US dollar reserve balances to grow. We expect BTC reserves to grow. We expect the operating cash or US cash balance that's unrestricted to grow, and we will use that opportunistically to buy back our credit, buy back our stock, or buy back our debt, or buy Bitcoin whenever we think it makes sense. So the company's optionality is growing, and at this point, we would expect we'll just keep getting larger from here, and we will have more trading options than we've had in the past.
And on the question around S&P inclusion, I mean, there's two different things here. One is S&P, the ratings. The second is S&P, the index. On the ratings, right, we currently have a B- corporate rating. I think increasing the cash reserve will help with that, right? And could over time improve our rating. Ultimately, what will improve the rating is whether they deem Bitcoin as capital that we have in our balance sheet. Right now, they see it as not true capital. It's rated, it's of zero value. If that changes, then our rating will go up, and that's probably the most important thing, more important than having US dollars. Index inclusion, I don't think is directly correlated to the US dollars on our balance sheet.
Jerry asks, is the focus permanently on Bitcoin per share accretion via financing, or could opportunistic spot purchases play a larger role in supporting liquidity and price discovery going forward?
Our primary focus is to create digital credit that strips a large portion of the volatility off of Bitcoin and extracts a yield. And so that's STRC. We're not really traders. We think that that market, which is the digital credit market right now, is about $15 billion. We think it can become $100 billion, then $200 billion, then $400 billion, then $1 trillion. So the business of the company is to create the credit. The trade that we're making is we're willing to bet that Bitcoin will outperform our hurdle rate. Right now, our hurdle rate is 10.5% or something. We update it on our website every 15 seconds. The duration of the company, the duration is like 33 years. And so the business of the company is we're sort of betting sometime over the next 10 to 30 years that we're right? And we're not really traders, from day to day. So we're not. The reason you should buy the equity is not because we trade Bitcoin. If you really think that you found someone that can trade Bitcoin really well, you should invest in their private fund. The reason you should buy the equity is because the company has $60 billion of capital and can create $5 or $10 or $20 billion a year of credit. And if Bitcoin beats the hurdle rate, that means the company makes $20 billion a year. And if you want to own a company that makes $20 billion a year that can grow 30% a year, then we're that company, right? So if you believe in digital credit, then you would look at it and say, okay, well, the company that can do that is very valuable. I think that as a practical matter, we will hold more cash, and if Bitcoin is trading at a extreme premium to the 200-week moving average, we'll probably tend to acquire cash rather than BTC when we sell credit. And if Bitcoin is trading at a low premium or a discount to the 200-week moving average, we'd probably lean toward a bit more BTC than cash. So I think that where Bitcoin is in the cycle may drive our cash to BTC allocations. But ultimately, we're not traders, and I think what people oftentimes they miss is they don't realize that in bull market, our equity premiums expand. So demand for the equity expands, the equity premium expands, demand for the credit expands, the credit risk on the credit falls. And so both the equity and the credit businesses explode and capital flows to the company. So in a bull market, when the Bitcoin price is rising or is high, we will tend to have a lot more capital come in the door, and therefore we'll buy a lot more Bitcoin because that's when the capital comes. And in a bear market, when Bitcoin is crashing, the equity premiums compress and the credit weakens, and there's less demand for the credit and there's less demand for the equity. And so we will tend to buy less Bitcoin in a weak Bitcoin market than in a strong market. But at the end of the day, if we're selling the equity at a premium to the underlying Bitcoin, right? If Bitcoin rallies and we're selling the equity at a massive premium, the fact that we paid double when we sold the equity for triple, isn't a problem. It was still accretive to the company. So the price of Bitcoin when we're swapping equity for Bitcoin doesn't matter. And the price of Bitcoin when we swap credit for Bitcoin only matters over the duration of the credit. So over a decade, if we're wrong, then we'll be wrong in 10 years on the credit. But with the equity, we can never be wrong. Like if Bitcoin rallies and our equity premium expands, we could pay $1 million a coin for Bitcoin, and we'd pay for it with a massive, stock price of 25,000 a share. We'd swap it. Bitcoin might crash from 1 million to 200,000, and people would say you're crazy. You bought it 5x more than it is. But the point is, we swapped equity for the Bitcoin at the top of the market, and so and at the bottom of the market, the question is not, well, did Bitcoin draw down? The question is, over the next 10 years, will Bitcoin outperform our hurdle rate or the cost of the credit? And at the end of the 10 years, we'll know. So we're long-term thinkers. We're not short-term traders. And the amount of acquisition of dollars or Bitcoin, or the amount of capital markets activity we engage in, is really dictated by the capital markets. That's Bitcoin. Bitcoin is capital. The credit markets, that's the demand for STRC, and then the equity markets, the demand for MSTR, and even to a certain degree, the derivatives market. So those capital markets, they're all moving independently, and sometimes they're correlated. And we are participating in all of them every day, and so that's the key thing to keep in mind when you consider what will we do and why do we do what we do.
All right, we are a little over halfway through this Q&A session. I'm going to take a question from our live audience. This one's from Tim Fiaca. What do you think of the business model to acquire cash flowing businesses backed by Bitcoin treasuries like Orange Juice? Do you see yourself adopting some sort of cash flowing business model in the future? And what are your thoughts on the potential benefit of cash flow for MSTR?
We won't do it. It's a perfectly fine business model for other people to do. I mean, for Orange Juice, it's perfectly fine. And there are other businesses that are in the business, and there are investors that are in the business of acquiring cash flowing business. So that's their business model. Our business model is to create digital credit. And if we were to start to divert from that, we would be distracting ourselves or diluting our focus. And so it creates all sorts of operational complications of different types. It would undermine the equity. It would be harder for equity investors to properly handicap and trade the equity, because we would be creating heterogeneous performance in the equity. You would have to have a forecast, or you'd have to have an opinion on every single thing we owned. Right now, if you're an equity investor, you just have to have a model for BTC. It would also undermine the derivatives markets. And so people that trade the call options and the put options, and that's a massive, $30-40 billion interest business, they would be undermined if we started to diversify into cash flowing business. And it would also undermine the credit, because now, instead of having a homogeneous credit model where you can recalculate the credit risk every 15 seconds, you would have to create a heterogeneous credit model where you consider the credit risk that is implied by bolting on another business to our existing business. And so we think it would be dilutive. It's a dilutive distraction for us. That's why we don't do it. We're laser focused on our business model, which we think is the best business model that we could possibly execute on.
All right, let's pivot some questions to specifically digital credit. What lessons has the management team learned from the recent STRC drawdown and recovery that could be applied to increase adoption moving forward?
Fong, you want to take that?
I'll start with the biggest lesson is the importance of having US dollar liquidity on our balance sheet as a backstop to the dividends, right? And that's why we now have $4.8 billion of US dollars. I think that's the biggest lesson, and we'll apply that going forward, right? The question of would we use Stretch for something other than Bitcoin? Yeah, potentially when we raise money from Stretch going forward, we would add to the US dollar reserve or some other form of US dollar liquidity so that we backstop the dividends and we create confidence in institutional investors, especially buying into Stretch.
Yeah, I would say we learned we have to be prepared to buy or sell anything at any time. So the company needs to be able to sell Bitcoin as well as buy Bitcoin for the Bitcoin to be fairly valued. And if we're not willing to sell it, then the credit is not fairly valued, because if we're not willing to sell the Bitcoin to fund the credit dividends, then that's credit negative. So we have to be able to trade BTC. We also realize that if we want to stabilize STRC, we have to be prepared to buy it as well as sell it. So we were very good at selling STRC at 100, and we were very good at buying BTC. But now we have illustrated to the market that we can sell BTC and we can buy STRC. So it's kind of like, you can't just have a right hand, you got to have a left hand and a right hand, or maybe the car has to be able to turn left and turn right. And I think that we also, to Fong's point, we have to show that we can dynamically manage our reserves, and the US dollar reserve, the unrestricted cash, the restricted cash, and the BTC. And all of those things were important. I think the other important thing we learned is we need to have a focus upon the capital structure, and we need to keep improving the capital structure, and we need to keep a laser-like focus upon the quality of the capital structure if we're going to grow the credit business.
Fong, when we were on stage in Las Vegas for the Bitcoin conference, you talked about how 80% of Stretch holders at the time were retail. This question comes from Stuart. He said, recently, I have seen you post about huge allocations from institutional funds to STRC. Why did retail lead the way on the product, and why are institutions now coming around, and what is the split now?
I think anytime you have a new product category, digital credit being one of them, retail tends to be the early adopters. Institutional, especially in something like digital credit, they want to see 1, 2, sometimes even 3 years of track record of the product paying dividends. They want to see track record in the price, so they tend to lag. What's interesting is that 80-20 is now 70-30. By the way, it doesn't mean that retail declined. Retail doubled. Institutions just increased significantly over that time. So we're already seeing institutional adoption start to increase. I think our digital credit capital framework created more confidence in institutions. And as good as it is to have retail, institutions tend to be longer term holders. They tend to take on less leverage, and so they'll stabilize Stretch over time.
We've had a couple of investors curious about whether STRC could move to daily dividends like SATA, and whether other preferreds will move to monthly dividends or daily dividends.
Right now, we don't have a plan to change the other preferreds. The STRD, E, F, and K are all institutional offerings, and the institutions that are holding them have been comfortable with a quarterly payout. And so we expect that'll remain that way for the foreseeable future. we're watching SETA, cheerfully and enthusiastically, but we don't have any plans to go to daily dividends at this point. Our primary focus is on improving the credit quality of STRC and focusing upon the balance sheet of the company. Fong, you have any thoughts on this?
No, that's it. I think daily dividends is an interesting concept, and we're watching SETA, but semi-monthly seems to be quite powerful with our investor base.
We've got several STRK investors. One of them from the live chat wants to know if you would consider buying back STRK.
Right now, our focus is on returning STRC to health. So you can expect we'll be laser-like on that. After STRC returns to health, then we want that credit instrument to be stable and to grow in a predictable fashion, and so that's our focus right now. After that, then we'll look at all the other instruments and consider if there's an appropriate thing to do for the investors in the company. We think, by the way, the best thing we can do for an STRK investor or or any other investor is to return STRC to health, right? Because the things that we're doing that are good for STRC are also good for STRK.
A question came in from John Lee Dumas. Under what circumstances would strategy be comfortable letting STRC trade materially above $101 rather than taking actions to bring it back to par? And what would be the strategic rationale for allowing that premium to persist?
We won't do that. It's our target range is 99 to 100, but we have no interest in allowing it to trade substantially above 100. And the reason why is this. The important investor proposition is when it gets to 100, you can sell it at 100 and you won't be leaving money on the table. And then you can buy it at 100, right? And then you can buy pretty much whatever amount you need at $100 and a penny, and you can sell into the market at 100. And if we allow the price to fluctuate, plus or minus X dollars, then you paralyze the market. So someone that was thinking about selling at 100 would think, well, maybe I shouldn't because it might go to 102 or 101. And so instead of making a decision in 15 seconds to sell it, they would be paralyzed. If you actually look at the impact, if it trades between 95 and 105, people might very well take 3 months to make a decision that they would make in 3 seconds if it trades stably. And on the other hand, we've seen examples where if people aren't sure if it was trading at $100.50 and they thought it might come back to 100, they might put in a limit order and wait for 4 days. And so if your bank told you that when you actually take money out of the bank, they might just arbitrarily only give you 99% of your money and keep 1%, you'd be very angry. And if they said, well, on certain days, you might actually be able to get it all. And on random days, you might get 1% more than the money in the bank. And so that would drive everybody insane if you randomly got plus or minus 1% of what you thought you should get. And so the primary value added of the company, right? The reason that we're here is to strip the volatility off the instrument and extract the yield. So if I use an example of like Standard Oil, okay, I have a barrel of crude oil and I create kerosene, and the reason it was called Standard was because it was the kerosene that didn't blow up in your face. And so if someone came along and said, like 1 out of 100 gallons of the kerosene blows up in people's faces, and should we just go ahead and ship that one, and then we'll put a little disclaimer on the can that says you need to test this before you use it? It's like people would say that's not a good business. It's not 1% less good. It's like 100 times less good. So what we're doing is creating the very best credit we can create. And in this particular case, I think the value proposition to the investor is the company is going to create liquidity around par as much as you need. If you wanted to buy $1 billion of this, we're not going to make you pay $110 a share. We're going to sell it to you at $100 and a penny or 100, you know. So that's a value, and that would cause someone to come in. And on the other hand, somebody wants to know that if they sold at 100, they didn't make a mistake. And also, if this thing falls below par and it falls to 95 or 90, the company is going to use all of its resources to bring it back to the trading range and to bring it back to par, right? That's what we're going to do. And so if we're ambiguous or unclear about that, then we have broken the promise, right? We have undermined the value proposition of the instrument. The instrument is to be the lowest volatility, highest liquidity, most predictable credit instrument in the digital credit market, right? And we want to create the best credit instrument we can possibly create. And so allowing it to flex, you know, and rattle around is an abrogation of that responsibility. But I'll make one more point. The people that say that, sometimes they say, well, you should do that because that's like bad for the shorts. Like if you let it float up to 101 or 102 or 103, people won't want to short it. We're putting the interest of the $10 billion of credit investors ahead of the interest of the $300 million of short investors. Like the point is run this program to the benefit of the people that buy the credit and hold the credit, as opposed to worry about the short sellers. Our view is even if someone shorted STRC at $100, that's good for us. Like we welcome that. And because if someone wants to come in the market and pay 12% dividend to create liquidity, and then they're going to put their balance sheet and post their balance sheet to build digital credit, we actually think that's good for the ecosystem. So we're not trying to discourage short selling. If someone wants to short $10 billion of this thing when it hits 100, then we will have $10 billion of credit and someone else will be paying 12% interest on their 10 billion. And so you can see someone else will be paying $1.2 billion of dividends to make STRC a $20 billion AUM instrument. So we just don't see a logical reason why you wouldn't, you know, run a very disciplined program to strip the maximum amount of volatility off the instrument. That is consistent with the highest liquidity. And since that's the highest liquidity, that makes it the best credit instrument. And if it's the best credit instrument, then the demand is going to be higher. Everybody wants the best thing. And then if the demand is higher, that's good for the common stock and it's good for the company and it's good for everybody else. So we're going to create the best possible product we can create. And we're not going to worry about how someone might view it if they're a short seller one way or the other. By the way, Natalie, if somebody really wants a product that will trade between 95 and 105, we have one. It's called STRF. Well, by the way, it's actually less risky. It's more collateralized, it's longer duration. If you're a long duration credit investor and you want something that might trade above 100, then I would encourage everyone to buy STRF because it was designed to literally do that. And what you'll see is if you look at it is the demand and liquidity for it is 20x less than STRC. So if people are wondering what would happen if the company let STRC trade like STRF, what would happen is the demand for the instrument would fall by an order of magnitude and the liquidity would collapse. And when that happened, confidence would collapse. So in my opinion, it's not a good idea to let the instrument float randomly around.
All right, thanks so much for that, Michael. We have about 10 minutes left. I'm going to try to get through as many questions. I know a lot are still coming in. So if we can keep the answers a little bit more concise, just so we can get through a couple. Starting with Osama and Eric both asked, Michael previously suggested that Bitcoin could reach 1 million per coin if Strategy accumulated 5% of the total Bitcoin supply and potentially 10 million a coin at 7%. Have your long-term price expectations and assumptions evolved given that the price is lower now than in November 2021 when Strategy owned about 120,000 Bitcoin?
We don't have a precise forecast for when those prices get hit. We know directionally that the more Bitcoin we buy, the better it is for Bitcoin. We're in the middle of a bear market right now, so things are a bit harder and the going is a bit tougher. But we will continue to acquire Bitcoin, and we think, again, if you're a short-term price predictor, you're a trader, I don't really have much useful wisdom for you. My advice is don't invest in Bitcoin unless you're going to hold it for more than 4 years. Ideally, hold it for 10 years. And what we think is the more Bitcoin we buy, the higher the price will go. And we remain bullish on the asset over time.
This question is from William. Fong, maybe you can take this one. Frontier AI models have identified security vulnerabilities in many kinds of software systems. How is the company thinking about this threat with respect to Bitcoin custody, and what are you doing about it?
Well, I'll start with we custody with 3 of the largest institutional grade custodians in the world. And we sit down with them all on a regular basis and go through what are some of their security measures that they have in place, both related to their software and their hardware, related to their personnel and their automation. And by the way, these are the same custodians that custody most of the Bitcoin ETFs in the world. So they're evaluated by a lot of folks. We have advocated for all of them and just the open source Bitcoin community in general to have access to the frontier models. Some of them do, and they do run the frontier models against some of their software. We're starting to do that too. So I'd say rest assured, Bitcoin security and custody is probably the most important thing beyond our Bitcoin capital planning in the company. And we take it pretty seriously. And I'm sure some have seen, we've also become part of the Bitcoin Security Consortium, which puts together some of the largest Bitcoin custodians, issuers, exchanges, holders, banks in the world. And we're working together with them too, and taking sort of the strength of all of our institutions to work on this together.
This question is from Jim. It's directed to you, Michael. Did you ever believe in Bitcoin's ethos of separating money from state, regardless of how long that takes? And could you pay dividends in Bitcoin rather than the US dollar?
Well, I think Bitcoin's valuable because it's a non-sovereign store of value, just like gold. And so it separates capital, it separates money from state. And the larger it gets, the greater portion of the global capital is sitting in a non-sovereign digital asset. So that's why we're enthusiastic. We don't have any plans to pay a Bitcoin dividend. We think that the wise trade, given the fact that 99.9% of the money in the world is in fiat and 0.1% of the money in the world is in Bitcoin, the smart trade is to sell credit and pay the dividend in fiat currency and to buy BTC. If BTC is appreciating 30% a year, we expect it will always appreciate, say, faster than the S&P index. The credit rates are all much, much lower. And so we would rather pay 10 and collect 30. If we were to pay a Bitcoin dividend, we would be paying 30 to collect 10. So the problem with paying Bitcoin dividends is your cost of capital becomes the strongest money. It's kind of like agreeing to pay 30% yield and then investing in a bond from a country that pays you 4%. And so it's kind of if you get the trade that direction, it's the wrong direction, you'll go bankrupt. And so I don't recommend it to anybody. The right thing to do is to borrow money in dollars or yen and to invest it in BTC. And that way you're capturing the spread in the right direction. And of course, there's 1,000x more money to borrow in yen and dollars than there is money to borrow in BTC. So it makes sense to issue fiat credit instruments and buy digital assets like BTC. The opposite direction doesn't really make economic or financial sense.
Right, this question is from Anthony. Earlier this year, there were advertising campaigns for STRC on X created using AI. Some of the advertisements included the retired engineer lady on the beach resort, the This Is Spinal Tap parody, and a mock-up of some traders discussing STRC. What were the results of the advertising campaign, and is the strategy satisfied with the results?
Well, some of the results were the number of views that we looked at, click-through rates, people who came to our website, dwell time on our websites. So if you look at those as metrics, they were all quite positive. And I do think it led to greater retail adoption of Stretch. So, and look, just using AI and discovering all the capabilities it had was fun, and it created a narrative. So I think overall, I was fairly satisfied with the results of the campaign. That said, if we think that institutions are a greater target for STRC, then I don't think those advertisements are really getting to the, causing them to buy the instruments. It makes them aware.
All right, I know a lot of people are always on the watch for your upcoming AI videos, Michael. We're going to end this with a little bit of a lighter note. We got a question from Jay asking what you guys do to unwind. Do you play video games? Do you play sports or have any hobbies that you can share? Have a great day from Jay.
We create and post AI videos promoting Bitcoin in different languages lately. That's been the most fun. Me speaking Korean, Japanese, Italian, and French.
That's right. And I think I heard you say on a show, Michael, or during an interview that, a picture can say 1,000 words, right? And these images sometimes reach more people than, say, a quarterly earnings call or a book, for example, right? You can reach a lot of people and not even necessarily have to say anything. The video or the photo speaks for itself.
I do some fun things, Natalie. I know Mike just only works, but I do some fun things. I have 3 kids, a wife that I love to spend time with and travel with. I play basketball. I love to cook, as you know. And I do play video games and watch mindless shows from time to time, but I try to be pretty fastidious about protecting my time from doing things that don't create much value.
Guard your time. That's one of your 10 pieces of advice, Michael. That brings us right to the end of our Q&A session. Michael and Phong, thank you so much both for sitting in the hot seat and taking the questions. Thank you to everyone who submitted one. We received far more than we could possibly get through today, so hopefully we'll have another Q&A session soon, and we really appreciate everyone who took the time to participate. If you did miss any part of the conversation, again, the full replay will be available on Strategy's account, and I will also be airing it on the Coin Stories podcast. So Michael, Phong, thank you so much. Thank you to everyone for watching and listening. I'm Natalie Brunell. Please check out my book, Bitcoin is for Everyone, and take care. We'll see you next time.
Thanks, Natalie. Thanks, everyone.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
What makes Japan so special? Why is it breaking all of our models? Japan is basically the monetary experiment proving ground for all central banks.
Why do you feel like this is the preview for what we're going to see everywhere else?
Their goal is to eliminate the business cycle. And that's kind of like the central banker's wet dream. Besant said that this is just what allies do for each other. No, it's not. There's something you do when you're scared. The problem with treasury companies is that too many of them focus more on acquiring Bitcoin than they do on their own fundamental business. One of the biggest things that you need to change is this idea that busts are bad. Because nobody ever truly loses, everybody loses.
Does it seem to you like we're past the point of no return when it comes to that?
They need to perpetuate the current system in order to maintain their power.
So what are we looking at next? Welcome back to Market Disruptors. Today I'm joined by Roberto Rios, the artist previously known as Peruvian Bull. And he's been this leading voice in this conversation around the Japanese yen, the carry trade, the global ramifications going around this. So I'm really excited for this conversation today. For those at home who noticed my black eye, big Bitcoin called. I got a shakedown. No, I'm just kidding. But just putting it out there. Yeah, we got a little black eye. It's all right.
Yeah.
Roberto, thanks for joining me, man. I'm excited for this.
Thanks for having me. And yeah, that black eye looks pretty badass, man. It looks like you fought off a wrench attack, with your bare hands.
Yeah.
So
yeah, I keep a wrench on me.
Let's go. Keep those hammers ready, dude. Yeah, it's good to see that. But yeah, thanks for having me on. I'm super excited to talk about this because this is obviously like the news of the hour. Japan's currently in crisis management mode, and everyone's eyes are pointed there.
Yeah. Yes. I mean, it's hot right now. We'll turn this around in probably like 2 days or so. And so this is something you've been talking about since we met back in 2024. You had the foresight to see that this was going on. And then, now's your time to shine as it's really picking up. And you're the guy. When I was reading about this, I was like, you know what? I got to talk to Roberto. He's the perfect person to have this conversation with. For a little intro, so you started off this video that you put out a couple weeks ago, citing a tweet that said this. It said, "The measures being prepared by the Bank of Japan will affect the lives of billions of people. To the people of the Western countries, I offer my deepest apologies. This is not a personal matter. May God's blessings be upon you," which is a pretty ominous little warning, and then it's continued to play out since then, since you brought this up. Scott Bessent, in this quote unquote leaked, which clearly wasn't leaked, to-do list that he had, said he intended to buy 5 to 10 billion US dollars worth of Japanese yen to prevent further devaluation. And this, which helped for like hours, it kind of helped the market for a few hours, and then the collapse continued. So I'm not a total expert in this topic, but I've been paying attention to it in a lot of ways mainly through the writing that you've been putting out. So I want to see if we could start with zooming way out, even before what you're writing in 2024. Like, what prompted you to start looking into this, discussing this? If you could give our audience a little bit of that zoomed out background before we get into what's going on today.
Sure, absolutely. So, I got into macro basically before my freshman year of college. So this was around 2015. Started researching, global monetary system, money flows, capital flows, different forms of economics, right? Austrian, Keynesian, monetarist. And, within a couple of years, like I felt like I'd built a pretty good base of understanding of how the global monetary system works. And I credit, Luke Roman, Lynn Alden, a lot of those people with a lot of the knowledge I gained in those years. But one thing that always stuck out to me, which was strange, was a stat that I'd read from Hindenburg Research back in 2018, which was in the past 150 years, so since around 1850, there's been 55 countries that have had their monetary system go above 120% debt to GDP, which seems to be like the magic number where either inflation, hyperinflation, debt defaults, demonetization, right? So like El Salvador, for example, went off of the Salvadorian peso and went onto the US dollar, right? There's rumors that Argentina is going to try to move onto a US dollar standard, right? So basically getting rid of their own domestic currency altogether. There's been 55 countries that have gone past this 120% debt to GDP. And of the 55, 54 either, again, defaulted, hyperinflated, financial repression, or just inflated away the debt, right? Or had a severe sort of depression or recession, as a result. The one exception
Is the go ahead.
the one exception is Japan, out
Okay.
of 55 countries in the last 150 years. And so then that started begging the question.
Didn't the U.S. tap like 130 or something back during World War II?
It did. And
Okay.
well, actually, right in the lead up, in the lead up to World War II. And then that was followed by, and most people don't know this, but basically 20 years of the Fed keeping interest rates artificially low and running inflation a bit high in order to
Okay.
offlay a lot of the debt. Although, of course, a large reason why we were able to get out of that was, you could say the growth spurt that happened in the 1940s and 50s as the baby boomers were born and as the U.S. industrialized and trade globalized. But
Which is
before
the
that was
opposite of what we're looking at today.
yeah,
Right.
exactly. That was preceded though by a 13-year-long Great Depression. And so for most countries that reach this 120% debt to GDP, 130% debt to GDP, they all face severe fiscal consequences, right? Japan is the only exception. And for many years, people thought like, well, Japan's kicked the can down the road for 30 years. Why can't they do this forever? And so that's when I started researching Japan. And I was curious. I was like, what makes Japan so special? Why is it breaking all of our models? Why doesn't it follow any of the conventional rules? And then that quickly led me down the rabbit hole of realizing that Japan is basically the monetary experiment proving ground for all central banks. So every single policy that we think of, QE, negative interest rates, 0% interest rates, QE infinity, yield curve control, all of this was invented and termed in Japan. So like the term quantitative easing is the translation of a Japanese word. It was termed by Richard Werner in the late 90s, right before Japan actually started to do QE for the first time in March of 2001. So everything that's being rolled out across the West was first tried in Japan. And Japan is kind of like the preview of what all of us will get to see. And that made me realize that this was a very key country to pay attention to. And so for 2022 and 2023, I started paying attention to it more and more. And then obviously I started writing, I started my Substack in 2023 in April, and then I started writing about it. And those posts, ironically, were like probably my most viral posts ever. And so I just kept doubling down. But it truly is the enigma. It's truly the outlier. It's the one of one that, nobody truly can understand unless you go deep down the rabbit hole.
Interesting. And why do you feel like this is the preview for what we're going to see everywhere else?
For a couple reasons. One, Japan is ahead of the West in terms of demographic decline, as well as like societal decline. So you look at like, rates of teenage relationships or marriage rates, or again, like birth rates, obviously. All of that started falling in Japan in like the late 2000s, early 2010s, even before they really started collapsing in the West in like let's say the late 2010s. So they're about a decade or two ahead of us on almost every single metric. But more importantly, the Japanese culture, basically, in my opinion, has been kind of emasculated by the central bank, right? The central bank has basically de-risked the entire system, right? You can't really fail because all the debt can be rolled over at 0%. But then the result of that is that because all this productive capital is now locked up in zombie companies, because of all these companies just rolling forward debt at 0%, there's no actual capital to be put into productive companies. So you stave off the collapse, but you also make sure that there's no boom either. And that's kind of like the central banker's wet dream, right? Their entire goal, if you go to an economics course or you take a finance course about central banking, their goal is to eliminate the business cycle, right? This is one of the stated goals of the 1970s Fed. They wanted to ensure that we don't have the boom and bust cycle. And so the way that they thought they could do that is by raising interest rates into a boom and then lowering interest rates into a bust, and then doing that perpetually. And then their idea was that instead of the GDP growth number going like this, like a jagged line up with a boom and a bust, and then a boom and a bust, that it would just be a perfect straight linear line. And again, nowhere have they gone as hard as they can as Japan. So that's been their like basically monetary experiment proving ground, their lab, so to speak, in order to, you know, test out all these theories and see if they can work on the Japanese populace. Because if they work on the Japanese populace, they can hopefully be rolled out to the rest of, you know, the Western world, in their opinion.
So relating to this in one of your pieces, I think it was the Godzilla Returns one from 2024, if I'm remembering correctly, which that was like, that has millions and millions of views now. Like which is interesting, you know, but that was big back then, right?
Yeah.
And so you've continued to talk about these ideas. One that stood out to me in that was the impossible trilemma that you, I don't know if you coined that term in that, but this is the problem Japan's facing right now, where basically every country that is not a global reserve currency issuer faces a choice between three things. These three things being the free movement of capital, where money can flow between countries freely, in and out of the country freely, I mean, independent monetary policy, so what that central bank does and how that relates to the global reserve currency central bank, and then having a stable exchange rate, primarily, I would assume, so that they can have like long-term international trade contracts. And the point you're making is that they can only choose two of the three of these at the same time. And so the third one has to be sacrificed. So I wonder if you could explain that a little bit more in depth, and then tell me which one Japan has chosen and what they're sacrificing as a result of that.
Absolutely. Yeah, the impossible trilemma is definitely not something I coined. It's a concept in monetary economics. It's actually an observation, right? It's like you look at China, you look at Russia, you look at all these, you know, especially net exporter countries, and they deal with this problem. Like you said, you can pick two of these three, right? The stable or floating, you know, exchange rate, monetary autonomy, meaning like your central bank raises when they want to, regardless of what else is happening in the world, and an open capital account. And the reason why those three things are what matters is because those three things are what determines the inflows and outflows of currency, right? And the inflows and outflows of currency set your trade balance and set your exchange rate. And for a country like Japan, which is a net exporter, well, you need to have an open capital account, which means an open capital account just basically means money needs to be able to flow in and out of the country, right? Some countries like China make it very difficult for Chinese money to flow out. It's easy for money to flow in, or it's very easy to open up, you know, investment products in China and have foreigners invest in them. It's very hard for you to get them out, for you to get the money out. And so that means that, you know, if you're going to, you know, facilitate trade in a way that, you know, you can settle payments, if you have a country that only accepts and doesn't send payments, well, how are you ever going to facilitate, like, you know, global trade? You can't. So that kind of a choice, right, basically restricts the economy into almost like a single-use exporter-based economy. And there's no way that the, you know, economy, like the Chinese economy in its current state, can expand beyond that, even though they want to, right? The next thing is monetary autonomy. So monetary autonomy, again, means raising or lowering rates at will. The reason why that matters is because interest rate differentials between currencies are part of what drives currency flows. So, like, let's say, again, Japan's at 0 and the US hikes to 5%. Well, then a lot of people will go to Japan, right? This is what happened with the carry trade. They borrow money at 0% and they go and turn it into dollars and they park it in treasuries. And that earns them free interest. And the size of the carry trade is controversial on the actual number. Obviously, it's basically immeasurable because it's diffuse. It's spread out among millions of people's accounts. But the numbers I've seen are, you know, on the low end, 2 trillion, on the higher end, 4 trillion. And if you include banks, pension funds, government holdings, what you'd call like unfunded liabilities in Japan that are financed by, you know, U.S. Treasuries or U.S. tax flows, or U.S. currency flows, that number can balloon up to $20 trillion, according to Deutsche Bank. So this is a huge thing, right? And that monetary autonomy, again, for Japan is very, very important because Japan is at 260% debt to GDP. And that monetary autonomy is needed so that Japan could stay at 0 or at least low, right? Right now, the policy rate's at 1. And so if Japan wanted to give up monetary autonomy, that means it basically becomes a copycat of the Fed. So what does that mean? The Fed does a hiking cycle. Japan would have to match them, like in lockstep or close to it. Let's say we're off by 3 or 6 months. Okay, you can't have Japan sit at 0% and the Fed at 5% without something bad happening. And
what happens? So if they don't hike, what happens? And if they do, you know, in one direction, what's the problem, right? If their rates go too high, their debt runs away from them. Yeah. So what happens in both directions of that?
For every 1% increase in for every 100 bips increase in you know, total interest rate across the yield maturity curve, Japan pays 2.6% of their GDP in interest. So, like, do the math. If they normalized with the Fed in 2022, they'd be paying 13% of their GDP alone in interest. And that's almost their entire national budget, right? I think the national budget's like 18 to 20% of GDP. So, you know, you'd be paying 2/3 of it just in interest. So if you hike, you basically hike yourself into an insolvency problem very rapidly. And
that's built on top of very similar problems that we have in the United States right now with if we, you know, we're at that place where as we increase our interest rates, our debt is running away from us. We have all this deficit spending that needs to continue, all these unfunded liabilities. So it's that problem is built on top of a system that shares like a same exponentially growing problem.
Yeah, exactly.
Essentially, right?
Exactly. No, exactly. I mean, again, Japan's just further down the road compared to the US, but the US has the same problem, right? We have $2.1 trillion deficit, $1.2 trillion in interest expense annually, right? It's now the largest line item in the fiscal budget every year. It's compounding by 23% annually since 2020. Like it's rising way too fast in the US, but my point is that Japan has just a more extreme version of that. So if they normalized with the US, meaning if they matched the US and went to 5%, or now it's at what, 3 3/4. If they went to 3 3/4, it'd still be 10% of GDP, or 9.5 or whatever. It's an insane amount of money. Like they don't have that money, and so they'd have to print it, and so that would just cause more devaluation. And then the last one is the blowout valve that they've chosen so far, which is the yen, right? So they said, okay, we're going to keep an open capital account, so we're going to keep trade flowing in and out. We're going to keep monetary autonomy because it can't hike into a basically, insolvent government. So we'll have to let the third one be, the pegged exchange rate, take all the pressure from this pressure cooker. The problem with that is USD JPY blows out, goes from 110 to the dollar to 155 to the dollar within the span of like 7 months in 2022. And then they start panicking because they realize, oh shit, we import 93% of our total energy needs and over 85% of our caloric needs. So when the exchange rate blows out by 40%, that means your food, your gas, your transportation, all of that goes up. Your electricity costs, all of that goes up in lockstep with the devaluation of the yen. And that drives inflation in Japan, and then that's very unpopular. And so then they start panicking, and they realize, okay, we need to start intervening. And then that's when, on September 22nd, 2022, that's when they started the interventions. And, they haven't really looked back. They've been trying everything since then, but truly, as we've seen, nothing's really worked.
Hey, look, over 130 million in Bitcoin was just stolen from cold card hardware wallets. This is the largest hardware wallet hack in history. And the sad part about this is that the victims, they did everything right. They had real devices, they kept it all offline, but there was a small firmware update that let hackers access their Bitcoin wallets and completely drain them. Now, don't blame self-custody. Self-custody isn't a problem. It's single key custody. That's the problem, when you have a single point of failure. So here's what I actually do. I've been doing this for years because I was always afraid something like this could happen. Now, this happened before Unchained ever sponsored me. I was a customer, and it's my Bitcoin, it's my parents, it's my sister, my family's Bitcoin, and it all sits in what we call multi-sig wallets. And I do that with Unchained Capital. Instead of one wallet and having one key, there's 3 keys on 3 different devices, 3 different places from 3 different companies, okay? I hold 2 in different locations, Unchained holds 1, and it takes 2 of those wallets to move anything, which means like this exact hack right now that got everybody drained, 1 compromised key won't be enough. It probably sounds complicated. Don't worry. Unchained has a concierge service where they can walk you through the entire thing one-on-one, and they're gonna build out your vault. They'll test your recovery. They'll have an expert review everything, making sure you don't have any problems. If you wanna do the same thing I do, the same thing I have my family do, go to unchained.com/MarkMoss. Again, unchained.com/MarkMoss. Set it up right. Do it once. Don't get vulnerable to a hack like this.
Yeah, and so they have spent, the Bank of Japan has spent tons of printed yen essentially to prop up the currency. They've now recruited the US Treasury to come and help try and bail them out, prop up the currency, but it's not working really. Why do you think it's not working?
It's not working because the structural problem isn't being solved, right? I said this in the spaces the other day. But even if you get rid of like, the negative problem of, let's say, the carry trade, right, which is a large part of the reason, the Japanese fiscal situation is extremely dire, and the new prime minister, Sanae Takaichi, is a populist right-winger who wants to increase government spending and wants to cut the consumption tax, which is one of the largest line items of government revenue for the Japanese. They have an 8% consumption tax on all food and beverage, as well as fuel oil. So when you go and buy gas, when you go and buy, water, food, whatever it is, you get taxed on it. And it's mainly a tax on the working class, obviously. And it brings in a lot of money for the Japanese. I mean, it basically gives them the equivalent of their entire public middle school and high school budget every single year. So it's a large amount of money. And if she's making these tax cuts like that, and then she also wants to repeal Article 9 and create a Japanese, new Japanese military, which is another 2%, 3% GDP that she'd have to spend, then the fiscal situation is going to get worse. And that just means more printing yen, more devaluation. And so that's why the bond yields are spiking. That's why, the yen keeps collapsing, regardless even of what happens with interest rate differentials, because now it's like they're basically past the event horizon of even that mattering. The debt is just so heavy. It's just sucking in everything around it. And anything they do just makes the problem worse.
So I want to keep pulling on this thread and figuring out where you think that this goes in terms of Japan and in terms of the United States. So I guess one more question before we go into some of the forward-looking projections is, I know that Japan is one of the largest holders of U.S. Treasuries globally. And so in what ways does their currency crisis affect and create risk upcoming for the United States bond market? Can you explain that relationship between the two to me?
Absolutely. I mean, again, you're right. Japan is the largest holder of U.S. Treasuries, $1.2 trillion roughly, mostly held on account of the U.S. Fed, or the New York Fed. And those treasuries, the problem is that using them for yen interventions, right, which is basically what they do is they sell U.S. Treasuries, they get dollars, they go wade out into the foreign exchange market, and they dump billions of dollars into the market to buy yen to strengthen the yen artificially against the dollar. And so their first one, like I said, in September 2022, brought the yen from 155 to 147 within a day. They had to follow that up with more yen interventions on October 21st and 24th of 2022. That month, they spent $60 billion. The first month was $20 billion. And they followed that up ever since with escalating and growing interventions, right? So the May and June 2024 one was the biggest yet, which was $60 billion in May, and then another 35-40 billion in June. That didn't solve the problem. And the reason why is because functionally how a yen intervention works, again, is selling treasuries. Well, what happens when you sell treasury bonds, especially 50, 70, 80 billion in a day? Well, it drives yields higher. Well, what are those yields? They're returns on government bonds.
It drives yields higher because that's happening because they're saying, okay, we have these bonds for sale. We need to get them sold. So they continue to increase the bond yields until they're sold, essentially.
Yeah.
Right. And so that's that relationship. Okay. Yeah.
Yeah.
And then you were saying then
even better, the bond price is inverse to the yield, right? So they go out, they sell a bunch of bonds. Let's say the bond price goes from 950 to par, which is like, let's say 1,000, to 920 to par. Well, that raises the interest rate from 4 to 5%, or, you know, maybe not extreme, but like 4 to 4.5%, right? It spikes yields. And you can see this, like I've tracked this on the days of the interventions, the US Treasury, especially the long end, like the 30-year, 20-year, and 10-year yields all spike intraday. And then they start to like stabilize at a higher level. And usually I think it's a spike of like 20 basis points, 10. It depends, but it's a lot of selling, right? It's raising a lot of cash, and that drives yields up in the US. And then that means that the carry trade that we talked about earlier is now even more profitable, right? Because now suddenly a trader can say, oh, I can lock in at 20 basis points more. I can get an extra, you know, couple fractions of a percent. They may not sound like much, but when you're using leverage and when you're using free money, which was what Japan had for 34 years, 0% rates or even slightly negative, right? Since February of 2016, their policy rate was slightly negative. It was like negative a tenth of 1%. So when you're getting paid to borrow and the US yield to go up by 20 or 30 bips, it's like, why would you not borrow more and add more leverage to the trade? You will every time. So
which makes it worse than kicking the can down the road. It's like, you know, pouring fuel on the fire.
Yeah, it's like shooting yourself in the foot, or shooting yourself in the face. Like it's really crazy, man. And they kept trying this, right? It didn't work. And then, you know, up until, you know, December 2023, they'd had the yield the bands on yield curve control at negative 0.1 and positive 0.1%. So they basically had said the 10-year, you know, JGB, Japanese government bond, cannot go above a tenth of 1%. And we will buy unlimited amounts to, you know, make sure it stays within that band. Well, finally, December 2023, they moved the bands to positive to 0 and then positive 0.5%. And then that helped the yen for a month maybe. And then the yen continued to decline. And then they moved the bands again. And then that helped for a little bit. And then it continues to decline. And then they hike out of, you know, their policy rate. Finally, they hike out of the negative bound. They go to positive 0.1%. That helps a little bit for a few weeks or a month, and then it starts to decline again. You know, the yen starts to decline again. So at every stage, right, they've started to unwind all of their crazy, you know, QE, ZERP, NERP policies, you know, YCC policies, but all of it just slowly stems the bleeding, but then the bleeding just resumes again, you know, in a month or two. And that's very apparent with this recent intervention, by the way. From April 30th to May 6th, you know, the Bank of Japan had spent, like, I think it was $73 to $75 billion, the largest intervention at the time, slammed down USD JPY from 161 to 155, 154. And within a month, you know, by the end of June, it was already back up to 160. And that was the biggest intervention on record at the time in, you know, April, May of 2026. And then, of course, July 30th and 31st, they just did it again to the tune of 90 billion. So they're adding 15, 20 billion every single time, but it's still not having the same effect. Right now, USD JPY is at 159.3. I checked this morning, and that's half of the move. So in 10 or 11 days, it's already retraced half of the move that they got from $90 billion, their biggest intervention yet. And functionally, obviously, this was the first different intervention, right? In this one, they didn't actually go out and sell the treasuries on the second day. So the first day, it looks like they did. On the second day, they went out to the FEMA repo facility at the New York Fed. They pledged those treasuries as collateral. They borrowed against them with US dollars, and then they used those dollars to pay off, you know, to buy back the yen and strengthen the yen. And in conjunction, Treasury sold euros, bought yen, and intervened, you know, alongside them. But that doesn't solve the fundamental problem, which is the Japanese fiscal situation is very dire. The carry trade is still on, and they're still a net energy importer, right? And there's still rumors and chaos going around with the war in Iran and, you know, oil security. So that doesn't solve any of Japan's immediate needs. And in fact, in many ways, you know, it exacerbates them because it makes Japan look even more desperate.
Right, right. And I'm pretty sure, I want to say 90 or 90+% of their oil that they were importing was coming through the Strait of Hormuz. And so I don't know where it's been coming from since then, but clearly that's, yeah, another source of tension on this. Um, so then what next, right? So clearly we have this issue that, if you look at any of the charts, Bitcoiners are familiar with exponential charts, right? You look at any of these charts, we see this exponential problem coming. They're spending more and more money on what seems to also look like an exponential trend on these interventions that are not working. So then what? So what are we looking at next, do you think?
Like what's next for the yen or for
Yeah,
money?
so maybe a better way to frame it is I could see like a maybe orderly yen unwind or carry trade unwind and like a chaotic unwind. And yeah, which of those do you feel like you see coming? What do you expect to happen next in terms of trying to solve this issue?
Well, there's a couple options, right? The first is to continue with the madness that they're doing, which is what they've continued with, right? Like sell treasuries, or in this case, pledge treasuries as collateral, go out, buy a bunch of yen, try to strengthen the yen against the dollar, and then have to pay back the loan in a week, which is the term of the New York Fed, FEMA repo facility. The problem is that's expensive. They charge 25 basis points above IORB, which is sitting at 3.65%. That's the interest on reserve balances at the Fed. And so the total interest rate that they'd be paying is 3.9% for a $90 billion loan. And even though the term's only a week, obviously that's still a week. It's a lot of money. They have to pay it back. So that sort of strategy is probably, if I'm being honest, it's probably one of the more likely scenarios, because Japan, unfortunately, doesn't really have, again, a good option with letting the yen depreciate. Some yen bears say, hey, they can let it blow out. It won't really matter. Nothing will happen. Let dollar yen go to 300, right? Again, the issue with that is Japan imports 90% of their energy and 85% of their food. And for the last
Which means
20
basically the
years,
prices of everything double,
yes.
right?
Yeah. And for the last 20 years, right, inflation's been zero, growth has been zero, and wage growth especially has been extremely low to zero. And so the Japanese economy is essentially engineered in a way to assume that the prices of everything stay stagnant and that wages as well stay stagnant. And if you introduce a price shock like that up to that level, to an economy that's not prepared for it, you could see riots, you could see demonstrations in the streets, you could see political extremism, and the people in power at the BOJ and the LDP, the Liberal Democratic Party, which has basically ruled Japan since 1955, they don't want that to happen, right? So their main goal is to keep USD/JPY as low as possible, to keep stop the depreciation. And even though this selling treasuries thing is madness, they don't really have another choice, right? It's just what they kind of have to keep on doing. So that's what I think is the most likely scenario. But again, they could try to just take the pain and just say, you know what, let's stop with these interventions, let it blow out, let the inflation rise, and we're going to have to work as fast as we can to try to build a domestic energy and food industry here in order to sustain ourselves. Again, the issue with that is Japan doesn't have much natural resources to speak of. They have basically no natural gas. They have no oil fields to speak of, no petroleum or what's called shale oil sands. For their agriculture, they actually have a very low percent of their total land mass is arable land, meaning like farmland. A lot of it is heavily forested or mountainous rocky terrain. So that land isn't really prime for growing stuff. And the main thing that they can grow in Japan is rice, and rice is not very calorically dense, right? So you basically have this situation where their geography, their history, their culture, right, everything has limited them in terms of their options for independence, especially in terms of food and energy. The Fukushima nuclear disaster, which you remember, there's a nuclear plant that basically melted down after a tidal wave hit it. That freaked out Japanese politicians so much in 2011 that they made a push to shut down a bunch of their nuclear reactors. So they have 55 total constructed nuclear reactors, and right now only 13 are operational. And obviously, since COVID happened, and then now, especially since the Iran war, the recent administration has been pushing to reopen and turn back on some of the decommissioned nukes. There's about 22 that I read that can be turned back on, without major construction. The problem is the process of turning on a nuclear reactor takes around 3 to 5 years. So it's not like flicking a switch. It's very intense, difficult work. You have to be very careful. Obviously, so uranium nuclear reactor, you don't want to melt down. And so their energy needs are also their electricity needs are also very, precarious right now. So it's going to take years for them to start to gain their independence in terms of energy back. But long term, they're always going to be dependent on other countries, which is, by the way, that's why the Japanese Imperial Army invaded most of Southeast Asia in World War II, is they were looking for oil. They were looking for, arable land. They were looking to conquer in order to secure resources for the homeland. So it's just been a perennial anxiety for the Japanese.
What are some of the non-monetary policy drivers and factors related to this? You just cited like there's these cultural factors, historical, these sorts of things. I know age demographics are a big part of this, and I sort of wonder at the same time as you explain this, like how much of it is a chicken and the egg problem versus are these changing cultural, societal, plummeting marriage rates, fertility rates coming from a currency problem? Is the currency problem coming from these? Is it both and? Yeah. What do you think of that?
It's a good question. There was a really good Substack post made a few weeks ago called No Country for Young Men. And the post was about Japan, right? It's a really long post, but I highly recommend it if your audience wants to check out some good writing on Japan. But the post basically made the case that Japan has basically made it very difficult to be a young person, especially a young man, within the country, right? There's in many Asian countries, there's very strict and like legalistic frameworks on how to become successful, right? You have to go to law school, you have to be a doctor, you have to be an engineer, you have to follow the structured guidelines on what exactly to do and how to rise through the ranks, right? And especially in Japan, but also in Korea and China, there's a very strong insistence on honor culture, right? Somebody who's older than you, someone who's your superior, is someone that you need to listen to, even if you believe they're wrong, even if they are wrong. It's not your place to speak up. It's not your place to fight back. It's your place to shut up and listen, right? And to hammer that point home to me, Weston Nakamura, when we filmed, I have a documentary up on my YouTube channel about this, but Julian Figueroa and Isabella and I were there in March 2025. We filmed the documentary on this, and Weston was
that's super cool. I'll have to link that. They're interesting. Yeah, people in the space.
Yeah, this is a really good experience. But when we were there, Weston was telling us, he's like, if you're a Japanese, let's say corporate worker, you're an accountant, you're a financial analyst, you're a lawyer, whatever, you don't get promoted based on merit. You get promoted when the guy above you dies or retires. And if your boss makes mistakes, if your boss does things bad, you cannot speak up in any sort of meeting or public situation and criticize them. That is completely taboo, right? And this fear of like losing face is so prevalent that the Japanese have actually created a new way of firing people, which is they don't even fire people outright. They just give an employee less and less work until they're basically doing nothing and they feel useless and they quit out of shame. Right. These are things that only would happen in Japan, right? Because of this 1,000 years of samurai honor culture, respecting elders, that's been ingrained into their society and their psyche so deeply. The problem is that creates a work environment, a business environment that's very hierarchical, very rigid, right? Weston made the great point. He said, where's the Japanese Mark Zuckerberg? Where's the Japanese Elon Musk? Where's the Japanese Jeff Bezos? It's like they don't really exist. All the Japanese have done is they've taken already existing ideas like the car or the radio or the TV, and they've made the production process and the actual end product higher quality. So they've improved the quality drastically of an already existing invention. But in terms of actual raw inventions, it's very low. Because again, their culture does not prioritize creativity or openness or breaking through barriers or breaking preconceived notions. It's all about rigid, structured following of guidelines. And so that's basically crippled them in terms of their creativity and their entrepreneurship, but it also has played to their strength in terms of manufacturing prowess. What the US military does now and what, US defense manufacturers, auto manufacturers do now in terms of quality is only possible because of what they learned from Japan in the 70s and 80s, during the, Six Sigma manufacturing improvement era. So, and many of them actually hired Japanese engineers to come and consult. Right, they're very good at that, but then that leaves their economy very structured and vulnerable, and makes it very hard for them to adapt to this ever-changing world that we're in.
Seems like that's how you would set up your culture and economy if you wanted to like completely discourage innovation, right? It's very different from the American way, and there, I think in American business, perhaps there's a lack of that. I notice in, how would you put it, like a cursory study of Japanese culture, there's a lot more emphasis on like taking responsibility that I feel like you wouldn't find as popular in American culture. There's a lot of finger pointing in American culture, but also too, there is this pragmatism that I think comes from like earlier American philosophy in some ways, where it's just like, if it works, you get it. If you're the guy, if you're doing it the best, like, if you're on a sports team and you're the next man up, if you're doing better than the guy who's in, you're in. It's not like, oh, this guy's been on the team longer. I think a lot of businesses are structured that way as well, where it's like, okay, if as soon as you're more productive, better, you're in there on the front lines, and so that's but I think that there, in a lot of ways, seems that our cultures are opposites to one another, and so there'd probably be a lot, like much more benefit from the things that we could adopt from each other's cultures in that way too.
Yeah, I agree. And again, to drive this point home, there's a study of all 50 developed countries, roughly 50, in the world. Japan is second lowest in terms of entrepreneurs per capita, so startup founders per capita. The only one lower is Croatia. So think about that. Japan, which is the fourth largest economy in the world, right? GDP, that is basically driven by huge manufacturing giants. It's a first world country. You go there, Tokyo is exceptionally immaculately clean, modern buildings, modern high rises, modern bullet train systems, better than anything we have in the West. And yet they have basically no entrepreneurs, no startup founders. There's no venture capital or angel investing, to speak of. And in the broader equity market too, nobody invests in stocks because there's been no growth for 34 years. Right? Why would you invest in something that goes nowhere? They just invest in US stocks. And that kind of environment is, I call it like a sanitization, right, procedure. It's almost like ripping out all the soul and the vitality and the youth and creativity of especially the young men, which are the founders and the people who are going out and taking risks and doing big things, right? It sanitizes them to the point that they're even unable to take those risks or do anything because the infrastructure just isn't there for them to do it. If they want to do anything big, they have to move out of Japan. They have to leave.
So you're saying in a lot of ways, in a monetary policy sense, in a cultural sense, Japan is a canary in a coal mine for us. They're relative to us in the West. They're further down this path. So I wonder what you think we could learn from them. Let's say if we were like, okay, this is where they're going, what's happened to their young men, what's happened culturally. If you were, let's say, I don't know, president of the United States or whatever, right? Like, what things would you try to do to pull us from the path? Like, what are they doing? What have they gotten wrong? And what would you try to shift so that we don't have to go as far down that path as they have?
So one of the biggest things that you need to change is this idea that busts are bad, right? That the credit bust, that the deflation is a bad thing. Hayek said it best, right? The credit boom lays the seeds for the bust. And that means that the bust is also necessary for the boom to happen in the first place, because the bust gets rid of the unnecessary projects, right? The vanity stuff, the NFTs, right? The rampant speculation on, like JPEGs of rocks, right? All this BS, right? Pardon my language, needs to be flushed out every once in a while. And Japan never allowed that to happen. And as a result, there was a study done by Bank of America that estimated that 23% of the companies on the Nikkei are zombie companies, meaning they're only surviving by 0% debt financing that's been just being rolled forward forever. So they would have collapsed back in the late 90s, early 90s. And because of 0% rates for 34 years, they just kept rolling it forward and rolling it forward and rolling it forward and rolling it forward and never actually turning the lights off and sending everyone home. And so all those people are working in unproductive jobs, doing unproductive things. And the people who made those loans and the people who run the company are too ashamed to admit that their company doesn't really do anything productive anymore. So they never call in the loan. They never declare bankruptcy. They never just let it collapse. And so, you know,
so they're just in the business of rolling debt
yeah,
over.
just rolling debt over. So it's extremely financialized. So what I would do if I was, you know, in the West is to prevent that. You need to let businesses fail. You need to let things collapse. You need to let, you know, when Silicon Valley Bank has gone, you know, too over its skis on treasury bond purchases and now is in the hole for $80 billion, you need to let them die. And then those depositors will lose money. And then you tell people, be careful. Audit your bank. Make sure you're not just investing in whatever, right? If Anthropic wants all these tax credits or government handouts, you tell them no. You have to survive as your own company. You're a business now. Go find customers. Go create revenue. If you can't create enough revenue to offset all your expenses, you lose. That's capitalism. You know, sorry. This is just how the game works. You can't win if you don't allow people to lose. And that philosophy, the antithesis of that philosophy is what Japan's done for 30 years. Because nobody ever truly loses, everybody loses, and there's no growth and no escape from then on out. So what I would do is I would allow things to fail. Obviously, a ban on 0% rates, a ban on QE, those things would be hugely possible. But it's also a mentality shift, right? Like, how can we allow people to take risk and tell them that it's okay if it fails and their business goes under?
Does it seem to you like we're past the point of no return when it comes to that? When I think of in terms of where we would see big collapses, we looked at 2008, the housing market collapse. Eventually it seemed like it would be systemic, like total systemic collapse if we didn't prop that up. We have all these indicators flashing the exact same things that they're flashing in 2008, in many ways worse in 2026 in terms of the housing market. So we're primed for exactly something like that to happen, yet it seems to me that 2008 proved that they weren't willing to let that happen, and I think that stems from the fact that we would basically have, you know, a contagion event that ultimately ends with like the total collapse of global debt markets. So does it seem like there's a possibility for that to actually happen, or do you think we're pretty guaranteed to go down the continue printing, follow the same sort of path that Japan has taken?
I mean, obviously, we're going to go down the continue printing, kick the can down the road path. And the reason why is actually very simple. The people in control of the system, the people who actually make the decisions, have the most to lose from the system dying, from the system failing, right? They're multimillionaires, billionaires, hedge fund managers. They profit from cantillon effects, you know? Besant and Warsh both were former hedge fund managers. And Treasury Secretary Mnuchin under Trump also was a former hedge fund manager. All these people make money buying and selling, arbitraging, you know, front-running retail investors, front-running other people, profiting from cantillon effects. That's all they do. And so if you're asking somebody who's paid to continue to keep the system alive, to turn the system off or to let it fail, at least in some large part, like you said, like let's say equity markets collapse by 80%, you know, real estate goes down by 80%, bonds basically all go to zero, all the pensions are wiped out, we all start at ground zero. Well, the person who lost, you know, let's say 500K of equity in their home, that hurts. The person who lost 500 million, that's something, and they're already 65, that they spent their whole life, you know, making this money either morally or immorally. They can't ever get that money and power back, right? So they have the most to lose. They do not want to lose any of it. And so they're going to
And they're in the driver's seat.
They're in the driver's seat. They're going to continue to perpetuate the system. And this is the unfortunate truth. Like I wish things were different, but this is just how it is. And so they're going to keep kicking the can down the road. And they're going to do whatever they can, including stealth QE, which I've written about on my Substack, in order to achieve that.
What do you think are the closest historical analogs to this present moment that we're looking at, and what happened in those situations?
I mean, obviously, I think one of the biggest historical analogs for the U.S. where we are now is the 1920s, right?
Okay.
You look at the booming in radio stocks and railroad stocks in the early 1920s, and it very closely matches, right, what happens now. You know, there's that famous Jesse Livermore saying. Jesse Livermore was a stock trader in the 1920s, became a multimillionaire. He said, you know, when the shoeshine boy knows about your stock or knows about a stock, it's too late to get in. And that was because on Wall Street, like by the time the common people knew about a stock popping off, all the gains had already been made, all the smart money was out, and only the dumb money that kept chasing it. And if you look at what's happening with AI stocks, you look at what's happening with semiconductors, you look at what's happening with, you know, high tech, same story today. The one difference is this time it's an everything bubble that's funded and financed by the Federal Reserve, and the Federal Reserve needs to keep the illusion alive. And so if there is a crash, the Fed will just print money to bring it back up, right? That's what we saw during COVID. The market collapsed 30%. The Fed opens the floodgates, prints $120 billion a month of QE, changes the SLR ratio, the bank capital ratios to 0, so they have to hold no reserves against anything, and just started printing money like mad, brought interest rates to 0 as well. And so all of that floods the system, the stock market goes back up. And if this happens again, if NVIDIA collapses, if any of these, you know, AI tech companies collapse, they'll just print the money needed because they need to perpetuate the current system in order to maintain their power.
So that sort of plays into a lot of our underlying thesis around Bitcoin, right? In terms of that, if that is guaranteed, that's how so many of us lunatics are so damn sure about this, that we're, you know, all in or close to all in or whatever, right? And that seems to be guaranteed to me, although I'm always trying to look for gaps in, could it go, you know, is there a potential outcome that I could see that I haven't anticipated, essentially. But since that seems pretty guaranteed to me, and then since it seems like there's that problem replicated in many ways on another level, you have the dollar that's replicated on the yen, essentially. Thinking of Metaplanet, I wonder what you think of that company. Do you think that they're exceptionally positioned in terms of building a Bitcoin treasury because they kind of have that, you know, that edge built on top of an edge? I wonder if you've been paying much attention to them and what you think of them moving forward.
Yeah, of course. The documentary we made was sponsored by Metaplanet, right?
Oh, very cool.
And the one that's on my channel is not a Metaplanet documentary, it's my own, but Julian Figueroa of Exit Manual will, I believe in September, be releasing the doc. Has been delayed a lot. There's been a lot of, you know, things changing in Japan, so they had to update stuff, and editors have been moving around. But yeah, Metaplanet is one of the few treasury companies I think is pretty well positioned because they're the only publicly traded Japanese Bitcoin treasury company. The problem with treasury companies, in general, in my opinion, is that too many of them focus more on acquiring Bitcoin than they do on their own fundamental business. And if you want to own Bitcoin, the best way to do that is just to own Bitcoin, just to buy some, put it in cold storage, right? Take it off the exchange, and
Be productive, store your excess economic energy.
exactly. Like I put out a tweet that said, I was like, radical treasury company idea, create goods and services, sell them for more than cost you to provide them. Use some of that profits to buy Bitcoin, repeat. Like that's the actual genuine treasury strategy, not issuing, infinite amounts of converts, infinite amounts of equity, financial engineering. All that stuff will work in the short run. But if your company is just a Bitcoin holding vehicle, then people can just buy Bitcoin instead. Because the likelihood that your company will outperform Bitcoin in the long term is basically zero.
And that's a dangerous game. That's a dangerous dance. You have some of the best in the world doing that dance right now, looking at strategy and stretch. And, it looks to me like they're pretty out of the woods this cycle. But they're playing a similar game that a lot of the central banks are playing. yeah, it's just a dangerous game, is all that is, right? And they're playing that similar game in terms of like, okay, we're having this, the values are dumping here, we need to increase our rates, but there's a dangerous dance in that, and so I think there will be a few people who do it exceptionally well and come out on the other side, and they're like, we crushed it. I think there's a lot of people who would be a lot better off, a lot of companies doing exactly what you're saying, being productive, storing their excess economic energy, and I think eventually we'll end up in a place where Mark Moss, co-host of the show, he always talks about when he was, back in like 97, maybe 99 or something. He was like, I was always talking to these people about internet companies. I was buying internet stocks, and now every company's an internet company. And I think what you're saying will be like the end game of this, where it's just like you're just a business that stores your excess economic energy in Bitcoin, and then you're not a Bitcoin treasury company. You're just everybody, using the money that everybody uses.
Well, it's that phrase from The Incredibles, right? When Syndrome, the bad guy, was revealing his plan. He's like, if everyone's a super, then no one is, right? If everyone's a Bitcoin treasury company, then no one is. And the irony of the Bitcoin treasury strategy is that it is very effective for the first movers, but as it proliferates, as more and more people copy it, it becomes less effective. And it actually becomes more of like a Trojan horse to, inject Bitcoin into companies' balance sheets, rather than to just pump one specific company's stock. And actually, that's better for the ecosystem. It's better for Bitcoin as a whole. That's what we actually want to see. But it means that this Bitcoin treasury thing is not a free money printer forever. It's not an infinite, money glitch. It will work for a while. The premium above NAV will compress, eventually go to 1, and you won't get any excess return from holding any of these stocks, in my opinion. Which is why I've warned people, like, hey guys, if you want to trade these things, go for it, do it, go have fun. I traded MSTR options back in November 2024. I made a killing. It was fun.
They're getting tempting right now. I tell you what.
I believe it, man. I believe it. And I think it's actually a good play on leverage Bitcoin, but like for long-term holdings, when you're thinking about like your portfolio, your life savings, just buy Bitcoin. It's an easier, simpler version of the trade, and there's way less counterparty risk.
Yeah. And you don't have to, just even, I've been eyeing some of those, some MicroStrategy options. I was even trying to figure out where could I buy, Metaplanet options, but you have to weigh the stress cost of it as well, right? If you're ever getting into leverage games, if you're ever getting into buying options or whatever, it's like, okay, maybe even if your thesis does play out, and you end up with more dollars, more Bitcoin, whatever, but you were like super stressed out for 2 years. Was it worth it? You gotta weigh those intangibles in that as well.
Yeah, exactly. There's like a portion of your portfolio that can be for fun, but my rule is that if you can't sleep at night, it's too much. And so you don't want to sacrifice your health, your longevity. I've never known a trader that has made a lot of money that was consistently stressed and like, really anxious about their position. There's always a comfortable, like, moderate position that they knew had asymmetric upside. It does really well. They cash out, they feel good, right? And hindsight's always 2020. You always could have put in more Bitcoin, more into Bitcoin in 2020 at 5,000 a coin. We could have all bought Nvidia at, $30 a share or whatever it was before it skyrocketed and split like 50 times. But that's not the world we live in. So just, be prudent, be careful. And Bitcoin, in the long run, obviously is going to go much higher. And this yen scenario is a perfect example. You look at the price of Bitcoin denominated in yen. That's a much more bullish chart than Bitcoin denominated in dollars. Like the drawdowns for the last few cycles are much lower in yen terms, and then the cycle highs are much higher, because the Japanese obviously are trying to get out of their currency. The problem is there's a very high unrealized tax gain on Bitcoin in Japan, so it's hard for Japanese to own it. But if that law changes, or especially if the currency continues to devalue, even a 50% or 55% unrealized capital gains tax on Bitcoin won't be enough to deter them from buying it. And that will just drive more and more of this excess liquidity that they've built up over generations into Bitcoin, driving up the price and obviously increasing the adoption in Asia.
Do you ever think much about the fact that the creator of Bitcoin's name was a Japanese name, Satoshi Nakamoto. Do you think there's any like important relevance to this? Do you think that they saw the canary in the coal mine in terms of Japan, that there was any, it seems that they were like a native English speaker from my review of the emails that we assume sent and those sorts of things. But yeah, do you ever think much about that or think there's any important correlation there?
It's hard to say. I mean, you know, part of me wants to say yes, that, you know, Satoshi saw that Japan was the canary in the coal mine. It was the, you know, monetary experiment proving ground. Like naming it a Japanese name is like the perfect, like, screw you to the central bankers. Because nowhere have the central bankers run more amok than in Japan, right? Like we said, 0% interest rates in 1999, QE in March 2001, basically suppressing growth, suppressing volatility, suppressing any sort of, you know, debt default for 34 years, zombifying the entire economy, you know, emasculating millions of young men, not you know, allowing them to find jobs or create businesses or do anything, which just destroys your, you know, future generations. All of that points to the fact that he could have known all this. The other idea is that, you know, he just simply wanted a name that wouldn't tie back to him. And as you're right, like the emails I've read, it looks like he's a native English speaker, but also British in terms of his accent. The way he spells certain words, like color, is the proper British spelling. So if he was British and he wants to throw people off as to who he is, he would name himself a Japanese.
Or maybe from a British colony or something
Yeah,
like that.
potentially.
So, you know, people
Potentially just wants to throw people off. So it's hard to know exactly the intention behind it. Either way, Bitcoin's still the same, and it's still an option to, you know, opt out of the fiat system.
Yeah, you know, so I find speculating about Satoshi's identities, you know, somewhat fun to do in private circles, but at other times I feel like it's sort of done in bad taste publicly, because there was clearly this desire for anonymity, and if you are like grateful for the gift of Bitcoin to many people, you know, to humanity, then maybe it's maybe you're better off not speculating. But it's fun sometimes. Sometimes I wonder, I pick up some patterns and go, maybe it's this guy, maybe it's that guy, who knows?
Well, I can tell you, I don't think it's Craig Wright.
I can tell you, I don't think it's Craig Wright. That
Yeah.
sounds right.
Yeah,
I'm with
yeah.
you there.
But the beauty of Bitcoin, one of the things I love about this space, is that it honestly doesn't matter who it is. It doesn't matter if it was a group of people. It doesn't matter if it was 4 guys in a basement. It doesn't matter if it was one lone genius. It doesn't matter even if it was Hal Finney, right? Just sending emails to himself. Doesn't matter, because the virus has been released, right? The anti-fiat virus has been put out into the wild. The code is open source, right? Everyone can run it. Everyone can audit it. Everyone can check the blockchain and see who has made transactions, when they settled, how they settled, how many confirmations they are. It's all public, right? It's the most auditable financial system in the history of the world, which is pretty extraordinary. So that kind of a cat can't be put back in the bag. And so even if Satoshi's still alive today, even if he sells his coins, even if he's dead, right? If it was Hal Finney and now obviously he passed away from, was it ALS or Lou Gehrig's disease in 2014, you know, it's over, right? It doesn't matter. The creation of Bitcoin has already been done, and that can't be, you know, rolled back. So I think what's best for us as Bitcoiners is to focus on what do we do moving forward, right? How do we increase adoption? How do we increase education and get people to, you know, understand the problems of our fiat system? And nowhere are they more prevalent than in Japan.
What does adoption look like on the grounds? You were talking about how in Japan, from your time you spent there, like I know you spent some time in South America. You know, El Salvador is kind of one of the leaders in terms of this, but there's been mixed responses in terms of some people get really into it, right? But some people just don't have the time. I know, yeah, you were talking about the capital gains rates on Bitcoin changing there. When you were over there, is it similar to the West and the US? Is there more interest? What are you seeing?
So in like 2013, I believe, Japan actually legalized cryptocurrency for payments, including Bitcoin. So Bitcoin's actually been an approved method of payment for most merchants in Japan since 2013. the problem is adoption still remains pretty low, right? And again, that was because up until 2022, 2023, the yen basically was pegged at 100 to the dollar, and it fluctuated only by like 10 or 15% every decade. So it really didn't go anywhere. And because
There's
prices,
a chart I saw this morning. I'll have my editor toss it up here, but it's been on an exponential since then. It was pretty stable for quite some time, and then it's just ripping since.
well, yeah, because again, 2022, look at March of 2022, that's when the Fed starts the hiking cycle, the fastest hiking cycle since Volcker. Japan was pegged at 0, right? So what happens when Japan's at 0 and the Fed's hiking 50 bips every single meeting for, 8 meetings straight? Well, you get a 400, 500 basis point differential in interest rates. And the other thing is that because Japan hadn't moved rates in so long, that also cuts out the volatility on the funding leg, right? Because as a carry trader, you're borrowing in yen, but you're also worried about like the cost of borrowing going up. Well, in Japan, the cost of borrowing hadn't gone up for, again, 34 years since 1998, 99. So what do? You lever up as much as you can. And that's exactly what happened. The carry trade, ballooned to trillions and trillions of dollars in 2022 and just started putting massive amounts of pressure on the currency. And, until you resolve that differential in interest rates between the US and Japan, that story doesn't go away. And like we said, it's very hard to lower it from the Japan side, because to lower that spread from the Japan side requires hikes. They've already hiked to the highest since like 1995 at 1%, right? An astounding 1%. And that hasn't really put enough of a dent in the market to impact anything. And the way to cut it from the other side, right? Oh, and hiking further from there would cause interest rates to blow out, interest expense to blow out across Japan, both in the public sector and in the private sector, by the way, because the private sector is at 120% debt to GDP. So very high private sector debt as well. If you go to on the other side of the ocean, right, the US, they have to lower rates. Well, the May CPI was 4.2 and the June just came in at 3.5, both hot inflation readings. We just had a hold at the last FOMC with 3 FOMC governors dissenting to hike, not to cut.
Right.
So
Right.
Warsh is, running a new Fed that is basically wanting to hike more, not cut because of inflationary pressure from the war. Japan can't hike, so how do you lower that gap? You don't. So the problem, you can't resolve it. It's an unfixable problem. And so that will just cause USD/JPY to continue to devalue and to test the limits of the BOJ, every few months until something meaningfully changes.
What assets do you think? So we're thinking maybe $2 to $4 trillion are wrapped up in the yen carry trade. Wrapped up where? Like what assets do you think this borrowed money are mainly flowing into? And then assuming there was an unwind, like where do we think we would see that capital flow back out of?
U.S. equities and U.S. government bonds are the main ones, but also U.S. corporate bonds, and then foreign government bonds. So British gilts, French BEGs, German bunds, Italian bonds. Because again, Japan, in a rate of 0%, 0% interest yield, anything looks great. Anything looks good. When your funding cost is nothing, or your return that you could get from lending is nothing, a 4% yield in France is amazing. So the Japanese went out and bought debt all around the world. And as a matter of fact, they're basically the largest lender to every single country in the G7. And I think the only exception is Italy, but they're like the second or third largest lender. Like they're largest for the US, for Canada, for England, for France, for Germany. They're a huge lender. And so an unwind of the carry trade means a selling of all those assets. And we obviously already have a template for this. August 5th of 2024. That's when the day after that is when I wrote that thread that got 2.5 million views. That day, or leading up to that day, Japan had basically done an emergency rate hike, right? And the Fed had a very, very dovish meeting and promised to, bring down rates, which would lower that spread that we talked about, that funds that carry trade. Carry traders started to get worried, and within 24 hours, the Nikkei collapsed by 12% because carry traders sold Japanese denominated assets to raise yen, to pay off yen loans, and then the Nasdaq and S&P both fell like 4 or 5% intraday, and kept falling for a couple days afterwards, slightly, before they rebounded and came back. So total move was several $1 trillion in market cap lost across multiple indices, and that means that, like, if this trade were to unwind in size over long periods of time, U.S. equities especially, but also U.S. corporate bonds and U.S. government bonds would be really hard hit, because those have basically relied on the yen carry trade for a large position of their funding, of the purchasing for the last, let's say, 20 years.
Mm-hmm. And the government bonds piece of that brings in that's where the nothing stops the strain argument comes from, right? Because if there's massive selling pressure there, the buyer becomes the Fed. The buyer becomes the United States government printing a bunch of money to cover that, so the whole thing doesn't collapse. So doesn't seem like there's many ways out of this. It seems like there's one expected way out of this.
Exactly. And that last thing you brought up is also exactly why the Fed has been so keen to help Japan. I mean, Besant said that in that famous Sunday tweet. He said, "This is just what allies do for each other." No, it's not.
Mm-hmm.
Spending $5 to $10 billion just to help out a friend, that's crazy. That's not something you just do for anybody. That's something you do when you're scared that the Japanese will dump their treasury holdings to raise dollars, and that will spike U.S. Treasury yields by, let's say 1 to 2% at a minimum. That kind of a terror is enough to make the Treasury and the Fed move. And to maintain the stability of the bond market is basically like their unspoken priority, right? That's their hidden mandate, is to keep the system running, keep the auctions flowing, keep the cash flowing into the government coffers so that they can continue to operate. And Japan selling that amount of treasuries, especially if it was, on a low liquidity day, would be disastrous for the U.S. So as a result, that's why we opened the FEMA repo facility. That's why we did the $5 to $10 billion of euros that we sold to buy yen, right? That's why they've pledged to potentially even expand and upgrade the facility, upscale it, so that they can do more and more, FEMA repo transactions, like repo loans to Japan, to continually lend them more and more cash so they can just keep bailing themselves out. All those are just indications that the U.S. itself is also getting desperate to help Japan, because they're worried about what happens if they don't.
So what are you looking out for, let's say, in the next 6 to 12 months? What things are you looking for / expecting from the Bank of Japan and the U.S. in terms of continued intervention? And then first that, and then maybe after that, like, how is that affecting your personal investing strategies for the next, let's say 6 to 12 month range, and maybe with a specific attention put towards Bitcoin strategies as well?
Sure, absolutely. So next 6 to 12 months for the Bank of Japan, there's definitely pressure for the BOJ to continue to hike rates, mainly because of the inflationary pressures from the Iran war that are starting to bubble up in Japanese CPI, which has now been above 2% for, like, I think 52 consecutive months or something like that. It's like the longest time within, the last, again, 35 years that they've had high inflation for a consistent period of time. There's expectation that they will start to hike meaningfully again, and try to do so in a way that they can hike and then bring it back down before the carry trade really starts to unwind it, to hurt U.S. assets, and before the interest expense problem emerges, right? Because hiking rates to, let's say, 2% for 1 or 2 meetings for a quarter or two, and then bringing them back down is one thing. Hiking them there and keeping them there and letting more and more of the debt revalue at that rate is really, really unsustainable. That's probably most likely for Japan, maybe 1 or 2 more rate hikes, and then trying to keep bring it down. What they're really trying to do is they're trying to wait out the U.S. cutting cycle. They know that if the U.S. really cuts meaningfully and starts easing meaningfully, that flood of dollar liquidity and that cheapening of interest rates in the U.S. will alleviate a lot of the pressure. Not all of it, obviously, but some of it. And that will help, because right now they've been running into a worsening situation where more and more yen buybacks, more and more of these yen interventions have had less and less of an effect every single time. The effectiveness of the interventions right now in 2026 is about half as much as it was back in 2024. And so that just should give you an idea of the scale. Like $20 or $40 billion back then could move you, from 160 to 153. And now that same amount of money moves you to 157. So it moves you half as far. Instead of 3 yen, or instead of 7 yen drop, it's a 3 yen drop.
It's so funny how there's just these currency games that have been played for so long. Swap out one currency with another, swap out, we're going to print more, we're going to pull more out of circulation, blah, blah, blah. And it's so fascinating to watch this economic constant be introduced through it all, which is Bitcoin, which is just like, there's no, it's playing in this game, but there's no supply fluctuations. So there is this this is where Bitcoin has come to this source of truth, this economic truth in that game. It's so funny because it's just such a convoluted game to hear you talk about, like 2022, 24, 26. This is what they're doing. And all throughout this time, you have this constant predictable variable in there, which will be really interesting to watch as things get more and more chaotic as well.
Yeah, absolutely. No, that's definitely true. And the currency fluctuations are just crazy because they're so arbitrary, right? There's no real reason why it should be 150 or 160. It's just the amount of yen they printed. And if they print more, it'll be 200. If they print more, it'll be 400, right? It's just the nature of how things are. But for me, like directional trades, I've been short USD JPY for 3 years now, basically, which has been a great trade. Obviously, like borrowing yen and buying dollars has been a really good idea. And especially when your funding costs are near zero. You can do so on Interactive Brokers, actually, by setting up a foreign exchange account. And actually, I have a PDF in my link tree, I think, that's like $70 that people can. It teaches you how to do the yen carry trade yourself as a retail investor in the US or in the EU or Canada. So people want to learn how to do that. You can go check that out. But directionally, obviously, short USD JPY, but long US equities and, I would say like gold, Bitcoin, any debasement trades. So anything that would benefit from the carry trade continuing to be put on, I keep those in my portfolio. The reason why is, again, I don't believe the carry trade unwind can happen without major things changing systemically in both Japan and the US. And since that's not changing anytime soon, since the Fed's not cutting tomorrow, and since the BOJ is not hiking to 3.5% tomorrow, I'm going to keep the trade on. I'm going to keep holding US equities, US tech stocks, and US ETFs, as well as majority of my money, which is in Bitcoin.
Do you have any strong expectations for Warsh and the Fed for, let's say, the remainder of this year up until the midterms, which are pretty soon, actually, and then maybe the remainder of the Trump administration?
I think Warsh is going, because, Warsh has a difficult problem, right? Which is he's trying to do this balancing act of lowering interest rates and not increasing the balance sheet, which normally that's functionally impossible, right? Easing means a lowering of interest rates and an increase in the balance sheet, and tightening means a hiring of interest rates, right? Or an increase in interest rates and a lowering of the balance sheet. So he's trying to do two combating monetary, halves of the same of a different monetary policies at the same time, which is very, very hard to do. Now, can you do it temporarily? Sure, right? You can set the policy rate lower and lower, and then you can, continue to acquire bonds or do reserve management purchases, right? Which is what they've been doing since December 2025. But long term, it's untenable. Long term, I don't think you can do it. But what Warsh's main goal is obviously to maintain systemic stability, keep markets going up, but also keep inflation at bay. And so as a result, I think what he's going to do is keep the reserve management purchases, so the RMPs, keep buying, $10-20 billion a month, or increasing the balance sheet by that much, buying treasury bonds, doing, helping to basically offlay, especially the longer tenor bonds. And then he's also going to most likely hold rates for, I would say, maybe the next meeting or two. I mean, even with these dissensions hiking rates, he was obviously a stay. Unless inflation gets really high, I don't really see him hiking, especially with how high our interest expense is already. I think he's probably going to hold rates for a few meetings and then finally try to bring it down once inflation has cooled off. But I think the main worry that the Trump admin has, and the other people who are gearing up for these midterm elections, is that you need to keep the American consumer happy, and the way you do that is by keeping energy and food prices low, and that's hard to do when you're trying to fight a war in the Middle East, next to the largest, basically oil and gas choke point, trade choke point in the world. So you can't have your cake and eat it too. And so the next best thing to do is try to stem the bleeding from the other side, which is to keep rates where they are, right? Keep them artificially high just because you want to stem inflation.
Yeah, that makes sense. Yeah, it doesn't seem like we're going to have any real meaningful progress on the inflation front until we can figure out how to wrap up this conflict in Iran. And that's like, hopefully sooner rather than later, man. It's been going on plenty long, if you ask me. I wonder.
It's ending and it's restarting, man. It's like, it's ridiculous. It's like,
yeah, it's happened like 25 times.
It's like Groundhog
30
Day.
times.
It's like the war's over. No, it's not. We're starting it again. Oh wait, no, we got a peace deal. No, it's not. And the stock market has just been a roller coaster since then.
Yeah, it's a total boy who cried wolf sort of situation now, where you hear it. I hear it now, and it's just like nobody believes it. When it finally ends, it's not going to settle in for months because everyone's going to be waiting for it to start again, I feel like. Is there any, you sent me some great articles I was looking over before we started in your Substack. Is there any key points from any of those that we haven't touched on that you'd like to refer to? Anything we missed?
I think we hit a lot of the main ones. I mean, yeah, I would just say, like, Japan is truly, like, that meme that Japan is the canary in the coal mine is true in many more ways than people realize. And my concern is that that sort of financial repression, that sort of like inability to allow actual busts to take place and deflation to take place and the system to reset is what is going to be rolled out in the West in the next 20, 30 years, right? There was already proposals by the ECB and by others to basically create a digital euro and peg everyone's interest rate at 0 or even negative rates, so you're forced to spend it, and then that continues to circulate it in the economy. All these things will be tried in Japan first before they're rolled out, and so just keep paying attention to it, and yeah, keep being aware that this is unfortunately this is like our harbinger, right? Our canary. This is like the future of the US. If we don't change things, we will face all the same problems that Japan is facing now.
Yeah, well, we'll link your X account. We'll link your Substack underneath. You've been a great resource for me, just staying on the loop on this. It's been a constant, important variable in global markets from the past couple of years since you really started focusing on it. And yeah, I'll be keeping an eye on that. It's good to have an expert like you just to be able to keep me in the loop on it and everything. So yeah, appreciate that. Where can people find you besides Substack, X? Is there anything else you'd like to refer people to so they can stay in touch with your work?
Of course, my YouTube actually. So I had a YouTube channel for a few years, didn't really know YouTube strategy, didn't understand how to do it. November 2025 rolled around and I deleted my old channel, restarted from the ground up, brand new YouTube videos, macro breakdowns, like market, basically like market analysis. And actually recently we've decided to full-time pivot to Japan only content. So if you're interested in Japan macro, if you're interested in what the BOJ is doing, what their forecast is for the next meeting, what's going to happen with the yen, are they going to do more yen interventions? I want to be covering all of that on my YouTube channel, which is called Peruvian Bull. And my documentary about the yen is there as well. It's called Something Big Just Broke in Japan. You can search that up on YouTube and you'll find me.
Awesome. And we'll send you a collab link as well, so you can just click right around there and you'll be able to subscribe.
Sweet.
Thanks for coming on, man. This is super cool. Yeah, I appreciate your input, and it's always good to chat.
Of course. Thanks for having me, Jake. I really appreciate it.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Happy Saturday, everybody. I really want to talk about Metaplanet today because I think this is pretty much the GOAT 10-year hold opportunity that I have ever come across. I did my first deep dive into the BitBond model this morning, and when I'm crunching the numbers over what this short fiat, long Bitcoin strategy will look like, it is starting to blow my mind. I really do believe that the upside opportunity for Metaplanet in Japan is absolutely insanely ridiculous. It's obscene, and it's very misunderstood. Right now, the company is valued at close to 80% of their Bitcoin holdings. I think that is nonsensical. I am definitely buying more Metaplanet after running the numbers this weekend, and I'm going to explain for you guys today why and how incredible this BitBond model is for the company and for the common shareholders. The headline sounds very simple. You issue yen bonds, and then you buy Bitcoin, you pay your fixed coupon, and then you let the common shareholders get that upside above the financing cost over the years in the future. And then obviously we have the deeper story of Metaplanet building out this capital markets machine, which is the short fiat, long Bitcoin strategy, building the pipes, building the credit plumbing, and arguably the capital market in the world that needs it the most. Metaplanet now is combining their large Bitcoin treasury with a securities platform distributing their own debt. So if that pipe scales Japanese demand for their predictable yen income, they can finance a growing pool of scarce digital property for the Japanese hotel company. If you guys could do me a huge favor, like the video on YouTube and subscribe to the channel. That way you can support me spread the orange gospel of Bitcoin to the masses. You guys are gonna love the video today because the math is absurdly bullish. And if you guys are bullish on Bitcoin like I am, if you think Bitcoin is severely discounted today and the governments of the world will continue to print money hand over fist, what better time to lock in a 5-year Bitcoin position with full principal protection? That's what my friends at Solana are building, buying Bitcoin right now with full principal protection, being exposed to tremendous upside over the next 5 years while your investment is secured by a title insured recorded lien on US real estate. Go to solana.io/capital right now to get started. I think you guys will really like this model. And I do want to thank the Bitcoin Way for sponsoring the Bitcoin Wizard. These guys are absolutely awesome elite Bitcoiners. You must secure your bloodline, Bitcoin in 100% self-custody. And you have to do it safely, and my friends at the Bitcoin Way are standing by to help you be a sovereign Bitcoiner. And right now, it's more important than ever, especially after this latest cold card hack fiasco. My friends at the Bitcoin Way lost 0 client funds throughout this entire crisis. This is the safe way to custody your Bitcoin, eliminate counterparty risk, run a node, become a sovereign Bitcoiner, be your own bank, using only the best open source tools. You can scan this QR code right here on the screen or go to thebitcoinway.com/Adam and they will schedule you a free introductory call. That's right, 100% free. I'm not asking you, kids. I'm telling you, go to thebitcoinway.com/Adam. You will love it. Daddy Wizard promises you. So let's talk about the inaugural Bit Bond that we saw. $1.3 million. That is the yen conversion price to US dollars. 200 million yen, $1.3 million. Obviously, pretty small size bond, all things considered. Now, a glance at that just invites a shrug, but it misses the entire point. This is a bit of a proof of concept. A railroad test starts with one train rather than the entire national timetable. The valuable thing here is this rail. What we're going to be getting into is the model. Metaplanet can issue ordinary yen-denominated bonds through its very own security subsidiary. They can pay investors between 4 to 4.3%, so we are going to use the midpoint at 4.15% in our modeling today. So the yen savings are going to enter this model, obviously, and then of course the bonds leave. Bitcoin lands on the balance sheet, and then the common equity owns that residual on the balance sheet after the bond obligation, and that residual grows over time. Now, this is the cool part. Let's say that there's a maturity of 3 years here. What is Metaplanet going to do? They are going to create a repeating financing rhythm with this 3-year maturity. Each maturity can just roll into a fresh bond, subject to market demand and pricing, of course. But what if you could just continually roll these bonds over 3 years? You borrow money for 3 years at 4% to buy Bitcoin that's probably going up a lot more than 4%. And then obviously you issue more bonds after 3 years, you pay off the old one, and you keep the thing rolling. And this structure is the beauty of the beast because it's dividing the economics between two investor groups with very different appetites. Obviously, there are hyper giga growth investors like myself, and then you have the income investors who want a steady stream of income. The common shareholders receive the variable remainder after the interest and the principal, of course. This remainder holds the convexity. So think of the bond as a ruler. The obligation grows at that 4.15% over time, and Bitcoin is essentially the rubber bands that can stretch far beyond the ruler because the contractual liability keeps following its fixed schedule path going up and to the right over time, while Bitcoin goes up more. So we have Bitcoin rising against an extremely soft currency in the Japanese yen, so the asset value above the debt that belongs to the common equity, and that creates a very clean exchange because the yield investors are getting the certainty that they prefer very low volatility income from a Bitcoin-denominated balance sheet, and the equity owners, we are getting an amplified expression of Bitcoin because that is coming from the residual between the Bitcoin amplification and the fixed fiat financing. So one side, they get their polite little coupon, and then the people that are buying Metaplanet common stock, well, let's just say that I want to own monetary history. So let's get down to the actual mathematical engine because it's actually going to blow your mind about how much better this model is than their old model of just selling common shares at a premium. So here is the engine in just a $1 example, okay? It's very simple. Metaplanet borrows $1 equivalent at 4.15%, and then they buy $1 of Bitcoin. That's the model, and then you finance, and then you roll the interest for 3 years. The debt obligation that Metaplanet owes becomes $1.13. Now, let's just assume that Bitcoin doubles over this period. So, by August of 2029, Bitcoin only goes back to its all-time high. I don't think that's too crazy to think. The asset is now worth $2 instead of $1 because Bitcoin doubled, so that's really cool. And then you just subtract the $1.13 obligation, and then the common shareholders, they retain 87 cents of incremental equity. This example is selling 0 common shares, kids. This is the financing model of the Bit bonds. They are going to rent fiat capital at a fixed rate and own the full upside of the Bitcoin purchased with it. And every single dollar that is borrowed creates a tiny contest between two curves on a chart. The debt curve starts at 1 and it crawls toward only 1.13, But then you have a bigger curve that's starting at 1 and it grows to $2 when Bitcoin doubles. And then the common equity just keeps the distance between those two curves over time. And we can translate this bond into the language that you guys already understand as Bitcoin Treasury investors, the term of MNAV. After 3 years, the company owns $2 of Bitcoin against a $1.13 obligation. If you divide 2 by 1.13, you get a 1.77x. So economically, what does this resemble? It resembles raising common equity at a 1.77x MNAV. This is mathematically identical. So this model would be the equivalent of issuing equity at a 1.77x MNAV. Each $1.13 of the senior claim on the balance sheet that supports $2 of Bitcoin. So this framing matters quite a lot. Remember, we know that a treasury company, what is the entire thesis? It's getting more Bitcoin per share. You are wanting more economic value backing each of your shares over time. That's the entire point of why you would want to invest in a Bitcoin treasury company over Bitcoin. I would hope, at least, having more residual value backing each share over time, and then hopefully one day your 3x MNAV price is your 1x MNAV price. But unfortunately, you guys know if the market is valuing the common stock at close to the value of their Bitcoin holdings, you can't issue shares and have it be economically accretive. And you definitely can't when you are trading close to 20% below the value of your assets. But a bond at this cost opens a separate funding lane. The company buys the asset, they preserve the common share count in this example here, and then they give Bitcoin time to outrun a 4% obligation. So if you think that Bitcoin is going to go up more than 4% per year, I think that you should probably like this model. And this is where it starts to get really fun, because we can look at a price ladder. What do I mean by that? Well, the same equation gives us a useful ladder for what happens over time here. Start with Bitcoin at $63,000 today, and we'll carry the bond obligation forward 3 years to roughly that $1.13 borrowed. If Bitcoin reaches $100,000, the purchased Bitcoin becomes $1.59. This would be like issuing common equity at a 1.41x MNAV, which obviously would make sense. You would want them to do that because that would increase your residual backing your common share. And a Bitcoin being 150,000, well, that just means that there's now an MNAV equivalent of 2.11x, and it's 2.81x when Bitcoin goes up to 200K. Fixed claims, expanding asset, growing residual backing each share. So this mechanism can only add value to the common shareholders once the Bitcoin return in yen clears the financing hurdle. But that is literally how amplification works. Amplification over Bitcoin, the senior claims staying fixed in yen, and then Bitcoin outrunning those senior claims. It's outrunning Metaplanet's cost of capital. And right now, when the equity is so cheap, like I said, 80% of the value of their Bitcoin holdings, the market seemingly ignoring the fact that they make money, they are profitable, and they're building infrastructure that will help them be more profitable. But of course, the market doesn't even want to value Metaplanet at the value of their assets, which is very strange to me. That's why I believe the opportunity is now. But if you can buy Bitcoin without expanding the common share count, and then you let Bitcoin going up and to the right over time doing the heavy lifting, not only does this allow time for the equity premium to recover, it keeps your residual that you're exposed to compounding. Previously, you had to issue those shares at a premium to increase your Bitcoin per share. This is not the case anymore. You can let the fixed yen obligations and then Bitcoin's compounding over time do the work for you, and the common shareholders still get to eat. So now this is where it gets mind-blowing. So let's look at the next 10 years, okay? This is just an illustrative example. I think that if you guys are watching the channel, you probably think there's a decent chance Bitcoin will be $1 million in 10 years. Personally, I definitely think that's a possibility. So I'm assuming that Bitcoin rises from $63,000 to $1 million. Just in this mathematical example here, that turns every dollar of Bitcoin purchased today into $15.87. That is the multiple. It's a 15 6.87x return from today to $1 million Bitcoin. So a dollar borrowed at that 4.15% and continuously rolled, what does that grow into? That grows to roughly $1.50 owed. So if you subtract that debt from the Bitcoin growing over time, the residual is $14.37. This spread that's growing here over time is the canyon that you are exposed to, my friends. The liability multiple, 1.5x, the fiat compounding is walking up a very small hill here. But the Bitcoin compounding is an absolute rocket ship, and you inherit this difference in the middle. We all think that Bitcoin will probably appreciate far faster than this 4.15%. Therefore, we get to capture that difference. Duration lets the asset curve pull away from the liability over time. And then obviously, if Metaplanet can service those small 4% coupons, I think that the math checks out. And this is the absolute sledgehammer of what this is. Low interest rates is the thesis, and this is why. You can't replicate this anywhere else. You can't borrow money at 4% in America and go buy Bitcoin. Even Strategy, the company with the most capital on the balance sheet, they can raise it 12% with STRC. But if Metaplanet can do 4%, this is what the math tells you. If you divide that $15.87 of Bitcoin by that $1.50 obligation, the financing looks economically identical to issuing equity at a 10.57x MNAV. That's correct. That's what the math checks out to. That is the number that is hiding inside of this strategy. Imagine if Metaplanet could issue their common shares at a 10.57x MNAV. The equity markets rarely hand out that luxury on command at all. And over a 10-year time horizon, that is what this financing equivalence looks like, a 10.57x MNAV. Now, if you change the inputs, the results change, obviously. If Bitcoin is less than $1 million, the math changes. If Bitcoin is more than $1 million, the math changes. At different snapshots through Bitcoin's volatile ride upward to $1 million, the financing is going to seem better sometimes, it's going to seem worse sometimes. The residual that you are exposed to economically as a common shareholder is always going to be fluctuating depending on what the Bitcoin price is at. But through this one illustrative case, it's very simple. The conclusion is viciously clear. Borrowing extremely cheap fiat before a major Bitcoin repricing, that can be far more accretive than waiting until the repricing has always happened. Borrowing fiat before a major Bitcoin repricing can be far more accretive than waiting until the repricing has already happened. And that is why the opportunity is right now when the company is not even valued at the value of their Bitcoin. The company locks in, hopefully, while Bitcoin is cheap right now, they can lock in some liabilities first, and then the scarce asset does the heavy lifting later, which is exactly why I want to be buying Metaplanet right now and not waiting for clarity when the brokerage statement says green again instead of red. So if we scale the unit economics onto Metaplanet's balance sheet, this model begins with the 43,000 Bitcoin that Metaplanet currently has. That's worth about $2.7 billion. And then let's just say that hypothetically, Metaplanet just maintains 10% balance sheet amplification. That bit is hypothetical. So let's say the gross Bitcoin assets equal about 1.1x the common equity. That would mean the opening bond issuance would be about $270.9 million. This is illustrative, but that amount would let them buy another 4,300 Bitcoin. And then if they control that 10% amplification over the next 10 years, you got to understand, as Bitcoin appreciates, the fixed claims that are those outstanding bonds, those are staying fixed. So in order to keep that 10% amplification, you need to continually issue more as Bitcoin goes up, and that takes up more of a percentage of the balance sheet. The monthly bond issuance, if they can continue to issue these things while the Japanese investors, they want their yen income, they can continually add enough Bitcoin to restore that same 10% amplification relationship instead of allowing leverage to just wander upward. They have different levers to pull now depending on whatever market conditions that the capital markets are giving them. So just under those illustrative inputs, the machine begins with that 4,300 300 Bitcoin purchase, and they keep accumulating Bitcoin as Bitcoin rises over time. Now, if they want to keep that target amplification, they would obviously continue to issue more bonds and buy more Bitcoin. In year one, the monthly issuance would be only $8 million per month. But once the 3-year rollovers begin, the issuance plus the refinancings, those would average $37 million per month. $72 million in year 6, $101 million in year 8, and $192 million in year 10. So across the decade, with that amplification target, the gross bond issuance would reach roughly $8.9 billion, including around $3.5 billion of the refinanced maturities. Now, just in that illustrative scenario, they would only end up with less than 60,000 Bitcoin over a decade, adding 16,727 Bitcoin. This is what that would look like over time as they scale up with an amplification target. They're going to scale up this infrastructure of Bit bonds. They want this durable issuance of the Bit bonds, distribution, servicing, redemption. They want to build the capital markets rail for the private placement of these bonds. And the thing is, that capability is their moat that nobody can replicate. Nobody in Japan has close to the level of Bitcoin that they do. A foreign entity even attempting this, yeah, good luck with that. So Metaplanet is combining this incredible treasury strategy, the product design, the distribution, the investor relationships, and the recurring issuance all inside of one ecosystem here. So this is the illustrative picture at $1 million Bitcoin, $59.73 billion in gross Bitcoin assets. But if you subtract that debt claim, that is $54.3 billion of shareholder residual, which would increase your NAV per share of 26.3%. And that there is the common shareholder prize that you're waiting for. You guys got to understand that compounding loves a small edge repeated for a long time, but the edge between a 4.15% cost of capital and Bitcoin's compound annual growth rate, I wouldn't call that a small edge. That is a massive edge if you just crunch the math. Metaplanet is building the credit rail that the market needs. Japanese investors, they need an income stream that allows them to outrun inflation. They're sitting on over $7 trillion in household cash and deposits. The corporate bond infrastructure almost doesn't even exist. And Metaplanet is smashing into this capital market using a Bitcoin strategy able to save the populace from total monetary destruction of their fiat currency. This is short fiat, long Bitcoin in the jurisdiction in the world that literally needs it the most. And Metaplanet is building the infrastructure to be able to exploit the weakness of the yen, the digital scarcity of Bitcoin, and the common shareholder upside is absolutely ridiculous when you realize that you only have to pay 4.15% to borrow yen. This is why I could not possibly be more bullish on Metaplanet. I think that this is such a unique opportunity that cannot be replicated anywhere else in the entire world. I am giga bullish on the Japanese hotel company. And I will continue to buy after a lot of people have exited the trade, not really understanding the long-term math. As a long-term value investor, I love this $1.38 Metaplanet share that I can go buy right now. Hopefully, I can continue to do this for a while before Bitcoin starts going back up. Because if Bitcoin goes up, you see what happens to the common equity. My name is Adam Livingston. I am the Bitcoin Wizard. Thank you so much for tuning in to today's transmission of the Orange Gospel of Bitcoin. Please do me a favor, like the video, subscribe to the channel if you have not, and leave a comment below with any content you want to see out of me. Have a very terrific day, everybody. Do not party too hard. Class dismissed. This video is sponsored by Solana, and if you are interested in gaining Bitcoin upside while keeping your principal protected, Solana may have built the most aggressively bullish product available for people who still enjoy sleeping at night. Yes, you as an investor can receive 50% or more of Bitcoin's appreciation with uncapped upside, while the structure is backed by the Bitcoin position itself and a lien on U.S. investment real estate. Basically, Sovana is putting Bitcoin in body armor. You still get the moon math, while your principal has a rental property standing behind it with a baseball bat. If you are interested, scan the QR code or use the link below. Sovana will help you every single step of the way. They will answer your questions and explain exactly how the structure works. Requesting information carries zero obligation or commitment. Go to sovana.io/capital to buy Bitcoin and MSTR with full principal protection. And you know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own, Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for Corporations, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
The European institutional investor base is massive, obviously, but also very fixed income focused. European fixed income is very much a fixed income culture. You got all the massive pension funds, all heavily weighted towards fixed income instruments. Kind of hard to get yield right now. I mean, I was in high yield credit for a long time, and high yield credit is basically very low yields these days. So I think that in itself is a big opportunity set.
Think about the scale of AI. How is AI going to use this? People just think that AI is just going to use it to pay. But what is AI? What do robots need? What do people need on a global network, a true extension of the internet? AI wants to use it for validation, authentication, accessing data, and they need to have it happen at the blink of an eye. In other words, money, which is trust, especially for agents and robots, needs to move at the speed of intelligence. You're not going to get that with Visa and MasterCard, but you're going to get that by being able to send, 1/1000th, 1/10,000th of a penny working sats with the blink of an eye to validate. And effectively, the Bitcoin address that they can validate that they have becomes the agent's agentic soul.
But again, Bitcoin can and will only ever be that safe haven in those types of environments if Bitcoin is viewed by the masses, by traders, as a currency. And unfortunately, we've kind of, as Bitcoiners, shot ourselves in the foot a little bit by calling Bitcoin digital gold a digital store of value, rather than calling it what it truly is, the most perfect form of money that humanity has ever conceived.
Is quantum computing a threat or is it overblown?
It's both.
I am fascinated by quantum computing.
I think there's definitely a lot of unknowns with quantum computing.
It is a theoretical risk on the Bitcoin network.
The big threat, in my opinion, is the discovery and unlocking of wallets that have been lost forever. Bitcoin is a scarce asset that you can make more of, but you can find more of it by unlocking these old wallets that could pose a threat to Bitcoin.
The quantum concept is What do you do with the Satoshi coins if they are not quantum resistant and they don't move? It's a really interesting philosophical debate because you could argue that if quantum computing is a real threat and it can come and crack the Satoshi coins, I mean, obviously there's a probability of having a bad actor that wants to tear down the entire ecosystem, but the game theory would suggest that there's more incentive to break the Satoshi wallet, keep the coins, and build on that into the future.
I don't know what the answer is, but I do know that there are a lot of teams working on protecting Bitcoin against it. Teams like Blockstream have a lot of PhD engineers currently working on upgrading Bitcoin to stave off those threats.
I do believe that the technology, as all technology does, will progress and get better. The Bitcoin network has the ability to upgrade and change and morph, and I think that's really the beauty of Bitcoin, is that it's distributed network of nodes. Frankly, I'm currently unconcerned by quantum.
The question is still if and not when. Still, it is important to take that question into consideration and most importantly, not add changes to the protocol with rushing into a solution in search for a problem.
There are people in the Bitcoin community that don't want to see a change to Bitcoin. They believe Bitcoin will be fine as is, and it's designed the way that Satoshi envisioned, and it would be a bastardization of what Satoshi viewed if we make a change to the Bitcoin protocol.
And my view is that Bitcoin will win. Bitcoin will actually be the best prepared for the future of what could be quantum. And you have already solutions that are being proposed by the market, and the best will win. And my view is that the best will be an optional one where people can opt in over time as they perceive a potential risk.
I do understand why people have the fear. I think it's an incredibly complex topic. We're literally talking about quantum physics, and I'm no expert, but from the people that I've listened to and the people that I trust and the research that I've done, I do not think it's an immediate threat. And if it were to become a threat, there are things that the Bitcoin network can do to protect itself.
I would say the threat is less imminent than the headlines suggest, and the work being done already to address any potential threat in the future is more robust and diversified than people think. And what I mean by that is there's lots of different work already underway that they range from changing the protocol itself or updating the signature scheme to post-quantum proof signature schemes versus, say, having contingencies and plans that would allow somebody, in case in the future they need to move or migrate to that signature scheme, they can. And so there's a lot of work being done, and the community is already discussing and debating ways that this could potentially happen, but it seems like the threat is more theoretical in nature right now. And I think people underestimate Bitcoin's resilience. Bitcoin is the most secure computer network in the world. It's decentralized. And so what that means is there's a ton of eyeballs looking at this open source code. They're maintaining it, looking for vulnerabilities, making proposals. There's a ton of discussion, and that hive mind is one of Bitcoin's biggest strengths. And that's why its uptime is 99.9%. Despite it probably being the biggest honeypot for any potential attacker to go after. So I think Bitcoin is extremely resilient, and people shouldn't underestimate it.
I think it makes for a great story. It is incredibly interesting tech. It'll continue to move forward. We saw this back there with the Y2K bug back in 1999, where the world was going to implode. Technology marches forward, and Bitcoin continues to adapt for it. And if anybody's worried about quantum breaking Bitcoin, they should be more worried. Quantum will break everything way, way before Bitcoin. And Bitcoin's already adapting to it because that's the nature of open source software and something at this kind of network scale. So it's actually going to unlock incredible possibilities. So I'm not one of these people that sees the progression of tech as dangerous. I see as we adapt to it, Bitcoin will adapt to it, already is. The discussions are great around it. And we're going to see many, many great things unfold from quantum computing.
There's multiple attack vectors for quantum on Bitcoin, but There was even just a paper that was released a couple of weeks ago where, without even having to go through a protocol upgrade, we know how Bitcoin and Bitcoin wallets and the consensus mechanism can be completely quantum proofed. So is it a threat? Yes. Are there ways to alleviate that threat such that it will not destroy the Bitcoin network? Absolutely. Do we have to come to a consensus in the Bitcoin community as to what we need to do to protect Bitcoin? Absolutely. Do I think that's going to happen tomorrow? No, but I think we have some very smart people in the community that have figured out ways to make this work, and we have a couple of years before quantum really becomes the true threat that it may be. And at the end of the day, I'm more worried about what quantum and its threat will be on the global financial system as a whole, more so than just native Bitcoin.
I'll say with no specific evidence behind this, it definitely feels like the hedge fund world is coming together directly against some of these digital asset treasury companies all at the same time right now. And you're seeing it in their prices, you're seeing it in the prices of the preferreds, in the put buying in MicroStrategy yesterday morning, into the lawsuits that seem to be very coordinated. To reframe something I said earlier, we just had this period of massive productivity growth and interest rates being pushed upward from geopolitical risks. You know, these are store value assets without productivity growth and without an interest rate, without some good engineering on top of it. So I think this has kind of been the perfect storm against these store value assets. And I find that the financial advisor space is the have and have nots with crypto. There's just a very few select groups that are willing to have over a 2% allocation of their client books. And I think I initially expected that the rest of the marketplace would, like dominoes, so okay, I'm a Morgan Stanley advisor, we just launched our own Bitcoin ETF, there's gonna be a wave of slow adoption, but I think you're gonna really have to see that next price leg up before you start seeing the FOMO from the financial advisor community that's on the sideline right now. But I think that's what can really make it exacerbated, and it seems like the ultimate bearish moment in Bitcoin right now. So knock on wood, hopefully there's not much else that can make it worse.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
Michael, since your May 5th earnings call comments, odds that Strategy sells some Bitcoin by year end have spiked from around 30% to 84%, and odds of a sell by June 30th are at 66%. Critics say stretched dividends and a narrowed MNAV premium are forcing your hand. How wrong is the market?
You know, I think we enjoy keeping everybody guessing. It definitely makes X a lot more interesting. Our view is business as usual here. We're kind of matter of fact about this. The goal of the company is to drive Bitcoin per share and to increase its Bitcoin and increase the enterprise value continuously forever. We'll make decisions about how we fund our liabilities week by week, day by day. Sometimes we make them minute by minute, to tell you the truth. We set algorithms where we're looking at what is most long-term advantageous to the company. Are we managing our credit risk? Are we creating Bitcoin per share? And are we best off to pay a liability with cash, or to pay a liability by issuing equity, or to pay a liability by issuing credit, or to pay a liability by selling Bitcoin? We've done a lot of multivariate models, and in all the models, what we find over the long term is that by far the best thing for the company is to engage in a mixture of those four instruments. Any model that we put together that's limited only to equity or only to credit or only to Bitcoin always underperforms. So ultimately, the way to think of it is 7 years out, we would like to have maximized our Bitcoin per share. And what is it that we should be doing now that's going to maximize and optimize the company's performance so that we've maxed out Bitcoin per share 7 years from now? And I think it's not unlikely that we'll sell some Bitcoin between now and the end of the year. I don't know how much. We still consider these things. But it's also likely that we'll sell a mixture of equity, a mixture of credit. We'll manage our USD, our cash positions, and we do it in a very thoughtful, programmatic fashion where we're running our multivariate models, and we're literally running them. We're making trading decisions. To say every minute might be an understatement. We oftentimes make trading decisions every second, and we'll continue to do that.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
Everything you guys do, Bitcoin for corporations, is so high quality.
Bitcoin for corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for corporations may be the highest quality professional association in the digital asset space.
All right, welcome back. Checking out shares of Strategy higher after the company sold more than 1,600 Bitcoins last week, raising roughly $105 million. Now, it's part of a major overhaul aimed at shoring up Strategy's finances and rebuilding some investor confidence, including buying back preferred stock. So will Strategy's strategy work? Joining us now for a first on CNBC interview is Strategy CEO Phong Le. Thank you so much for joining us, Phong, for this. As I'm looking right now, the prices for Bitcoin just a little below 64,000, so call it roughly half of what it was at the highs just in the last 12 months alone. We're closer to the bottoms here at the 52-week range than the top. What exactly is your outlook for it, and how exactly are you navigating this kind of price action given your corporate balance sheet needs?
Yeah, look, I think Bitcoin is going through a bear cycle right now, and some of that is external macroeconomic. I think there's a major funding that's happening with AI. I think there's uncertainty with interest rates. There's uncertainty wars around the world and there's uncertainty with governmental legislation. We, as a company, went through this in 2022. Right? We actively manage our capital structure. We rotate into Bitcoin. We sell Bitcoin when we need to, and we'll continue to do so. And we'll get through this bear market. And what strategy is designed to do is to outperform Bitcoin in a bull cycle, which I expect to happen next year.
You mentioned those factors that were driving some of the downside action and sentiment. It wasn't that long ago that many of those factors were reasons to be in cryptocurrencies and specifically in Bitcoin. The fact that they were decentralized from traditional finance, the reasons because you didn't have some of the exposure to fiat currencies and some of the geopolitical aspects, cross-border transactions. Why that sentiment shift, and how do you get back to a zone where Bitcoin becomes one of those positive plays on those uncertainties yet again?
Yeah, I think that'll still be the case. The biggest catalyst that'll start to cause Bitcoin to move forward is legislative clarity. And what I mean is we need the SEC and the Treasury and the CFTC to move forward with a set of excellent rules that they have planned to allow tokenization of real-world assets, to allow stable coins to be implemented. What will happen then is large banks, and we've seen them, will start to move into this space, and that'll be a major catalyst for Bitcoin. And I think that'll also allow Bitcoin to be the inflation hedge that we expect it to be.
Following our graphic just showed that your average cost was $75,000 per Bitcoin, and we're at 63 today. So are you a forced seller of Bitcoin?
No, we're not a forced seller of Bitcoin. The average cost is not that important to us. It's really were our Bitcoin purchases accretive to our common shareholders and our Bitcoin per share, and they always have been. We're selling Bitcoin from time to time, and we've shown that our Bitcoin sales are not really a major portion of what occurs in the market, but sometimes it makes sense to sell Bitcoin to add to our US dollar reserves. Sometimes it makes sense to pay dividends, and that's what we've been doing.
When we spoke about this last time, the first time you had sold, you said it was to test the market. What is the rationale to shareholders for why selling Bitcoin gives them more value per share, when the original idea was that buying Bitcoin as it continues to move higher would give them kind of leveraged returns? Now, of course, your shares are down by half. What is the shareholder value you're creating by selling your Bitcoin here?
Well, I'll start with the big picture, right? The big picture is we have net 142,000 or 170,000 Bitcoin we've added this year. We've added over 35x the number of Bitcoin that we sold. So I think focusing on the sales of Bitcoin is really focusing on a very small amount. We've done in the last couple of weeks to pay dividends. We've done in the last few weeks to buy back Stretch, which is trading below par, and that's accretive to Bitcoin per share when we do that.
Michael Saylor, the chairman of your firm, has basically put on social media that, while strategy has been a seller, to your point about some of the corporate machinations around your balance sheet, but Michael Saylor on X said, when I I say never sell your Bitcoin, I speak as no one saver to another. I have never sold mine, not one Satoshi. Strategy is a public company, not my wallet. Since 2020, it is disclosed it may buy or sell Bitcoin and manage capital. Our shared conviction of Bitcoin remains unchanged. Michael Saylor says he's never personally done it. You'd have to do it for corporate purposes because of what you just mentioned. How exactly then do you view that future of it, given the fact that you may not have to operate with the same kinds of parameters that Chairman Saylor does?
Yeah, look, we have 842,000 Bitcoin. That's over 4% of the world's Bitcoin that will ever be mined. We're the largest institutional holder of Bitcoin. Last quarter, we passed BlackRock. We're the JP Morgan of the crypto economy. So whether we sell 1,000 Bitcoin out of 840,000, to me, is irrelevant to the conversation. The conversation is, what is our role in Bitcoin? And are we adding Bitcoin per share overall to our shareholders? And are we creating value? I think that's an unequivocal yes.
Fong, you said that one of the reasons you sold the Bitcoin was to pay your dividend. Would you have been able to pay the dividend without selling the Bitcoin?
Yeah, we have over $4 billion of cash now on our balance sheet as a U.S. dollar reserve. We could use that to pay. We could use that to sell the Bitcoin to pay the dividend also.
And Fong, just how much? And I want to get this because this is not just about your firm. There is legislation tied up in Washington, D.C. right now, namely the Clarity Act. How important is the Clarity Act to not just yourselves, but the entire crypto industry for its path forward? And we're just showing some stats right now from Kalshi. Will the Senate vote on the Clarity Act before August recess? And the majority, 72% of respondents there at Kalshi, say no.
There is rulemaking behind the Clarity Act that has been put forth by Commissioner Atkins at the SEC, by the CFTC, Treasury Secretary Bessent. There are rules ready to go, and they're either going to go with clarity, with the legislature behind them, or they're going to go without clarity, with the power of the executive branch. So I think the most important thing is decision on clarity one way or the other, and the rules will get made.
All right, Fong, thanks. Really appreciate it. Good to check in with you again.
All right, thank you.
Fong Li, CEO of Strategy.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for Corporations, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key. And you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Bitcoin is still trading at $63,000 today, and I made a tweet this morning saying that Bitcoin going to $1 million is inevitable. And a lot of people really did not like that I said that. They don't like that I have conviction in Bitcoin. There are a lot of people that are down on their investments. When you denominate it in fiat currency and they're telling me that I'm a lunatic, that's fine. Let's start with the claim that sounds insane. That is, it only sounds insane until you actually look at human incentives. Today, I'm going to be making the case that Bitcoin is going to win because the existing financial system is financing its own displacement. We built this civilization where governments, companies, banks, and households can create enormous future claims in dollars, yen, or euros. Then somebody dropped an asset with a terminally fixed supply into the middle of the machine, 21 million. Now suddenly, the guy that's borrowing the flexible thing can buy the thing that is inflexible, okay? It is scarce, it is finite, and it compounds faster than the liability. So the borrower always keeps the spread. And once this system, this speculative attack happens for long enough, other people copy him because human beings enjoy money and they deeply resent watching somebody else get rich first. This is simple game theory. Bitcoin needs ambition, envy, competition, and access to credit. America alone could probably supply all four. We are going to get into today why Bitcoin's victory is inevitable. It is absolutely going to $1 million per coin. So if you guys could do me a huge favor, like the video below, hit the thumbs up button, subscribe to the channel, that way you can support me spread the orange gospel of Bitcoin to the masses. And look, if you're listening to me, I would assume that you're bullish on Bitcoin. My friends at Sovana can help you be secured in a Bitcoin investment position with full principal protection. That's correct. If you want to lock in a 5-year position in Bitcoin while it's this cheap with full principal protection, my friends at Sovana have built a way so you can do that. Go to sovana.io/capital to get started today. You will love what my friends are building. Go there right now, click the link below, scan this QR code. I really think that you will enjoy what they are doing here. It's full principal protection. What's the downside, kids? Every dollar of your investment being secured by a title insured recorded lien on U.S. real estate, you splitting the upside with a property owner whose home equity is backing your very own investment. Scan the QR code, get started today. And look, kids, you know we're going to be talking about the speculative attack today. You know that I understand. It is just simply true that Bitcoin is going to win with corporate adoption. But do not lose sight of the fact that the most important strategic reserve is your own Bitcoin in 100% self-custody. You can eliminate counterparty risk, run your own node, and be your own bank using only the best open source tools. With all of the AI cyber attacks that are happening, you must be secure with your Bitcoin in self-custody, and there is no better entity than the Bitcoin Way to help you along in your self-sovereign Bitcoiner journey. You can go to thebitcoinway.com/Adam to get started today. Scan this QR code. You will get a 100% free introductory call. That's correct, 100% free, so why wouldn't you do it? Scan the QR code, get started today. Now let's get into today's content. So today we are going to be starting out with the speculative attack thesis. Now, Pierre Rochard wrote an article back in 2014 about the Bitcoin speculative attack thesis. I highly recommend that you check it out. I will leave a link to it in the description below. It is required reading, and so is part 2. Now, when we look throughout Bitcoin's history, it's very clear that early Bitcoin adoption required a personality type. Cryptography, monetary history, distributed systems, pseudonymous cypherpunks, if you will. The next phase of Bitcoin's adoption, though, it requires a lot less philosophy. Imagine 2 chief executive officers today. Obviously, one is running one company in one domain, you have another one running another company in another domain. One is keeping treasury assets in cash and bonds. The other one owns Bitcoin. You could picture that guy as being Michael Saylor. And then, of course, several years of compounding later, one of them has a stronger balance sheet, $50+ billion of Bitcoin. And now the first CEO on the other side, he has a real problem. His board might have to ask questions. And if they don't ask questions, how much does the other Bitcoin hoard in that corporate treasury, how much does it have to compound before other people start to ask real questions? Will it be when the hoard is worth $300 billion? How about $600 billion or $1 trillion? When you become a Fortune 50 company with just compounding of the assets on the balance sheet, you really have to wonder when questions will start to be asked. Suddenly, the useful question will eventually become, how expensive does this make us if our competitors are correct? This is how competition in the real world reaches people who hate the idea of Bitcoin. It's inevitable. And this is the part that people often miss here. The world is structurally short fiat currency because huge portions of the economy owe future units of fiat. Mortgage borrowers like yourself, if you have a mortgage, you owe dollars with an interest rate. Corporations with bonds outstanding, they also owe dollars. The Treasury owes dollars. Governments with yen debt, they owe yen. Banks owe their depositors currency. Pension systems owe future nominal payments in fiat. So a debtor is economically short the unit that he has promised to deliver later. This is a concept that must be understood. Zoom out, and civilization here, it really looks like one gigantic pile of promises to produce future currency units. That creates a constant demand for refinancing, liquidity, credit, and currency. Those 4 things. And Bitcoin just changes the asset side of that equation. If I already owe the elastic unit, why hold every asset in the same thing that I owe over time? It doesn't make any sense. Borrow fiat, buy scarcity, service the liability from cash flows, and then let time decide which side compounds faster. This is a structural short meeting a structural long. And the federal debt is sitting near $40 trillion. We are on pace to cross that number literally any single day now. The broad money is about $23 trillion. That's pretty awful. People hear currency debasement and, they think of the hyperinflationary horror stories of taking a wheelbarrow full of cash to buy your bread in the morning. But America usually does their decline with a lot better branding. Right now, your starter home costs $600,000. The pickup truck in your driveway has an 84-month loan attached to it. One bag of groceries feels like a small acquisition. Your refrigerator wants a software update. Somebody at a firm is probably building a payment plan for chicken thighs and Domino's Pizza. Our lives continue. Your payroll checks continue to clear, and the drive-thru still has a line around the block. Financial assets reprice against a growing pile of nominal claims. And this is the environment where Bitcoin thrives in because we have continuity here in this system plus persistent monetary expansion. The money supply is going up and to the right. The federal debt also going up and to the right. And this is what I call fiscal gravity because it seems like it's a law of the universe refusing to go away. We can look at the Congressional Budget Office. These people in our own government, they are pricing in, projecting a federal deficit around $1.9 trillion in 2026. The debt held by the public near 101% of the GDP, and the net interest around 3.3% of the GDP. Now, this is the important part. Think about 10 years ago in 2016, how different the world was. It's only going to speed up and get worse from here as it relates to inflation, because when we project out into the future 2036, What is the Congressional Budget Office saying? They are saying that the baseline has the deficit around $3.1 trillion, the debt around 120% of the gross domestic product, and the net interest around 4.6%. This is ordinary baseline arithmetic. The past borrowing is creating future interest expense. The interest expense is creating future deficits. Larger deficits just require more borrowing. And with every single escape route that is possible, well, it punches a constituency in the face, because taxes just anger voters and you can't get reelected if you actually promise to raise taxes. And if you cut their benefits, well, they're not going to like that either, because you've been promising them those benefits for decades. And then, of course, high real rates, well, those just explode the debt service. And then, of course, hotter inflation that just harvests savers through purchasing power. So politics will always choose pain that arrives very slowly. You are frogs being boiled alive in a pot and you don't even realize it. Because the most politically convenient situation over time is to devalue the currency, devalue the debt through monetary repression. This is the route that they're going to choose every single time. And Bitcoin sits entirely outside of this committee meeting, and that is a beautiful place to be. And the debt problem is actually not just the United States, it's global. The speculative attack can hunt globally for cheap funding. Dollar credit can buy Bitcoin 100%. I can take my credit card and I can buy Bitcoin with the funds allotted to me. But also, yen credit can buy Bitcoin. Euro credit can buy Bitcoin. The liability only needs to be cheaper and more durable than the expected return of the asset. Humanity has spent decades building credit markets, pension systems, and repo desks and derivatives. And armies of 26-year-olds invests hunting 40 basis points, and Bitcoin is arriving at the perfect time after all of this plumbing has already been constructed. Every jurisdiction with deep credit markets is becoming a funding leg into digital scarcity. The old system already built the weapons that will be used to make it irrelevant. Isn't that beautiful? That's why we are calling it a speculative attack. It is a Trojan horse, specifically Bitcoin-backed credit, paying out decaying fiat claims while using the proceeds to buy Bitcoin. Bitcoin is giving the weapons a target with a harder supply schedule. And normal assets, they always respond to higher prices by creating more supply. What happens when the price of oil rises? They drill more. That's exactly what happens. You have a supply that is seemingly more scarce, and then there is a natural human response to that scarcity. If there is a shortage of houses, you can build more houses. If there's a gold shortage, you can go mine for more gold. Bitcoin rises and the terminal supply stays at 21 million. Miners can plug every warehouse in Texas into the grid, hang prayer candles around an ant miner, and they can perform their Gregorian chants at the next difficulty adjustment, but the supply cap goes nowhere. So the sustained demand, therefore, has one narrow exit, which is the price. That is the last variable that exists. It must go up to acquire more of it. The price needs to go up for sellers to want to sell. And the higher price just increases the value of it being collateral. And the greater collateral can then improve financing capacity. And then better financing supports more acquisition. More acquisition pushes against fixed supply. And that is the reflexive loop. You have to understand that scarcity only becomes more financially useful as the market recognizes that scarcity. And recognition just strengthens the balance sheets of the people who arrive early. What fiat credit borrowing terms do you think Michael Saylor and Strategy will have when their Bitcoin hoard is worth $200 billion? If they were able to issue convertible notes at 0% when they had 100,000 Bitcoin, what do you think they will be able to borrow fiat at? What do you think their terms are? It's literally a math equation, guys. Borrow $1 at financing cost C, use it to Bitcoin, let coin compound at G for T years, T equals time. So the asset becomes 1 plus G raised to T. Meanwhile, the liability becomes 1 plus C raised to T. So whatever sits between those two curves belongs to the borrower after the costs. And everything will resolve around that gap. If Bitcoin compounds at 20 or 30% or even 15%, while the financing costs 4 or 5, the duration turns the spread into a weapon and game theory kicks in. Buying Bitcoin on a credit card at a 27% APR is reenacting the final days of Rome in a Best Buy parking lot. But durable 4% corporate debt, that creates a completely different setup. The same asset, radically different capital structure. One behaves like casino financing, but the other one becomes a machine. You have to understand that $1 of fiat debt becomes a Bitcoin call option. Run the math over 10 years. It's very simple. It's just math. It's not my opinion. This is just an illustrative scenario of Bitcoin compounding at a 30% CAGR. $1 becomes $13.79 after 10 years. You might recognize this from my Metaplanet example because Metaplanet is issuing Bit bonds, rolling over debt, let's say over a 4-year, 3-year time frame, and their cost of capital is 4%. Borrow the original dollar at 4%, and then if you let the liability compound for the same decade, it becomes roughly $1.48. So what is the residual value? About $12.31 because the spread is right here as we go through time. You capture this spread if you are borrowing fiat to buy Bitcoin. The trade is absolutely obscene, and when you recognize that fiat is decaying in purchasing power, what is the incentive of a rational human being, a rational enterprise or a corporation made up of human beings just pursuing their own self-interests? Cheap fiat changes everything. Cheap fiat changes the payoff for each market participant, okay? This is the residual value difference of what you would collect from the cheap fiat versus the Bitcoin compounding spread over 10 years at a variety of funding rates. At these different costs of capital, maybe an average between a SATA and a stretch, 12.5%, you would capture $10.54 of residual versus Metaplanet capturing $12.31 with 4% yen funding. Japan spent decades cultivating very absurdly cheap money, okay? Now imagine routing part of that financial architecture toward Bitcoin. Gee, borrow yen, the softest currency from a developed country in the entire world, and then acquire an asset with a fixed supply. The shareholders see it, the competitors will have to study it. If they're not, they definitely will be in 5 years. Somehow I'm some guy on YouTube seeing what's gonna happen here. The math is pretty obvious to me, but it's gonna be 10 years before we see TradFi making digital asset treasury optimization conferences. Guys, we are on the forefront today, the bleeding edge. If you are watching this, you are a witness to the monetary revolution and you understand it to a degree than more than 99.9% of the populace. Seriously, if you are this far into the video at this point, you must understand that you are remarkably early. And this is why when you get to this point, you understand that incentives and pragmatic adoption of borrowing fiat to buy Bitcoin, that is what's going to cause Bitcoin to win. Microsoft Excel is going to do more for Bitcoin adoption than every single ideological argument ever written. And you just got to understand that the incentive to do this is how you're going to create shareholder returns, because leverage converts the Bitcoin compound annual growth rate into convexity for your common equity. If you take $1 of common equity and borrow another dollar at 4%, well, now you own $2 of Bitcoin against $1 of equity and $1 of debt. This is why treasury companies are going to create insane upside if their capital structure just survives over time. It's that simple. Bitcoin will take your balance sheet into an alley behind a Dollar Tree and test whether you understood duration, but strong financing is going to live through the drawdown and weak financing becomes liquidation content on X. Strategy is industrializing the speculative attack, and this is what people fail to understand. They proved that Wall Street can become a Bitcoin acquisition machine. They have 4% of Bitcoin's terminal supply cap. Wall Street spent a century mastering financial claims. Michael Saylor walked into that factory that they created. He pointed at all the machinery and he said, great, aim the entire thing at 21 million coins. That is why we are in this new phase of attack on the fiat system. And then we have Metaplanet opening the yen channel. Obviously, Bit bonds are already launched. There is that initial tranche of debt that has been announced, a 3-year unsecured yen bond at 4% cost of capital. Are you kidding me? To buy Bitcoin? And then let's say in 3 years, you got to pay that money back. What do? You just issue another bond that rolls forward. Japanese investors want yield. Metaplanet wants cheap capital to buy Bitcoin. Bitcoin is providing that scarce reserve asset for them. And then, of course, I want to capture the value, the spread between the asset outrunning a 4% funding cost. That's why I am buying Metaplanet shares, because it's obvious I can do the math. That's also why I buy MSTR. Do you think Bitcoin will compound more than 4%? If you can do that math, the answer should be obvious to you. Human beings have invaded countries and killed people and conducted genocides for weaker incentives than this. You have ETF plumbing removing the friction of borrowing money to buy IBIT if you want to. The pipes are there. People are going to start to wake up to this over the next decade, over the incoming years, and we're going to see the boring infrastructure start to change history. Institutions are moving through the approved channels already. You got to understand that the plumbing of traditional finance, it is lowering the operational and social cost of operating on the incentive to borrow fiat to buy Bitcoin. Bitcoin is becoming easier to own at the same time that owning zero becomes harder to defend, and that combination is very powerful, and that is what is going to lead Bitcoin to go to $1 million. The pools of capital are comically larger than Bitcoin. I had to do a log scale chart here just to make it not look ridiculous. You have Bitcoin's max supply right now, $1.32 trillion of a market cap versus global bonds, global equities, global real estate. Bitcoin will continue to absorb the monetary premium from these asset classes because it's logical, because Bitcoin has superior monetary properties. It functions as collateral better than other asset classes. And the key idea is just a marginal reallocation, because clearly Bitcoin can capture a very small sliver of the giant asset pools, and that represents enormous purchasing power. A modest change in the monetary preference colliding with a fixed terminal supply is going to force the price to perform the readjustment, okay? And this is the asymmetry that people continually underestimate. The stored pools of wealth are gigantic. Bitcoin supply is scarce, so when capital starts moving at the margin, those two facts are going to become very interesting very quickly. Zero Bitcoin just becomes an active risk. Imagine that you own a fund and every single one of your peers owns zero Bitcoin. Easy. Then 3 competitors allocate a small amount and let's say Bitcoin triples. Now your safe choice has created visible underperformance. The investment committee asks why in 2030. A guy named Brad, who spent 5 years calling Bitcoin rat poison, suddenly explains that he has always supported a measured allocation to digital scarcity. Career incentives are undefeated, kids. Companies are going to face pressure in the decaying fiat environment that's just going to get worse. Adoption is going to become defensive. You will have to acquire some because the cost of being wrong has become larger than the discomfort of changing your mind and telling other people. And countries are going to be playing the same game. The sovereign debt crisis is going to force this game theory upon all sovereign nations of the world. They're playing the same game with higher stakes. Why do you think the United States is already framing a Bitcoin strategic reserve as a strategic advantage for the country and its populace? There's really one mortal attack, and that's just bad financing. Obviously, you got to finance adequately. You got to think of your funding duration and the leverage that you're taking out to play the speculative attack game. And obviously, you do not want to blow up. Eventually, the cost of being wrong about Bitcoin exceeds the cost of owning some. That's the crossover point. After that, adoption becomes defense. You buy because the other guy owns it, finance because the spread exists, and participate because sitting out becomes expensive. Humanity built hundreds of trillions of dollars of assets and liabilities on currencies whose supply can expand in perpetuity forever. The machine has a structural need for future currency units. They have to print more. And then Bitcoin arrived with a supply cap that cannot go anywhere, and that create the trade. Borrow the thing that everybody owes, then just own the thing that nobody can print. Keep the financing durable. Let the spread compound. Bitcoiners are speculative attackers. And for those of you who give out the purity test, do you have a mortgage and do you pay the minimum payment and take the rest to buy Bitcoin? Congratulations, you are a levered Bitcoin investor. The world can argue forever, guys. The spreadsheets care about the returns. If borrowing fiat to own scarce digital property keeps rewarding the people who do it intelligently, the market will manufacture more of them. Eventually, the incentives are just going to become too impossible to ignore. My name is Adam Livingston. I am the Bitcoin Wizard. If you guys like this content, please do me a favor, like the video, subscribe to the channel on YouTube. That way you can support me spread the orange gospel of Bitcoin to the masses. Have a very terrific day, everybody. Do not party too hard. Class dismissed. This video is sponsored by Solvana, and if you are interested in gaining Bitcoin upside while keeping your principal protected, Solvana may have built the most aggressively bullish product available for people who still enjoy sleeping at night. Yes, you as an investor can receive 50% or more of Bitcoin's appreciation with uncapped upside, while the structure is backed by the Bitcoin position itself and a lien on U.S. investment real estate. Basically, Solvana is putting Bitcoin in body armor. You still get the moon math while your principal has a rental property standing behind it with a baseball bat. If you are interested, scan the QR code or use the link below. Solvana will help you every single step of the way. They will answer your questions and explain exactly how the structure works. Requesting information carries zero obligation or commitment. Go to solvana.io/capital to buy Bitcoin and MSTR with full principal protection. And you know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own, Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it.
Is quantum computing a threat or is it overblown?
It's both.
I am fascinated by quantum computing.
I think there's definitely a lot of unknowns with quantum computing.
It is a theoretical risk on the Bitcoin network.
The big threat, in my opinion, is the discovery and unlocking of wallets that have been lost forever. Bitcoin is a scarce asset that you can make more of, but you can find more of it by unlocking these old wallets that could pose a threat to Bitcoin.
The quantum concept is, what do you do with the Satoshi coins if they are not quantum resistant and they don't move? It's a really interesting philosophical debate because you could argue that if quantum computing is a real threat and it can come and crack the Satoshi coins, I mean, obviously there's a probability of having a bad actor that wants to tear down the entire ecosystem, but the game theory would suggest that there's more incentive to break the Satoshi wallet, keep the coins, and build on that into the future.
I don't know what the answer is, but I do know that there are a lot of teams working on protecting Bitcoin against it. Teams like Blockstream have a lot of PhD engineers currently working on upgrading Bitcoin to stave off those threats.
I do believe that the technology, as all technology does, will progress and get better. The Bitcoin network has the ability to upgrade and change and morph, and I think that's really the beauty of Bitcoin, is that it's distributed network of nodes. Frankly, I'm currently unconcerned by quantum.
The question is still if and not when. Still, it is important to take that question into consideration and most importantly, not add changes to the protocol with rushing into a solution in search for a problem.
There are people in the Bitcoin community that don't want to see a change to Bitcoin. They believe Bitcoin will be fine as is, and it's designed the way that Satoshi envisioned, and it would be a bastardization of what Satoshi viewed if we make a change to the Bitcoin protocol.
And my view is that Bitcoin will win. Bitcoin will actually be the best prepared for the future of what could be quantum. And you have already solutions that are being proposed by the market, and the best will win. And my view is that the best will be an optional one where people can opt in over time as they perceive a potential risk.
I do understand why people have the fear. I think it's an incredibly complex topic. We're literally talking about quantum physics, and I'm no expert, but from the people that I've listened to and the people that I trust and the research that I've done, I do not think it's an immediate threat. And if it were to become a threat, there are things that the Bitcoin network can do to protect itself.
I would say the threat is less imminent than the headlines suggest, and work being done already to address any potential threat in the future is more robust. Work being done, and the community is already discussing and debating ways that this could potentially happen, but it seems like the threat is more theoretical in nature right now. And I think people underestimate Bitcoin's resilience. Bitcoin is the most secure computer network in the world. It's decentralized. And so what that means is there's a ton of eyeballs looking at this open source code. They're maintaining it, looking for vulnerabilities, making proposals. There's a ton of discussion, and that hive mind is one of Bitcoin's biggest strengths. And that's why its uptime is 99.9%. Despite it probably being the biggest honeypot for any potential attacker to go after. So I think Bitcoin is extremely resilient, and people shouldn't underestimate it.
I think it makes for a great story. It is incredibly interesting tech. It'll continue to move forward. We saw this back there with the Y2K bug back in 1999, where the world was going to implode. Technology marches forward, and Bitcoin continues to adapt for it. And if anybody's worried about quantum breaking Bitcoin, they should be more, quantum will break everything way, way before Bitcoin. And Bitcoin's already adapting to it because that's the nature of open source software and something at this kind of network scale. So it's actually going to unlock incredible possibilities. So I'm not one of these people that sees the progression of tech as dangerous. I see as we adapt to it, Bitcoin, it will adapt to it, already is. The discussions are great around it. And we're going to see many, many great things unfold from quantum computing.
There's multiple attack vectors for quantum on Bitcoin, but there was even just a paper that was released a couple of weeks ago where, without even having to go through a protocol upgrade, we know how Bitcoin and Bitcoin wallets and the consensus mechanism can be completely quantum proofed. So is it a threat? Yes. Are there ways to alleviate that threat such that it will not destroy the Bitcoin network? Absolutely. Do we have to come to a consensus in the Bitcoin community as to what we need to do to protect Bitcoin? Absolutely. Do I think that's going to happen tomorrow? No, but I think we have some very smart people in the community that have figured out ways to make this work, and we have a couple of years before quantum really becomes the true threat that it may be. And at the end of the day, I'm more worried about what quantum and its threat will be on the global financial system as a whole, more so than just native Bitcoin.
According to regulatory filings, the world's largest corporate holder of the digital token sold more than 1,600 Bitcoin for more than $108 million total. Strategy sold the Bitcoin at an average price of about $64,200. It's the second consecutive week the company has sold, and marks the seventh week in a row it has not made any Bitcoin purchases. Let's find out what the plan is. Joining me now in a Fox Business exclusive, Strategy CEO Phong Le. I get the selling for the moment because you got to raise some cash, because you've got the preferred shareholders that you need to make sure you pay their dividend. But why no purchasing of Bitcoin at all?
Yeah, let's start with some perspective, Liz. We now have 840,000 Bitcoin. Since the beginning of the year, we've bought 175,000 Bitcoin and we've sold 7,000, so about 25x more. And in the last 3 months, we've gone from being the number 2 institutional holder of Bitcoin in the world to the number 1. Right? So I think we've bought a lot throughout the course of the year. We've increased our holdings 25%. I've said we're now the JP Morgan of the digital economy. And we'll get back to buying more Bitcoin throughout the course of the year.
What, does the price have to go down, or you want to see it go up? Right now it's at $63,950 per Bitcoin.
Yeah, it's not really price related. What we've been doing over the course of the last few months is adding to our US dollar reserve, right? So we've added 175,000 Bitcoin this year, sold 7,000, and we've actually increased our US dollar reserve to 4.75 billion from about 800 million. So that's been our focus over the last few weeks, and then we'll get back to buying Bitcoin at some point in time. And it's not price related, it's about whether we can do it accretively to our common shareholders.
It was last October that Bitcoin hit 126,000. Obviously, it's been cut in half, 64,000 at the moment. This has lasted kind of a long time. It's come up off the floor. But that said, how much longer do you anticipate this, and would you call it a crypto winter?
Yeah, I think it's reasonable to call it a bear cycle. It's been about 8 months, right? And if you go back to 2022, the last time we had a prolonged bear cycle, that started in about May of 2022. And it really went into the beginning of 2023. So a 8 to 12 month down cycle is not unusual. But what you find, and if you go back and look at the 18-year history of Bitcoin, every time there's a down cycle, Bitcoin comes back stronger the next time.
We've seen that, absolutely true. Never guaranteed, but that has been the history of it since the birth of Bitcoin. The question becomes for investors who bought MicroStrategy at more than $400 a share, and now we look at it, it's at $97 a share. What do you say to those investors who are out there saying this is a sign of financial distress, that strategy is selling, is actually selling Bitcoin?
I look at the underlying characteristics of the company. We have 4% leverage. We have now 2.7 years of dividend coverage. We have $55 billion worth of Bitcoin on our balance sheet. None of that signals financial distress. I understand, to our common shareholders, the stock has been down. I look at the history since we've been buying Bitcoin. Since August of 2020, Bitcoin has been up 33%. We've been up 42%, right? And so anyone who's investing in Bitcoin knows that it's a long time horizon asset, which has high returns, high volatility. If you're going to invest in MSTR, which is amplified Bitcoin, we have higher returns, higher volatility. Mm-hmm. And those who are looking for a shorter duration asset with lower volatility, that's why we created Stretch STRC. And it is, you do have to have the stomach for the volatility and longer duration to be a common shareholder of ours.
Yeah, it's sort of a buyer beware. This is a rough ride. It is not smooth. Michael Saylor, who of course is the chairman and had been the CEO, he recently posted on X this, and it was a picture of Bitcoin strategy reserve value with the caption, quote, doing business. What, can you interpret that for us? What did he mean, doing business?
We've been doing business every week for the last 6 years related to Bitcoin. The big difference between our business 4 years ago is we were basically buying Bitcoin, issuing debt, and buying more Bitcoin, or levered Bitcoin. What's changed now is we have a lot more options. We can sell US dollars, we can sell Bitcoin, we can sell our prefers, we can sell our equity, and we can buy all of those things. So business is just a lot more options.
Is it a decision made between you two about whether to sell some Bitcoin each week, or is it you? Is it Michael Saylor?
We talk 3 to 4 times a day.
Okay.
And we consult with our finance team and we listen to our shareholders. But we talk quite a bit, so it's a joint decision. And of course, the board has guidelines around what we can do.
We've just got not too much time left, like 30 seconds, but the Clarity Act. What are you hearing? The Senate has not passed it, and it would give some much wanted guidance and regulation to the industry, which is actually asking for it.
Yeah, look, I think having clarity coming from the government, especially from Congress, would be positive right now. And it looks like they're going to vote for this come mid-September. So I think there's positivity comes out of that. Regardless, there's good rulemaking coming out of the SEC that will progress Bitcoin clarity.
Phong Le, CEO of Strategy. Great to have you. Thank you very much. All right, here comes the bell, everybody. And it looks like it's just, as we said, kind of a meandering mealy-mouthed Monday. Lots of red on the screen, but nothing too deep. We'll see you tomorrow with Jan Hatzius of Goldman Sachs.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin Corporation, is so high quality.
Bitcoin for corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
Do you think self-custody, is it too hard for normal people?
I have a lot to say on this topic, as you may imagine, Mark.
Yeah.
Maybe just as I kind of have these thoughts in my head, I'll share them, and it might be a little rambly, but you'll guide me, I'm sure. So the first comment I make is, like, no one's alone in this process, right? Like even like the gold miner out there 200 years ago on the frontier, or the Bitcoiner today, like, again, you're always enmeshed in this world of technology that you use to protect you, and there's community around you, and there's resources, right? You may bear a lot of responsibility, but you didn't make your own gun and bullets and gunpowder, and you didn't make your own hardware wallets and your own software. You're always part of a system.
Yeah.
It's just important to remember that, right? No human system is perfect. That's the way I like to live my life, at least in regards to Bitcoin and protecting secrets and taking and managing risk. The physical analogy here is if physical walls worked like digital walls, where you can look at it and it looks fine, but you can't really be sure. A reasonable response is, could we just build two walls, right? That's like a very simple-minded, but also robust solution to not having the ability to verify the integrity of any specific protection. And that's very much the way that Unchained and myself, we think about designing protections for Bitcoin, is whether it's a malicious insider, whether it's just a mistake, whether it's completely unknown 0 day that an AI finds, whether it's a supply chain attack. I think we should, in general, like, still value reputation and brand and other things, but we shouldn't take those as signals of infallibility, rather just signals of general trustworthiness, right? We should, like, when a company has a good brand and they're known for their technical excellence and they have great, teams and experienced engineers, we should trust them, but we should not assume that they're perfect. We should always seek to protect ourselves with a different team, a second team, a third technology, things that complement the risk profile of the first thing. Coming back to self-custody versus an exchange, I don't like that dichotomy because they both, to me, fall sometimes in the category of things that have single points of failure, right? I think right now there's a popular discussion going back and forth of, like, how much coin was lost in self-custody versus by exchanges and third parties. I think that's kind of like not the right way to frame it, right? It's always how much coin was lost in systems that had single points of failure versus how much coin has been lost from systems that had redundant controls and multiple points of failure required in order to truly break. And the answer is the vast majority of coins are in that first category that have been lost or stolen, because of course they must be. That's the much easier systems to break. Exchanges have had very famous hacks in the history of Bitcoin. You just described your own personal experience. There have been many, many, many stories like that. And part of the reason self-custody became so widespread is as a response to some of these negative outcomes that came from just trusting somebody else.
Yeah.
Unfortunately, I think what this lesson is teaching us in self-custody is we're not immune to single points of failure if we choose to build systems that protect our coins that have single points of failure, whether that's a single device, a single geographic location, a single vendor, a single supply chain, a single person. right? Like if no matter how perfect your setup is or how redundant it is, if you're the only person in the world that understands it, you're the single point of failure. And if you were to pass, what will happen to your Bitcoin? Will your heirs or your spouse or your family really be able to recover them? I think that is the real question to be asking, not so much is self-custody dead or are exchanges better? I think that's a false dichotomy, and we can all learn to like move past that and live in a world where there are always multiple points of failure. And again, that's what part of what multi-sig allows you to do. But then multi-sig also can, I think sometimes is interpreted as I'll just have more than one key. And that's a great protection for many things, but it doesn't, in my view, totally solve the problem. Multi-party multi-sig, I think, really helps, and relying on professionals to help hold keys in your quorum or relying on other people you know who are experts to help you, I think is very powerful. Those are both features that Unchained provides. And I just want to make a final comment relating to your ultimate question around, is self-custody too hard? I think the answer is maybe yes today for a lot of people, but I don't view that as, in some sense, the same statement as, therefore it'll never work, right? Things that were hard often become easy as technology improves, user interfaces improves. And I think a crucially underestimated component, as the professional classes start to absorb this as a business workflow that many people are involved in. As an example, any complex financial transaction that you do in your normal fiat life, selling a home, investing in a business, setting up complex retirement portfolios or accounts like this, you're very, very seldom doing this alone. Even if you have sovereign control over these accounts, even if they're self-directed, even if even if you completely understand what's happening, you're almost always being advised by lawyers, accountants, state agents, people who are in the professional classes who have seen the edge cases. They're there to oftentimes be fiduciarily servicing to you to make sure that your goals are met. We don't have this concept today in the self-custody world. Like we see it in firms like Unchained and many others that offer great service and will be that role for you. But there isn't like a job that is, I am a self-custody professional, right? Like I have a collection of several hundred of clients that every year they have 2 or 3 major things that they're doing, and I make sure that that process goes well. I think about security, I think about geographic proximity, I think about systems and tools. I'm always paying attention to risk factors, and I'm proactively alerting my client base to let them know that an issue is going on, much the way that an accountant or a lawyer could be abreast of new legislation that could either help or hurt their clients. We're just so far away from that being a common practice. And I think for something as important as, massive transactions that move money around, you kind of need that class of person to exist. I think once they exist, self-custody becomes way easier because, again, you're never doing it alone. You have technology and professionals to help you get it done.
Yeah. Drew, I love that answer because the human mind, we're comparing, and the human mind compares things. If I say this is heavy, it's like, well, heavy compared to what? Compared to what? So when you say, if I pose the question, is it too hard? Too hard compared to what? Is it too much work? Too much work compared to what? Right? And to your point, any major financial transaction that you do is going to require some work and effort and time commitment. So to your point, buying a house, most everyone's going to probably buy a house at some point in their life. Think about just the amount of hours that you would put into buying the house, right? From looking at the house, submitting the offer, getting the appraisals done, filling out the escrow paperwork, getting the loan documents, submitting your package, the tax, all that. So the amount of hours you would spend to do that transaction, and then the amount of, to your point, the professionals that you would use. So then I have the real estate person and the escrow person and the title person and the loan
Home
processor.
inspector.
Yeah.
Termite bats. Yeah.
So I have 5, 6, 7 professionals helping me, and I'm probably still going to spend 20, 30 hours doing it, right? To buy a house. And, I set up a trust to put my estate stuff in there, or I buy a life insurance policy. I mean, all of those things take hours and hours and hours and require the help of professionals. And so, is it more work than, even setting up an account on an exchange is going to take some time, especially if it's a business account, right? So I love that you say that, because I think that's actually a much better framing, and I had never really thought about it that way. And so you need professionals, and you need to be willing to put some time, and think about the trade-off. Think about how much time would it take me to go find somewhere in the desert to dig a hole and bury my gold? That's hours. How much time would it take me to build a safe You know, like so when you think about it, like it's a good trade-off. So I appreciate that. Let's talk about some of the professionals and really some of the services. So again, like one of my biggest fears was always that, you know, somewhere in one of these hardware wallet manufacturers, there would be a bug, a malicious act or something. And then, you know, 5, 6, 7 years, 10 years goes by, Bitcoin's $1 million. And then all of a sudden, shoop, you know, it's gone. And so for me, it was always trying to think about how can I mitigate that. And so for me, I've been a customer of Unchained for forever, for years and years and years, because I can now have multiple wallets and hardware wallets. And so I don't, you said, you know, brand or integrity and, you know, a certain level of brand can elevate itself. And then you have a little bit of trust there. Yeah, but not really, because I don't have the technical ability, nor does everyone in that company know enough that maybe potentially a bug could have been inserted. And so it sort of made sense to me. Why don't I just have 3 wallets, all from 3 different manufacturers? And that way, if one wants to be malicious, it can't affect the other 2, at least not at the same time. So I know you wrote an article called, or a piece called Bitcoin Needs a Network of Keys. So I know you spent a lot of time thinking about this. So break down this network of keys.
I think it's just the vision that like true security comes from human relationships. I think we sometimes think it comes from cryptographic keys and so forth, but the ability to learn to use those things correctly comes from talking to other human beings typically. So the root, I think, of knowledge and trust and robust systems is human beings who understand processes working together to solve problems and protect each other. I think about the insurance industry, right? Like how massively interconnected and layered and robust the insurance industry is, or really any global supply chain at true scale, right? It is typically fractal in its structure, right? That the last mile looks really, really different than the things that are working at the total global scale, right? Like you don't pick up, the container ship doesn't come to your house to drop off your package, right? There's many handoffs along the way. And similarly, you don't buy insurance from a massive global insurance reseller, right? You buy it from potentially a local person in your city down the street that runs a, 1 or 2 person, farmer's insurance outfit or something like that. But they're part of a network and they're protecting each other. Insurers also purchase insurance for themselves. There's tiers, vendors in that space are specialized to certain tiers of operation. And the system is therefore very heterogeneous and well-structured. We don't have that in key management. We haven't really needed that in key management up until this era where Bitcoin becomes something that we want to manage in this way. And so my vision for how does self-custody work in a future that has a large professional class that understands the problem and has been trained to solve it, as well as a robust global layered ecosystem of providers, well, it looks kind of like, well, my keys are, it's not just a thing that's in like my home safe, and if my house burns down, I lose my Bitcoin, because that's insane. Why would anybody like live with that amount of stress, right?
Yeah.
Of course, I'm just part of some local quorum with my friends and family, or my accountant, or some other local service providers. My local bank may be part of that. There will be likely structures like time locks and other kind of transfer structures that if some of those keys fail, every single key is backed by some other network of things. If mine fails, I have family members that can vouch for me. If my bank or accountant's fails, like there's a larger entity that they're rolling back up into. And this doesn't necessarily mean that there's a few people controlling everything, because cryptography gives us lots of controls to avoid that outcome. But what it does mean is everybody's sharing risk, right? That like one person losing a key, or one fire, or one death, or one bad outcome over here shouldn't propagate into now millions of people being in trouble, right? There should be built-in fire blocks and risk corridors that prevent local blowups like that. And in general, because you're always trusting somebody else to back up one part of the system that you're part of here, right? Like Unchained very much works this way right now in a small picture way. Like we're a small company, we have a relatively small number of clients compared to the global population. But that's the future that I see, is people working with firms like Unchained, local professional, Unchained itself as a business, working with other banks and businesses to be in a network where we're protecting each other using multi-sig and other technologies. That just feels safe.
I'll say with no specific evidence behind this, it definitely feels like the hedge fund world is coming together directly against some of these digital asset treasury companies all at the same time right now. And you're seeing it in their prices, you're seeing it in the prices of the preferreds, in the put buying in MicroStrategy yesterday morning, into the lawsuits that seem to be very coordinated. To reframe something I said earlier, we just had this period of massive productivity growth and interest rates being pushed upward from geopolitical risks. These are store value assets without productivity growth and without an interest rate, without some good engineering on top of it. So I think this has kind of been the perfect storm against these store value assets. And I find that the financial advisor space is the have and have-nots with crypto. There's just a very few select groups that are willing to have over a 2% allocation of their client books. And I think I initially expected that the rest of the marketplace would, like dominoes, so, okay, I'm a Morgan Stanley advisor. We just launched our own Bitcoin ETF. There's going to be a wave of slow adoption. But I think you're going to really have to see that next price leg up before you start seeing the FOMO from the financial advisor community that's on the sideline right now. But I think that's what can really make it exacerbated. And it seems like the ultimate bearish moment in Bitcoin right now. So knock on wood, hopefully there's not much else that can make it worse.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
Everything you guys do, Bitcoin Corporation, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
All right, welcome back. Checking on shares of Strategy higher after the company sold more than 1,600 Bitcoins last week, raising roughly $105 million. Now, it's part of a major overhaul aimed at shoring up Strategy's finances and rebuilding some investor confidence, including buying back preferred stock. So will Strategy's strategy work? Joining us now for a first on CNBC interview is Strategy CEO Phong Le. Thank you so much for joining us, Phong, for this. As I'm looking right now, the prices for Bitcoin just a little below 64,000, so call it roughly half of what it was at the highs just in the last 12 months alone. We're closer to the bottoms here at the 52-week range than the top. What exactly is your outlook for it, and how exactly are you navigating this kind of price action given your corporate balance sheet needs?
funding that's happening with AI. I think there's uncertainty with interest rates. There's uncertainty with wars around the world, and there's uncertainty with governmental legislation. We, as a company, went through this in 2022. Right? We actively manage our capital structure. We rotate into Bitcoin. We sell Bitcoin when we need to, and we'll continue to do so. And we'll get through this bear market. And what strategy is designed to do is to outperform Bitcoin in a bull cycle, which I expect to happen next year.
You mentioned those factors that were driving some of the downside action and sentiment. It wasn't that long ago that many of those factors were reasons to be in cryptocurrencies and specifically in Bitcoin. The fact that they were decentralized from traditional finance, the reasons because you didn't have some of the exposure to fiat currencies and some of the geopolitical aspects, cross-border transactions. Why that sentiment shift, and how do you get back to a zone where Bitcoin becomes one of those positive plays on those uncertainties yet again?
Yeah, I think that'll still be the case. The biggest catalyst that'll start to cause Bitcoin to move forward is legislative clarity. And what I mean is we need the SEC and the Treasury and the CFTC to move forward with a set of excellent rules that they have planned to allow tokenization of real-world assets, to allow stable coins to be implemented. What will happen then is large banks, and we've seen them, will start to move into this space, and that'll be a major catalyst for Bitcoin. And I think that'll also allow Bitcoin to be the inflation hedge that we expect it to be.
Following our graphic just showed that your average cost was $75,000 per Bitcoin, and we're at 63 today. So are you a forced seller of Bitcoin?
No, we're not a forced seller of Bitcoin. The average cost is not that important to us. It's really were our Bitcoin purchases accretive to our common shareholders and our Bitcoin per share, and they always have been. We're selling Bitcoin from time to time, and you know, we've shown that our Bitcoin sales are not really a major portion of what occurs in the market, but sometimes it makes sense to sell Bitcoin to add to our U.S. dollar reserve. Sometimes it makes sense to pay dividends, and that's what we've been doing.
When we spoke about this last time, the first time you had sold, you said it was to test the market. What is the rationale to shareholders for why selling Bitcoin gives them more value per share, when the original idea was that buying Bitcoin as it continues to move higher would give them kind of leveraged returns? Now, of course, your shares are down by half. What is the shareholder value you are creating by selling your Bitcoin here?
Well, I'll start with the big picture, right? The big picture is we have net 170,000 Bitcoin we've added this year. We've added over 35x the number of Bitcoin that we sold. So I think focusing on the sales of Bitcoin is really focusing on a very small amount. We've done in the last couple of weeks to pay dividends. We've done in the last few weeks to buy back Stretch, which is trading below par, and that's accretive to Bitcoin per share when we do that.
Michael Saylor, the chairman of your firm, has basically put on social media that, you know, while strategy has been a seller, to your point about some of the corporate machinations around your balance sheet. But Michael Saylor on X said, when I say never sell your Bitcoin, I speak as no one saver to another. I have never sold mine, not one Satoshi. Strategy is a public company, not my wallet. Since 2020, it has disclosed it may buy or sell Bitcoin and managed capital. Our shared conviction of Bitcoin remains unchanged. Michael Saylor says he's never personally done it. You have to do it for corporate purposes because of what you just mentioned. How exactly then do you view that future of it, given the fact that you may not have to operate with the same kinds of parameters that Chairman Saylor does?
Yeah, look, we have 842,000 Bitcoin. That's over 4% of the world's Bitcoin that will ever be mined. We're the largest institutional holder of Bitcoin. Last quarter, we passed BlackRock. We're the JP Morgan of the crypto economy. So whether we sell 1,000 Bitcoin out of 840,000, to me is irrelevant to the conversation. The conversation is, what is our role in Bitcoin? And are we adding Bitcoin per share overall to our shareholders? And are we creating value? I think that's an unequivocal yes.
Fong, you said that one of the reasons you sold the Bitcoin was to pay your dividend. Would you have been able to pay the dividend without selling the Bitcoin?
Yeah, we have over $4 billion of cash now on our balance sheet as a U.S. dollar reserve. We could use that to pay. We could use that to sell the Bitcoin to pay the dividend also.
And Fong, just how much? And I want to get this because this is not just about your firm. There is legislation tied up in Washington, D.C. right now, namely the Clarity Act. How important is the Clarity Act to not just yourselves, but the entire crypto industry for its path forward? And we're just showing some stats right now from Kalshi. Will the Senate vote on the Clarity Act before August recess? And the majority, 72% of respondents there at Kalshi, say no.
There is rulemaking behind the Clarity Act that has been put forth by Commissioner Atkins at the SEC, by the CFTC, Treasury Secretary Besant. There are rules ready to go, and they're either going to go with clarity, with the legislature behind them, or they're going to go without clarity with the power of the executive branch. So I think the most important thing is decision on clarity one way or the other, and the rules will get made.
All right, Fong, thanks. Really appreciate it. Good to check in with you again.
All right, thank you.
Fong Li, CEO of Strategy.
He helped break the Bank of England for $1 billion. He made another $1 billion shorting the yen. Now he runs the US Treasury. And the yen is his to save, but he can't. That's your problem too, because Japan is the largest foreign holder of US Treasuries. And when the biggest bidder steps back, then somebody has to replace him. And the price of a new buyer is a higher yield. And that's your mortgage. That's your 401k. Now, last month, $87 billion was spent in just 2 days, the largest currency defense ever recorded. And it only bought 5 trading sessions. And then all it took was one jobs report that cost no dollars, and it undid almost all of it in a single morning. Now, Scott Bessent made 2 fortunes, proving governments don't lose these fights when the vault runs dry. They lose when the defense costs more than it's worth. Now, Japan just hit that price. There's one number that tells you when this breaks wide open. Right now, it's reading 0. But in this video, I'm gonna break it all down. I wanna show you the choice that Japan can't afford to make. What's actually in America's war chest, because it's nowhere near the number you've been told. And we're gonna look at the Thursday number to watch, so you see it all break open before the market does. You ready? Let's go. All right, now before we jump into this video, let me just tell you why I think this video is not just important, but it's interesting. Now, first of all, we have Scott Bessent, who's made $1 billion multiple times from shorting currencies, now trying to save a currency, and he's using the same playbook. Now, I don't think I'm gonna make $1 billion, but I wanna understand the playbook so I can get on the same side as him, number one. Number two, because we're talking about defending currencies. So in order to defend a currency, it takes money flows. I have to sell certain assets and buy certain assets. And if I understand what assets are being sold, what assets are being bought, and then I can understand the playbook that Scott Bessent made to make $1 billion twice in a row, then hopefully I can get at least a part of that trade, and hopefully you can too. Okay, let's break this down. Currency defense, it's been happening over 5 days. Now, what we're seeing right now is the weakest yen since 1986. It's been about 40 years. Now, a lot of you are like, why do we even care about the yen? Well, there's a lot of reasons we care about the yen, which we're gonna break through in this video, and it all matters. So why the weakest yen? Well, like I said, it's 40 years it's been, it's the weakest it's been in 40 years. Now, there's a couple times in history where we've seen some massive intervention, not just with Tokyo and the yen, but with the United States. Just look at this chart real quick. Here we go all the way back to 1987. So from 87, we saw the yen getting stronger. It was sold back down. It was pretty weak through here. It got really strong. And right about here is where we're going to pick up this story. And we can see that it's been cascading ever since, obviously bouncing around a little bit. So we can see that the yen, it's been strong, it's been weak, and it's the weakest it's been in over 40 years. But we saw all of a sudden both Tokyo and the United States coming together to try to save the currency. Japan's been doing it on their own. Now the United States is coming. So on 7/30, July 30th, Tokyo started to intervene in the markets, trying to keep that currency propped up. The next day, the United States started joining in. Now, it's important to point out that this is the first time that the United States has gotten involved trying to prop up the Japanese currency, the yen, since June of 1998. All right, so it's a big deal. It's been a long time since the US has done this, and it's interesting to think about why this might have happened. Now we can just see, here's a chart that we made. This is the US dollar against the Japanese yen. And we can see this is just going back to July 20th, and we can see it's been sort of trading in this alone here. But we can see here back to July 30th is when Tokyo alone was trying to intervene in the markets, and you can see it dropping. Here we have the US starts joining in right around here, and they started bringing it back up just a little slowly. And unfortunately, we got this August 7th, the jobs report, and started smashed it again. So we're really trying to get this propped up. And as you can see it's been struggling to get ahead. Now look at this. This is the biggest one-day defense on record. What are we talking about defense? Well, we have to either buy or sell the currency, right? Supply and demand. There's more buyers than sellers, et cetera, right? And so the defense of the yen is to buy it to make it strong. If I sell it, it makes it weak, right? So this is the biggest one-day defense on record. Here we have October 21, 2022, 5.6 trillion yen. 2024, this is 5.9 trillion. 2026, April of this year, 6.2 trillion. And now just July 2026, about almost 8.5 trillion yen. Now this is about 60 billion US dollars. But notice this is just all in the last 4 years. So the biggest defense numbers on the yen in history have all been happening in the last 4 years. And if you notice, they're starting to happen more frequently and more frequently and more frequently, which means that the yen is continuing to get weaker and weaker and weaker. 87 billion, the largest defense on records. And with all of that work being done to prop it up, like I said, it just took one jobs report to smash that back down. So we are $87 billion was spent here. And then the jobs report cost zero. There was no defense needed. That was just reality. It's the reality of the economy. And no matter what the intervention is doing, it's smashing it back down. Now, it all comes down, as I said, to one number. We're going to come back to it then, but we're talking about this Fed report, H41. I'm going to show you what that Fed report is and why you should be watching it like I am. We're going to come back to that. Okay, now let's just jump back to the man himself for a second. I'm talking about Scott Bessent. Scott Bessent isn't just the U.S. Treasury Secretary, which he is. He's the man that's in charge of selling U.S. debt to the world, the largest, deepest, most important financial asset in the world, the bedrock of the global financial system. But Scott Bessent has been playing this game long before he got to be the Secretary of the Treasury. Scott Bessent has been around some of the biggest circles. As I said in the intro, he's made $1 billion twice. All right, what are we talking about? Let's go back to September 1992. This is when George Soros got famous for making $1 billion in a single day by breaking the Bank of England. He broke a bank. How? By fighting against the currency. This was known as Black Wednesday. Look it up. The big day, Black Wednesday, they broke the bank. Now, this was George Soros under their London fund, okay? Now, a couple other names that I've talked about on this channel quite regularly. So George Soros Fund, the London Fund, Stanley Druckenmiller, or Druck, we call him the GOAT. He's the greatest of all time, the best track record, no losing years, all those things. And Scott Bessent, he was 29 years old at the time. So George Soros, now, George Soros politically, there's a lot of reasons why we should not like him. But financially, he's made a lot of money. And so we want to understand those things. But Stanley Druckenmiller is the GOAT. And Scott Bessent, young, 29, executing this trade, again, made $1 billion in a day. Now, what they were doing is they were watching Britain's and they were watching the Bank of England's reserves. They're looking at how much money they had to defend their position. But Bessent, Scott Bessent, he was doing something different. He was watching something completely different, a different number. What he was watching specifically was Britain's variable rate mortgages. See, in the United States, we have 30-year fixed mortgages, but the rest of the world, they don't have that. And so Britain had variable rate mortgages. And what was happening is, as the Bank of England was trying to protect their pound, they kept raising prices. So at 9 a.m., the rates were at 10%. By 11 a.m., just 2 hours later, they had to raise to 12%, trying to protect that peg. Here we are by 2:15 p.m., they got to 15%. And then before it even got implemented, they canceled it and it round tripped all the way back down. Why? Well, the reason why is because while it was trying to protect their markets, they were crushing the consumers. So the rule, all governments are always going to be forced to abide by this rule, is they're always going to have to make a choice. It's always going to be sacrifice one to save the other, right? And so in this instance, back in the Bank of England, they either had to sacrifice the pound, save the currency, or they had to sacrifice the homeowners, the households, the consumers. So they voted to let the currency die, the currency loses. What does that mean when the currency dies, the currency loses? That means it gets devalued. That means they have to print so much of it that all the existing currency buys you less and less and less. So it looks like prices going up, but it's just because they printed so much. The currency loses out in order to save the households in that instance. Okay, well, let's just look at one more playbook, because Bessent didn't just do this once. He's the mastermind architect of all kinds of foreign currency games. He made a lot of money. We're just talking about two of them, the billion-dollar ones. And here we are in 2013. Now, this was in Japan with the yen. Surprise, surprise. And this was in an era that was kind of kicked off called Abenomics. And basically, they wanted to bring the yen down. They would need to devalue the yen. And so what Scott Bessent did is he said, hey, we'll short it down, but we'll do it with you. So we're not attacking it. With the Bank of England, they were attacking the peg, they broke the peg. But here, they wanted to do it with them. We're gonna go ahead and short that with you and bring that down. Now, if you look at this, remember I said we'd come back to this chart. So you can see right here, about 2013-ish, right here, is when, hey, we need to get this down, and they did. So Scott Bessent shorted this move with Japan and made $1 billion. How did Scott Bessent know to make this move? Well, he knows that, again, like I said, the rule, when a country is faced with a fork, should we either save the currency or do we save the bond market? We can't do both. So which ones do we do? He knows that it's always going to be the currency that's sacrificed. And so which side of the fork is going to be sacrificed? And then he trades it with them. If you can't beat them, join them. He understands the dilemma that they're in. He understands the choice that they're going to make, and he positions himself to trade with that. So they could either, Japan was forced in this era to either save the currency, but the problem is They had debt, the bond market, the government owed debt, 236% debt to GDP, crazy high, 236% debt to GDP. So if they raised the interest rate, they had to pay real interest on that amount, which they couldn't afford. So do we do that, or do we save the bond market? And then the currency just keeps falling down. Remember, they have to print it up. The currency supply expands, and it buys less and less goods. And of course, they sacrifice the currency. Scott Bessent shorted all the way down, and of course, made another $1 billion. Now, that's the playbook. You understand the dilemma. You watch the indicators, because if we're shorting the market and being wrong on timing is still being wrong. So you have to understand the indicators, to understand what's going on, to understand how to position. You need efficacy, but you also need the ammunition to do it. So Scott Bessent tells us it's policy that turns it. And I'm just going to say this real quick. I'm not trying to make this political at all. It shouldn't be political at all. But the previous chair at the Fed, the previous Secretary Treasury, they were both academics. Jerome Powell at the Fed, he wasn't even a finance guy. He was an attorney. Janet Yellen, who was at the Treasury, was an academic. So she studied a lot of theory, but she never practiced in the real world. And Mike Tyson said everyone has a plan until they get punched in the face. And it's easy to teach in theory, but until you've actually tried to apply that theory in the real world, until you've had to compete with the best of the best, until you've been punched in the face, as Mike Tyson would say, you don't really know it, right? There's a difference of knowing information, repeating back theory versus struggling with it, learning with it. And so Janet Yellen, she had the theory, but she never actually practiced. She never made money. She never had to compete with this. Scott Bessent was at the highest level in the world, like running the biggest fund, George Soros fund, with Druckenmiller, with the GOAT. And he made $1 billion in a single trade a couple of times. So the level of competence that we have in that position hasn't been seen in my lifetime at all. And so we want to pay attention to what he's saying. He's telegraphing, he's telling us, he's showing us the place. So he says that it's policy. We can see one thing that I really love about Scott Bessent and Kevin Warsh, they're in the media a lot. We can listen directly to them a lot. You should listen directly to what they're saying. He says, Secretary Bessent says, a stable yen is important, not just for the US, but for the entire region. So it's very important. They're going to do a lot to prop up, to save that currency. Okay, so we have to understand it's super important to them. They're going to be doing that. Now, how? How will they do that? Well, the Exchange Stabilization Fund. Now, this is as of June 30th of this year. And what this shows us is that there's about $217 billion in total assets to stabilize exchange rates. What it sounds like, right? About $217 billion in ammunition. But the problem is about $172 billion of that is already accounted for in the SDR book. These are special drawing rights. This is what the IMF has, okay? That's already accounted for, which leaves only about $43 billion as a net position that they have to work with. But it's even less than that because only about $18.8 billion is spendable foreign currency. And within that, about $13 billion is euro and about $5 billion is yen. Okay, so this is the ammunition, as I say, in order to do this. But the problem is that they have $18 billion, but they just spent $87 billion in 2 days defending it, and it didn't even work. That just gives you the magnitude of the problem that they have and the amount of ammunition they had to deal with this. Now, it was kind of funny. They're spending all of it to try to defend it, and it's not going to be enough. But it's kind of funny. At Camp David, Scott Bessent was there, and he got photographed. Someone caught him, some paparazzi caught him with his legal pad, with a notepad out. And on that notepad, on that legal pad, he had reminders, tasks, things to do. And it said, to do, buy Japanese yen, 5 to 10 billion. They're propping it up. They were selling euros, because they don't want to hurt the dollar, selling the euros down to buy the Japanese yen up. They're telegraphing. They're telling us what they're doing. They're telling you how important it is. They want to stabilize it. It's the first time they've worked together in decades. Okay, now, they have a facility that they've set up to really set this up. I'm going to get into the technicality of it. I think of it like this. It's like I have kids. If you have kids, my kids drive, they're out and about. I want them to have some emergency money, so they have credit cards. Now, they're not really supposed to use those, but if they get into an emergency, they have them. They don't need to call me if, I don't answer, I'm sleeping, whatever, I'm out in the water surfing. They don't need to call me, get a hold of me. They don't need me to make a decision. They don't need me to go drive and meet them or Western Union. They just have the card. It's there. As soon as they need it, they can swipe it. And so that's what's happening. We have these facilities that are being set up that allows them to draw on them if they need them, emergency facilities. So we have this FEMA, the FEMA usage, and we'll talk about when it was set up and how it's been used, but just so you can understand what it is, the FEMA is the Foreign and International Monetary Authority repo facility. So that's the FEMA, Foreign and International Monetary Authority. It's a central bank lending tool created by the Federal Reserve, by the U.S. Federal Reserve, and it allows approved foreign central banks and international monetary authorities, so central banks like the Bank of Japan, to temporarily exchange their U.S. Treasury securities for U.S. dollars. And so this acts as, it says here, an emergency liquidity backstop, but without forcing them to sell Treasury in the open market. Why? Because Japan is sitting on a bunch of U.S. Treasuries. And if they need money, they could just sell the U.S. Treasuries. But if they sell the U.S. Treasuries, then what does that do to the U.S. currency? And so they don't want them to do that. So rather than having to sell the U.S. dollars to prop up the yen, they can just get access to the money without having to do it. They can exchange it. So it's basically a collateralized loan. It's like a pawn shop, right? I'll give you collateral, you give me the money. And foreign institutions pledge U.S. Treasuries held the Federal Reserve in collateral for overnight U.S. dollar cash. And it's a market stabilization designed to calm global dollar shortages and prevent sudden disruptive sell-offs of U.S. government debt by foreign official bank. Okay, so you kind of get what it is. So it's sort of like again, giving my kids the credit card. Now, in 2020, they set it up, and we've seen like a little blip right here. It was used a little bit in 2020. Where we really saw this big blip was right here. Now, it's important to note that there's a $60 billion, let me write that here, $60 billion cap on this fund. In 2023, we saw it actually go all the way up and touch the cap. What happened in 2023? If you can remember back, the Federal Reserve, Jerome Powell, in 2022 started raising rates, one of the fastest rate hiking cycle in history, and it caused 3 banks to collapse in 2023. It was the big Silicon Valley Bank was the big one that went under. And a lot of banks were in trouble. Why? Well, because they had a mismatch on duration. They took in customer deposits. Customer deposits are due on demand. So at any time you should be able to go get the money out of the bank. But then they take that money and they put it into long-term treasuries. So they may lock it up for 5, 10, 20, 30 years at a time. And the problem is because they raised rates so fast, the value of those bonds had collapsed. And so when depositors asked for their money, the banks were forced to sell the treasuries at a loss. They went bankrupt, went out of business, 3 banks, and other banks were hurt and they had to draw on that facility. We can see that. And now here we are right here, and it's effectively at 0. Effectively at 0. So it's there, it's ready to go, but it's at 0. Now, Basent is urging to upsize this. So this is what everyone's kind of getting all caught up in. Everyone's predicting it in the world. Like, oh my God, Scott Basent said that we need to upsize it. Yeah. He wants to be ready, because what happens if we need more than that? We want to be ready again, like giving my kids the credit card in advance. Now, I put this as a marker here because in 2022, I think it was 2022, I made a couple videos talking about the collapse of FTX, which was a crypto exchange. And at the time when I was talking about FTX and what caused them to collapse, I sort of compared their currency, the FTT token that caused them to collapse, to the Japanese yen. Interesting. And the reason why is what happened is FTX had created their own currency, sort of like Japan has their own currency. And I think it was a tweet that was posted from CZ from Binance because he was going to buy it. And he's like, no, I'm not going to buy it, which caused it to start selling off. And FTX was forced to defend the currency, the token. How do they do it? They have to buy it in the market. They have to step in and start buying it by bill biting pressure. But how do they buy it when they don't have any money? Well, they have to start selling things. They had to start liquidating their positions to buy the FTT token to keep it propped up as everyone else was trying to get out and sell it. Everyone's trying to unwind their position. So they're trying to absorb it. They're trying to buy it all. And at the time, I talked to sort of like the Japanese yen. Japan has to sell assets like U.S. Treasuries or get some sort of funding like this through FEMA to buy their token, to buy their currency back up. Now, what's interesting is we can see that the IMF is warning this, and I think this is real interesting. The IMF is basically saying, hey, hang on. If you do this, you can potentially lose your free floating rate. That says that your currency is free floating. A floating exchange rate can be classified as free floating if intervention occurs only once in a while, only exceptionally. But if you mess with it too much, it's no longer free, and you got to be careful for that. So the IMF is giving that warning. Okay, now what's really driving all this? Well, you've heard multiple people talk videos about this. I haven't really made a lot of videos. I don't find it particularly interesting, but the Japan carry trade. A carry trade is basically arbitrage, right? So I borrow low, I borrow 1%, and I put it into something making 5%, and I make a 4% spread, right? So it's like a carry trade. But the carry trade has been massive because Japan has kept their rates artificially low, 0%, 1%, and someone could just take $100 million, $1 billion, $100 billion at 0% or 1% and put it in US Treasuries at 4 or 5% and just make the spread, right? So of course people do that. And so this carry trade though has been closing. Now this is starting a massive unwind and it's getting these currencies to start moving, which is what's behind all this. Now if we take a look at this, we can see this is the carry trade right here. The US 10-year yield minus the Japan 10-year yield, which would give you the arbitrage, which would give you the spread. And you can see we're all the way up here at about 4%, a 4% positive carry, October of 2023. But you can see this yellow line has been dwindling down, dwindling down, dwindling down. And right now we're at about 1.9. All right. So a lot of people that have this open, have billions of dollars open on that positive carry, trying to make 4%, are now unwinding it, closing their positions because it keeps dropping, 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 dropping. And that's forcing all of this to unwind, which is then causing all the currencies to move. And we see the BOJ has raised their rates 5 times, which is what's causing that window to collapse. They've raised them 5 times to get them all the way to 1%. I'm going to talk about that 1% in a second. And it's cut that gap in half from the 3.9, they were making 4% spread, to now less than 2%. Now, what's interesting is the rate change like that should favor the yen, but it's not. And the reason why it's not is because the bond market is seeing fiscal risk there. So we can see that the currency isn't listening to what the rates are saying. There's a disconnect. And so where are we talking about? Well, let me show you how big this disconnect is. Take a look at this. This is a chart of government debt and 30-year bond yields. Now, you would imagine that the more risk somebody has, the higher the rate of return they're going to want if you loan them money, right? That's why when you get a house, a car loan, whatever, they look at your credit worthiness, and depending on how good your credit is, you get a higher or lower rate. And so what we have here is this fitted line, if you will. And over here on the left is low debt, debt to GDP. This is 60% debt to GDP. And this is higher debt to GDP over here, 220%. This is the rate that they pay, 7% here, 3.5 here. So Germany is all the way here on the left. They pay 3.8%, and they have about 60% debt to GDP. On the other end, well, we have the United States, 5.25%, and about 120% debt to GDP. United Kingdom, Euro, Canada are in between that. But way out here, 220% debt to GDP is Japan at only 3.9. So something doesn't add up. How is a country that's so far indebted, more than double what the United States is, without near the economic power, economic might the United States has or any of the other things, and they're paying 3.9? So the question is, what happens with this? Does this have to start catching up to this fitment line? Now, this is no forecast tool, but it just goes to show you how disconnected these things are. As traders start to recognize this and start to shift, they're going to start to position. They're going to realize that the Japanese debt is way too cheap, and we can already see this. There was 163,000 contracts that were shorting this, and they've already started to unwind. 45,000 of those contracts have already been dropped off. Okay, so what's really driving this? And more specifically, now that we know this, what do we do about it? How did Scott Bessent make billions of dollars, and what should we be doing if we want to make some money with this, or we want to be in the right place with our money? Well, we want to understand that Japan is at a fork in the road. Just like every other nation in the world is at a fork in the road. And they're all going to be forced to make the same decision. Fork 1, the currency, or fork 2, the bond market. You're either going to pay the debt that you owe, or you're going to destroy the currency. Those are the only two choices. And there's no country in the history of the world that's ever decided, well, let's just not pay our debts when they can just print the money and they can print their own currency. And so the currency is going to be the one that's going to fail every single time. Now, if Japan forces that, then the US is going to have a problem because the US is going to have to replace the highest bidder. So Japan, so take a look at this chart, and this is why Scott Bessent and the US wants to protect Japan so much, is because this is a chart of the largest foreign holders of US debt, US Treasuries. Japan is right here as the largest holder with over $1.1 trillion. And then we have the United Kingdom, $948 billion, China, $659 billion, Belgium, $472, Cayman Islands, $471. Okay, but look how far Japan is. They're the largest buyer. So what happens if they can no longer buy that US debt, or they can't buy it and they're selling it at the same time? Well, that's a problem. The US is going to have to replace Japan as a buyer and potentially a holder at the same time. What does that mean? Well, that means that they are going to have to pay higher rates in order to attract that capital. What does that mean? Well, that means your mortgage. That means your credit lines, your business credit lines, your business credit cards, your auto loans, all of that. It's also your portfolio, because the price of your portfolio has to do with the real rates. Okay, we have to understand that in order to protect this, we have a third branch. So certainly we have the Treasury and we have the Fed, but we have this third facility, is this FEMA facility, as we talked about it. It's the one that's stuck at 60 billion cap. Scott Bessent's trying to get raised right now. It's the credit card I give my kids. And what we want to do is we want to watch one single number, and it comes out every Thursday. The number that we want to watch every Thursday is this. It's on that Fed report I told you we'd come back to at the very beginning. It's called the H41. And what this shows us is the repurchase agreements of foreign officials. And here we can see for the 8th consecutive week, it's at 0. Right now, it's not being tapped. But as soon as it is being tapped, we can start to expect this to start accelerating. All of this is in motion. It's math. It's there. It's fixed. We can see the intervention. We have Scott Bessent on TV talking about trying to raise the rates. It's not happening yet. And being early is the same as being wrong. So we're going to watch that number. We're going to keep an eye on the US dollar and the Japanese yen to understand which assets are being sold, which assets are being bought, and which way the money is going to flow. Hopefully that makes sense to you. Leave me a comment down below if you have any questions about this. Of course, as I always say, to your success. I'm out.
It does feel inevitable. It does feel like it's coming. I think the only question is whether that pace that we get there is linear or exponential. The largest product that we have is, of course, the iShares Bitcoin Trust IBIT, which was launched in early 2024. When it was launched, the rough demand was roughly 80% retail and 20% institutional. And over time, if you think about it, come into today, it's become roughly 50-50. So I would say the institutional adoption has actually been increasing.
I have heard some cool stories about Larry Fink and his journey into Bitcoin.
I think we all know that he used to call it pirate money, but I think the mental flexibility to look at the facts and come around is something that we should all applaud and commend.
European institutional investor base is massive, obviously, but also very fixed income focused. European fixed income, it's very much a fixed income culture. You got all the massive pension funds, all heavily weighted towards fixed income instruments. Kind of hard to get yield right now. I mean, I was in high yield credit for a long time, and high yield credit is basically very low yields these days. So I think that in itself is a big opportunity set.
Think about the scale of AI. How is AI going to use this? People just think that AI is just going to use it to pay. But what is AI? What do robots need? What do people need on a global network, a true extension of the internet? AI wants to use it for validation, authentication, accessing data, and they need to have it happen at the blink of an eye. In other words, money, which is trust, especially for agents and robots, needs to move at the speed of intelligence. You're not going to get that with Visa and MasterCard, but you're going to get that by being able to send, 1/1000th to 1/10,000th of a penny working sats with the blink of an eye to validate. And effectively, the Bitcoin address that they can validate that they have becomes the agent's agentic soul.
But again, Bitcoin can and will only ever be that safe haven in those types of environments if Bitcoin is viewed by the masses, by traders, as a currency. And unfortunately, we've kind of, as Bitcoiners, shot ourselves in the foot a little bit by calling Bitcoin digital gold, a digital store of value, rather than calling it what it truly is, the most perfect form of money that humanity has ever conceived.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
Let's talk about where we're at in the cycle and what this potentially does. You've been around a long time. This is my, I guess, third deep bear market that I've gone through, 2018, 2022, here we are. There's a lot of people who have been in the space a long time, like a mutual friend of ours, Parker Lewis. I mean, I had a phone call with him a few weeks ago, and he's just like, man, this is the worst I've ever seen it, And so after going through 3 cycles, to me, they're all bad, but they're different. Right?
Yes.
It's like, I don't know if this is the worst one. I mean, the other ones are really bad too, but it's different. It's like before it was Mt. Gox, now it's FTX, now it's this one, well, now it's the suit coiner, it's always like something different. So I'm just curious, number one, do you think this cycle is different? And is this cold card sort of going to be like the impact or the mark on this one?
It is different. I feel like every bear market is different. There's always a different problem that we're dealing with. Every bull market, I feel, is like the exact same. It's like, everyone's getting girlfriends, everyone's making money, like, making bad decisions, their risk is piling up. Like, they're almost always the same, I find. But yeah, bear markets always feel different. I totally agree. And there's always a narrative, I think, around the bear market that, like, here's the reason that the price is low or whatever. And I think in prior markets, it has been, FTX, fraud, scammy behavior, crypto, more generally, people losing faith and trust. I think in prior cycles, you've seen things like Bitcoin fork drama, like other things, pandemic, of course, like being a massive macro driver of bad outcomes on Bitcoin price. And there's always fear, and there's blaming to some degree, a lot of times in bear markets, but there's always a ton of building too. So in those senses, this feels comparable. I think one difference that I see that is particularly maybe scary for some people is there's a sense in which Bitcoin doesn't feel as new and shiny and as cool anymore. That feels to be very widespread. Of course, it's AI that is now the thing, right? That is absorbing people's attention, their capital, their time. It's not just technologists in San Francisco. It is investors. It is acquirers. It is banks. It is financial institutions. Everybody is putting that acquisitive energy, that inquisitive energy towards this new technology. And Bitcoiners are not immune to this, right? There's a theme that is that I've seen in numerous places in the Bitcoin communities is Bitcoiners getting together to ostensibly talk about Bitcoin, but instead talking about AI. And I've seen that at Bitcoin meetups. I've seen that at Bitcoin conferences, at the Bitcoin conference in Las Vegas earlier this year. I mostly talked about AI with the other Bitcoiners that I ran into because it's a thing that's happening in the world that's extremely exciting, scary, relevant, impactful. So of course we're talking about it. Moreover, I think there are so many Bitcoiners who have turned to AI, whether avocationally or professionally, as like the thing that is absorbing all of their time. And that feels scary to watch somebody that was obsessed with this thing, Bitcoin, for many years, suddenly get obsessed with a new thing. Does that mean the old thing is going away? Like it can feel a little bit uncomfortable, I think, to watch nerds get sniped by a new thing, right? To me, of course, it's very predictable, right? Like the kind of person who got nerd sniped by Bitcoin is very easy to nerd snipe with AI. There's a lot of commonalities. They're both powerful, cool digital technologies. And I think combined with the fact that you're starting to see now large banks and other financial institutions make meaningful inroads into Bitcoin, like for real, not just nominatively or to placate, something, but like to actually build products in these spaces and to get involved. There's almost this feeling of like Bitcoin is boring and mainstream now, and I don't like that, and that's making me uncomfortable. And I've seen that expressed, maybe not so directly, but I've seen that. I feel like that emotion is animating a lot of people's reactions right now. So to some degree, my own. I'm sometimes shocked to hear that so and so is now leaving Bitcoin to work on an AI company. Occasionally, that guy, no way. But then I also kind of remind myself of like, it had to be this way, right? Like this is what success looks like. If Bitcoin becomes the world's money, it's not like the coolest technology anymore. It's just invisible. It's just part of the world now. And it's built into massive, companies and infrastructure. And as we were saying earlier, professional classes, like boring people are choosing to study Bitcoin because they feel like it might get them a good, dependable job one day, right? Like, so on some level, I'm trying to put away my emotional reaction to, hey, why isn't anybody paying attention to Bitcoin today? Why are they all obsessed with it? Hey, why am I so interested in AI? I'm trying to put that away and remember that like, that's actually really good because Bitcoin doesn't seem to care that people are doing that. Bitcoin is still doing its thing. Like it's still making blocks every 10 minutes. The price is doing what it does. Bitcoin miners are still mining despite, AI competing for some of their, infrastructure and energy and capabilities. So overall, I try to just remind myself that like, it's kind of amazing that like Bitcoin doesn't even need the Bitcoiners anymore on some level. That's not quite true. I think Bitcoin has a lot of changes and stuff that has to improve over time, but it's just, it feels like it's okay. That's my message to Bitcoiners. Guys, if you want to work on AI, it's okay. Like Bitcoin will survive. It's very robust. And for those that still want to stay in Bitcoin like me, who view AI as a tool to achieve our goals in Bitcoin rather than a thing to go study for itself, it couldn't be more exciting. Like AI is scary because it allows attackers to do terrible things like what we've seen this past couple of weeks with Cold Card, but it's incredibly empowering. It allows me and other people to achieve things we couldn't possibly have achieved as quickly as we seem to be doing them now. So I remain excited, I guess. And I, for better or worse, I still believe in the cycle. And I still think in a couple of years, the Bitcoin price will be up again. And there'll be a narrative as to why that happened. I don't know. Maybe it'll have something to do with AI. The AIs will realize finally that Bitcoin is the money that they should be using, et cetera, et cetera. I'm not sure.
Well, I think I was just talking this morning actually to my nephew who's quite a bit younger in his early 20s. And I was telling him how my first real business I had, when I say real business, like I actually had an office and I was like hiring people, was 1997. That was like pre-internet. It was pre-internet, right? We were just at the sort of like the dot-com run-up, 2000 dot-com blew off, obviously. In 2001, I started an internet company, and it was an e-commerce company. I went to these companies, and it was not easy to build a shopping cart. I used like this Miva merchant. There was like no Shopify, whatever. It was like 25 grand to get like the most basic like e-commerce thing set up.
Sure.
And I went to these companies. I said, hey, I built this e-commerce website. I want to sell your products. This is in 2001. And they laughed at me, and they told me no one's ever going to buy anything online.
Sure.
Which is insane when you hear that story, but that's what happened. And I said, well, I'll give you the money. I'll be at risk. And like, we don't even want our products on because it had this like stigma of being blown up and this ridiculousness, et cetera. And, even before the blow up, I was day trading these things called internet stocks. We were trading these things, but there's no such thing as internet stocks today. There's no such thing as internet companies today, right? The internet has just gone into the background.
It's just the world now. Yeah.
But it's certainly bigger. It's certainly more powerful. There's certainly more people working in the internet than there ever were back then. It's just not its own class. And so sometimes I try to keep that frame in mind when I think about Bitcoin. I remember I used to go to Consensus, which was the crypto conference before the Bitcoin conference. And I remember the last time I went there was in Austin, and it was like, oh, video games on the blockchain, and then supply chain on the blockchain, and real estate on the blockchain. I'm like, go to a real estate conference, go to a video game conference, like whatever, right? And so it's sort of, and I realized at that point, like crypto's gone. Not that it disappears, it just goes into the background like the internet does. And I think maybe part of, Bitcoin sort of like that, it's money. And it's not going to go away. It's going to continue to get bigger, but it's not like its own thing. Like the internet's not its own thing anymore. Everyone just uses the internet, right? I also think about, we have that diffusion of innovation, which shows how technology the innovation gets diffused out to the mainstream. And you have those innovators, and these are the people who invented it. And then you have the early adopters, and those are the cool kids, the counterculture early adopters. And then the early majority comes, and we're certainly in that stage. You said, Wall Street is certainly here. And so now it's like, well, early majority's here. But then like the early adopters, it's gentrified now. Like it's not cool anymore. It's not counterculture. Maybe that's part of it, but it certainly doesn't mean it goes away. It certainly doesn't mean it stops growing.
People I don't like are using Bitcoin now.
Yeah.
So I'm done with Bitcoin. It's like, well, what do you expect?
All right, welcome back. Checking on shares of Strategy higher after the company sold more than 1,600 Bitcoins last week, raising roughly $105 million. Now, it's part of a major overhaul aimed at shoring up Strategy's finances and rebuilding some investor confidence, including buying back preferred stock. So will Strategy's strategy work? Joining us now for a first on CNBC interview is Strategy CEO Phong Le. Thank you so much for joining us, Phong, for this. As I'm looking right now, the prices for Bitcoin just a little below 64,000, so call it roughly half of what it was at the highs just in the last 12 months alone. We're closer to the bottoms here at the 52-week range than the top. What exactly is your outlook for it, and how exactly are you navigating this kind of price action given your corporate balance sheet needs?
Yeah, look, I think Bitcoin is going through a bear cycle right now, and some of that is external macroeconomic. I think there's a major funding that's happening with AI. I think there's uncertainty with interest rates. There's uncertainty with wars around the world, and there's uncertainty with governmental legislation. We, as a company, went through this in 2022. Right? We actively manage our capital structure. We rotate into Bitcoin. We sell Bitcoin when we need to, and we'll continue to do so. And we'll get through this bear market. And what strategy is designed to do is to outperform Bitcoin in a bull cycle, which I expect to happen next year.
You mentioned those factors that were driving some of the downside action and sentiment. It wasn't that long ago that many of those factors were reasons to be in cryptocurrencies and specifically in Bitcoin. The fact that they were decentralized from traditional finance, the reasons because you didn't have some of the exposure to fiat currencies and some of the geopolitical aspects, cross-border transactions. Why that sentiment shift, and how do you get back to a zone where Bitcoin becomes one of those positive plays on those uncertainties yet again?
Yeah, I think that'll still be the case. The biggest catalyst that will start to cause Bitcoin to move forward is legislative clarity. And what I mean is we need the SEC and the Treasury and the CFTC to move forward with a set of excellent rules that they have planned to allow tokenization of real-world assets, to allow stable coins to be implemented. What will happen then is large banks, and we've seen them, will start to move into this space, and that'll be a major catalyst for Bitcoin. And I think that'll also allow Bitcoin to be the inflation hedge that we expect it to be.
Phong, our graphic just showed that your average cost was $75,000 per Bitcoin, and we're at 63 today. So are you a forced seller of Bitcoin?
No, we're not a forced seller of Bitcoin. The average cost is not that important to us. It's really was where our Bitcoin purchases accrue US dollar reserves. Sometimes it makes sense to pay dividends, and that's what we've been doing.
When we spoke about this last time, the first time you had sold, you said it was to test the market. What is the rationale to shareholders for why selling Bitcoin gives them more value per share, when the original idea was that buying Bitcoin as it continues to move higher would give them kind of leveraged returns? Now, of course, your shares are down by half. What is the shareholder value you're creating by selling your Bitcoin here?
Well, I'll start with the big picture, right? The big picture is we have net 170,000 Bitcoin we've added this year. We've added over 35x the number of Bitcoin that we sold. So I think focusing on the sales of Bitcoin is really focusing on a very small amount. We've done it in the last couple of weeks to pay dividends. We've done it in the last few weeks to buy back Stretch, which is trading below par, and that's accretive to Bitcoin per share when we do that.
Michael Saylor, the chairman of your firm, has basically put on social media that, while strategy has been a seller, to your point about some of the corporate machinations around your balance sheet, but Michael Saylor on X said, when I say never sell your Bitcoin, I speak as no one saver to another. I have never sold mine, not one Satoshi. Strategy is a public company, not my wallet. Since 2020, it has disclosed it may buy or sell Bitcoin and manage capital. Our shared conviction of Bitcoin remains unchanged. Michael Saylor says he's never personally done it. You have to do it for corporate purposes because of what you just mentioned. How exactly then do you view that future of it, given the fact that you may not have to operate with the same kinds of parameters that Chairman Saylor does?
Yeah, look, we have 842,000 Bitcoin. That's over 4% of the world's Bitcoin that will ever be mined. We're the largest institutional holder of Bitcoin. In the last quarter, we passed BlackRock. We're the JP Morgan of the crypto economy. So whether we sell 1,000 Bitcoin out of 840,000, to me, is irrelevant to the conversation. The conversation is, what is our role in Bitcoin? And are we adding Bitcoin per share overall to our shareholders? And are we creating value? I think that's an unequivocal yes.
Fong, you said that one of the reasons you sold the Bitcoin was to pay your dividend. Would you have been able to pay the dividend without selling the Bitcoin?
Yeah, we have over $4 billion of cash now on our balance sheet as a U.S. dollar reserve. We could use that to pay. We could use that to sell the Bitcoin to pay the dividend also.
And Fong, just how much, and I want to get this because this is not just about your firm. There is legislation tied up in Washington, D.C. right now, namely the Clarity Act. How important is the Clarity Act to not just yourselves, but the entire crypto industry for its path forward? And we're just showing some stats right now from Kalshi. Will the Senate vote on the Clarity Act before August recess? And the majority, 72% of respondents there at Kalshi, say no.
There is rulemaking behind the Clarity Act that has been put forth by Commissioner Atkins at the SEC the CFTC, Treasury Secretary Besant, there are rules ready to go, and they're either going to go with clarity with the legislature behind them, or they're going to go without clarity with the power of the executive branch. So I think the most important thing is decision on clarity one way or the other, and the rules will get made.
All right, Fong, thanks. Really appreciate it. Good to check in with you again.
All right, thank you.
Fong Li, CEO of Strategy.
All right, everybody, welcome back to another week of BFC Live. I am joined today by Tracy Hoyos Lopez, Head of Strategic Initiatives at Kraken Institutional, and Michelle Weekly, Director of Product Development at Byte Federal. Ladies, thanks for joining me today.
It's so awesome to be here.
Okay, it has been a big week, big couple weeks in Bitcoin. Definitely bear market vibes. Feels like we might have gone through our obligatory black swan event. I want to start with cold card. For those that might not be self-custody professionals, I would include myself in that, that really don't understand what happened. Michelle, could you start by just giving us like a high-level view, like what happened, and we'll kind of jump off the conversation there.
Yeah, absolutely. So first and foremost, I just want to say that if anybody is self-custody their Bitcoin in a cold card and you're aware of this news, you want to get on X, get on Twitter, what's going on. Don't panic, but you do need to move funds off of your cold card very so that's the most important thing. The Bitcoin community has done a great job at getting the message out there, but a lot of people are not frontline. And so if you have a cold card and you have any Bitcoin in there, you need to do it as quickly as you're able to do so. So what happened is
Sorry, Michelle, I just want to say a quick shout out and sincere thank you to Alex Thorne from Galaxy, who has been working full time to help people that have been affected by this in the community. So Alex, thank you so much for helping everybody out. It's it means the world to all of us.
Yeah, absolutely. Rob Ham as well. There's been a handful of people who have really just stayed straight now, been helping people endlessly, and they deserve all the credit in the world. Going back to 2021, there was an error in Coin's code that basically set your seed phrase up in a way. It's a bug to the entropy, and it means that your seed phrase is not very strong. It could actually be weaker than a 2-word password, depending on exactly what firmware you're on. So there are details out there if you want to dig into devices were affected, the timeline as to when it was introduced. There are some conspiracies that are building. There is a little bit of proof of some of those conspiracies. But ultimately, there was a bug in the firmware on cold cards that shipped in 2021 and after. And any cold card that was generated using the default seed phrase path, meaning you didn't roll dice to create entropy, your seed phrase is not safe and your funds can be swept. There's a couple of unverified rumors that even if you did roll dice, there may be backdoors. I don't know what credibility there is there, but ultimately I think using a cold card, it's just safest to migrate to a different device or setup.
Got it. So, okay, before we get into
Also, just to give people an idea, and Jake, you mentioned, oh, we're in the bear market. I've had feels this feels a little bit like 22, but also not, because it's so everything that's happening is so completely unprecedented. But 1,616 Bitcoin across more than 5,200 addresses in multiple waves. That's what's been affected with this particular issue. What Michelle and I were also saying, and like we can get into the conspiracies or not, is I think the thing that has really like blown me away has just been how absolutely nasty so many people in the community have been to those who are not tech savvy. I mean, Isabella yesterday got ripped apart. I can't remember what his name is, but like, you know, either Bitcoin is for everyone or it's not.
Yeah.
But it's not okay to rip people apart for not being technologically savvy to deal with this. And it's not okay to go and attack people that have been in the industry for a while, assisting in that hyper Bitcoinization vision that we all have. And like, it's just not okay to be disrespectful, and it's not okay to like say nasty things to them or about them or completely attack them or say things like, oh, you deserve it because you don't know how to deal with a cold card. Well, you know what? The product sucks.
I couldn't agree with that more.
Like if it's a product that exists and you have to have technical background to use it, then it's only a product for technical people. Then don't sell it to anybody else.
Yeah, Tracy, I couldn't agree with that more. If the device had been coded correct, then the faulty path would have never been available. If you said, I'm not comfortable rolling dice, shouldn't have been able to go any further and set it up. A lot of people didn't roll dice, and it's really, really insane that people who have never even heard the word entropy be responsible for creating their own. I mean, narrative is just absolutely out of touch.
I had no idea what entropy was. And before anybody attacks me, English is not my first language. So I had to look it up in a dictionary. Then I had to like look up what it means within like the context of like this thing. And like, that's not the point. That's not the point. Either we're moving to take the whole point of institutionalizing Bitcoin is so that we can have like more things to do with it, less complicated technologies to work with, right? The more people we gather into this ecosystem, the more brain power we bring into the ecosystem, the more tools we have to use these products in an easier way. If companies are going to build products that people don't understand, then, I mean, you're SOL because your product is only for a few people, and most of those people are bit 110 people, and most of the people aren't liked to begin with. So there you go.
I want to add one more thing for people who do think they are smarter than everyone else. There's a lot of people online going, well, I rolled dice 200 times. I rolled my dice 1,000. Well, guess what genius is? After 100 dice roll, you're not adding entropy. You're actually truncating the front end of your entropy. 100 dice is the maximum entropy that you can create. So if you don't understand what all that means, maybe take a step back.
I have no idea what any of that means. And I like, listen, I respect people and self-sovereignty. I do. I am not a custody person. And I will tell you why. Because I am so ADD that it's not going to work. I'm going to forget everything. And so every time I was texting you guys earlier, like every time I have moved Bitcoin, I open a new wallet because that is how paranoid I am of like the previous wallet that I just touched. So then I have to I literally just like, oh, did I send Michelle Bitcoin? Great. I need to open now a new wallet and move everything from this wallet to a new wallet. Like this is just how paranoid I am.
It's good though. It's actually best practices to do that.
Well, I also keep most of my stuff in the exchange because I trust my exchange.
Yeah. Yeah, so I don't think, sorry, Jake.
No, go ahead.
I was just going to say, you know, there's a saying out there that subsidy is for anyone, but it's not for everyone. And we really need to reassess the blanketed, you have to self-custody coins because there's a lot of options for setup and it's not a one-size-fits-all recommendation ever.
But also there were people in the community that had literally flagged to the company the fact that there were these like vulnerabilities and they didn't do anything about it. I mean, there's been multiple people on X that have posted their emails and their exchanges that they had with the entity flagging the vulnerabilities in the code, and they were just either dismissed or completely ignored. And so like that's a significant problem that that entity has. Like if your users are flagging a problem, you should probably take a look at that.
Absolutely.
So for someone like me, who I would say like I self custody, but now I'm we're going back to the drawing board. Like we got to consider the options. Like after I read the story, my immediate thought was like, oh, okay, this is like where the ETFs, like that starts to make a little more sense, or holding it on one of the exchanges. If like, what would you guys advise for the pleb like me that is like, yeah, I'm self-custodying, but maybe I need to reconsider. Like, what do you guys say?
So
Michelle and I are going to say opposite things. So I'm going to let her say it first.
Yeah, no, we are. And I think it's good because again, there's no one size fits all. So I will speak to the people that want to continue self-custody, right? Because if you want your Bitcoin completely in your own hands, unconfiscatable, then self-custody is super important, right? And you can absolutely still do that safely. I think right now, I don't want to recommend anything to anyone. I will say that this is a cold card CoinKite specific problem, and that if you have a setup in a Jade or a Trezor Bitbox, you're fine. I kind of want to add for now, only because AI is advancing really, really quickly, right? And I genuinely don't believe that a single SIG setup is going to be broken. But in the age of advanced AI that we're in, you do have to stay responsible and stay up to date on what's happening. A lot of people are online right now recommending multi-sig, because if you're in a multi-sig setup, then you're cryptographically, you're super, super safe. Personally, I don't recommend for anyone to set up their own multi-sig. I think if you're not comfortable with a hardware wallet and yourself at home, then collaborative custody options are really, really great. They will walk you through a multi-sig setup. You have Unchained, you have Anchor Watch, Casa. There's a couple of other recommendations out there. And I think Tracy's recommendation is also an option for people. And I will let Tracy go into what she's comfortable with, because again, self-custody can be for anyone, but it is not for everyone. And if you're not comfortable doing something, you shouldn't be doing it.
Yeah, my thing is just like, listen, there's a reason we don't hide our money in our mattress, right? There's a reason like banks were created, and I am not defending banks here, but I don't manage well the stress of self-custody. And I've seen so many of my friends who are tech savvy and who have been in Bitcoin since the very beginning get their computers hacked, their wallets drained, their iClouds hacked. I mean, and it's not like these tech companies are also like providing any help to assist people. Like, you know, I have a really good friend who got his iCloud account hacked, and he's reached out to like, I mean, he's part of this community. He's high up in a big position. And he's reached out to Apple a couple times to be like, hey, can you guys help me out? Like my account has been compromised. My telephone number has been changed, like all this stuff. And they're like, nothing, right? So it's not also like the tech community is all coming together to assist people that are also in tech. I am a big fan. Obviously, I work at Kraken. I am a very big fan of Kraken. I am an incredible fan of our security team. And I believe in the products that we have. And I use our products, to be very clear. Like I don't use any other products except all of our Kraken products. I feel very comfortable there. And so I think that if you want to continue self-custodying, by all means, absolutely. I am not a self-custody person, so I use the products that my company has, and they're amazing. That said, I think that there's a valuable question here, and it's, you know, this whole situation with Cold Card is pushing for institutional custody grade security for everybody. So it's a big push for that. And it's interesting because putting my feelings apart, it's kind of like, well, what's going on that this is being pushed for centralization? Like the whole point of Bitcoin is so that it's fully decentralized. And we're seeing all of these things that are happening right now are gearing everything towards more centralization, right? Because it's pushing you to go to a regulated exchange, because a regulated exchange obviously is regulated. They have insurance. If anything happens, they can potentially assist you in recovery. But it's a little crazy that this specific issue, which is an issue that had been flagged by multiple users a long time ago, is now blowing up at the same time that Clarity Act is going into the House, and at the same time that nothing's moving the price of Bitcoin except every time Sailor sells, it tanks. People are now pooping on self-custody. So it's just what's going on? I don't know. There's something going on. Or maybe I'm just so used to the PSYOP that I think everything's a PSYOP. But that's why when I sent you guys what are we going to talk about? Well, it's the roaring 20s. If you looked at what was going on in the 20s, right? The flash market crash and the financial crisis. I'm not saying it's identical, but it's interesting that this is all lining up the same 100 years later, with the only innovation that has existed in finance in over 200 years, which has been Bitcoin and crypto. And we're having all of these issues.
Okay, we hit a lot of stuff, but something I want to dig in more on is you've talked about the centralization of Bitcoin. And we can also see, not outside of Bitcoin, just the centralization and consolidation of power and influence in our greater culture, in politics. So after a hack like CoinKite, tell me about what is it that you see, when you say, I think this is a step toward further centralization, pull on that thread a little more. What is it that you see that are some of these downstream effects that lead to further centralization in Bitcoin?
Michelle, you want to start or you want me to start?
Go ahead. Do you want me to?
Yeah, go for it. Because you get me fired up, so go.
Okay. Right. Well, it depends which path you want to go down, because I think centralization is the key threat here. It's sort of coming from all directions. And Tracy, all of the threats that you mentioned, which are curiously timed, they will push us towards centralization in one way or another. And that's the real danger, because the real feature of Bitcoin is decentralized, right? And so if we allow for the network and all the products and services to be, I don't want to say co-opted, controlled, or taken over, or swooped up and managed, same big banks that it was brought about against, then what have we really changed? We done? What have we fought against, right? I don't know if we're ready to talk about the Clarity Act, but the Clarity Act, in my opinion, pushed us further into this hyper centralized and highly regulated environment. And so personally, I did not get into Bitcoin to ever cheer on more government regulation. We need to fight as hard as we can in every direction to maintain decentralization.
So I'm going to say unpopular things. You're going to love it, I promise, though.
I love it.
So centralization is not a bad thing. And before everybody decides to murder me, just hang on. Centralization makes certain things easier, right? The reason I love Spotify and I pay for a monthly membership on Spotify is because I get all my music in one place, right? The reason I like going to a supermarket is because I can get all my nutritional needs, for the most part, in one place, as opposed to having to have chickens, plant things, kill a cow, right? So centralization is not a bad thing. What is bad about centralization is when it is utilized to monopolize and when it is utilized to force people into doing things that they don't want to do. That's really when the problem begins. The reason Bitcoin came to exist, right? And we've all read like, Satoshi's like everything he's written, everything he said. And the reason this whole thing came to exist was one, it's a peer-to-peer cash system. It's so that you can cut the middleman out. It's the consistent violation of like the amount of fees that are charged every time we send $1, every time we pass one card, right? Like, why do I have to pay this person when I can pay you directly? It's all of these controls. It's the same thing. Like, you can't be completely off the grid in your home, your panels and everything. You still have to be locked into the grid. Otherwise, the government comes in and says, like, you can't do this, right? Again, centralization, not a bad thing. But when we're being forced to do things that we don't want to do and to pay that government toll, that's when it becomes a bad thing. But Bitcoin, the important thing about Bitcoin and why it should remain decentralized is because, well, one, we don't want anybody to control it. If we are looking at the debasement of the financial system and like current currency system, it's because government keeps printing money. And that's not only our government, it's every government. Every government is printing money. So everyone's money is being completely debased. Inflation is eating it up. And the value of you're a slave. You are a slave. You can't stop working because your money continues to be devalued. And that goes for everyone. I mean, unless you're a billionaire, or 100 millionaire, a trillionaire, which only one up until now, like you're seriously going to find yourself hurting. And that's why we're seeing so many people in our community like try and go to more favorable places with better tax treatment because they can't, it's becoming increasingly difficult to accumulate wealth. And so this is why we Bitcoin. It's a hedge on top of like a digital economy. We're moving towards a digital economy. This is the one that's stuck. It works. There's proof of work. Okay, all of that. Yes, but our currency is being debased. So when the value of $100 bill becomes $1, like, what are you going to do?
Yeah.
What are we going to do? Right? Bitcoin is finite. So the value of Bitcoin will be better. Now, of course, we can talk about the volatility of Bitcoin and like the insane. And quite frankly, I think that part of what we're seeing here is that Bitcoin got institutionalized. I'm not going to say so quickly because this was 15 years in the making, but it was like slowly, and then suddenly.
Yeah.
And then in that suddenly part, it became very institutionalized. And while we recognize the value of Bitcoin as a peer-to-peer cash system, which we hope that one day we get there, Bitcoin has been named a commodity. And also Bitcoin, right? Banks don't, let me take a step back. If Bitcoin becomes as popular and as views as a peer-to-peer cash system, it threatens the US dollar.
Yeah.
Which is why we're seeing also the rise of so many stable coins. I'm sorry, or how we have seen the rise of so many stable coins and the idea that the stable coins, which is true, works as the proliferation of the US dollar everywhere in the world. But it's still, you need to print money to back those tokens. So it's not changing anything. Inflation continues. But the reason why I think, and Michelle and I have spoken about this ad nauseum, the reason I think there's an outright war right now and not everyone, particular people attacking Clarity. You've got all of these different issues. We've got Cold Card, you've got Bitcoin ATMs. Like, it's happening to prevent people, retail, from really like utilizing Bitcoin on a daily basis, because that means if you're using Bitcoin, you're not using US dollars.
Yeah, I want to get into ATMs on-ramping into Bitcoin, but I want to go back to the Clarity Act. I would say if you look at the sentiment or the way it's spoken about on X is like, this is generally a positive thing. At least that's the way it's been branded. I'm curious to hear, Michelle, like your thoughts. You said, you were unsure, or it felt like a further centralization of Bitcoin. Tell me your understanding of the Clarity Act and like what are the actual implications for the space?
Yeah. So I understand why people want clarity, right? You can't build in an environment that's either unregulated or the regulation constantly changing, and you do something, you think you've done it correctly, and a year or two later at you and they say like, no, actually you could go for this or for that. Totally understand the desire and the need for clarity. I think the Clarity Act itself it's really, really extensive. I don't know how many pages the current version is, right? In my opinion, broadly, what it really does is it continues the visualization of the Bitcoin ecosystem. A lot of the big industry players, Byte Federal, Kraken, a lot of the larger services businesses are already fully regulated. We comply with all laws, the BSA, KYC, all of that stuff. We are very compliant businesses. But the Clarity Act is going to scoop up even more of the ecosystem and put them into that regulation. And I think there are sections of it in particular not well enough defined. They could in the future come back and say, well, here's how we interpret that, or here's what we really meant. And I think that's kind of dangerous. So I don't know how much energy it's worth fighting. I think it's inevitable. But I just am not going to cheer on more regulation. And so I guess that's my position on it. I think it is inevitable, but people need to be careful and cautious about how excited about, more regulation, more laws, legislation, because we comply with all of that.
Real quick, do you think they get it done and it passes in the next 2 days before they go to recess?
I don't. I don't think so, no.
Yeah. Okay, I want to go back to on-ramps. So Tracy, you had mentioned that there is hostility or a war on-ramping new participants into Bitcoin. Tell me more about your thoughts on that and where you see this actually playing out in businesses, in the Bitcoin space, in the economy.
So if you take a look at Clarity, Elizabeth Warren added a 3-page addendum to the Bitcoin ATM part. And it makes it extremely difficult for Bitcoin ATM operators to operate a profitable business, right? Because it's an outright war that's being declared against them. What's crazy about it is that this is such an incredibly and highly regulated industry.
Yep.
So all the Bitcoin ATMs follow all the money transmit. They have money transmitting licenses. They have all these things. So to add additional requirements that make no sense because those requirements are not being asked of in regular ATMs, the argument that the people advocating for this 3-page addendum are saying it's consumer protection. And that is just such a load of crap because, okay, the estimate, let me look these numbers up, because when you look at the numbers in the TradFi industry of the amount of fraud that is committed, right? Because that's what they're saying. They're saying, oh, people go to this Bitcoin ATM and this fraud is happening. Let's just start by the fact that 98.8% of Bitcoin ATM transactions are legitimate. That's the first. The second is they have a lower fraud rate than the broader financial industry. Now, the 389 million in losses, it's that like 1.2%. while it's significant, it's generated from a 3.63 billion annual on-ramp ecosystem. So the loss ratio compares quite favorably to many regulated financial products. And when you are looking at how much actually is, I'm looking at these numbers. Okay, so like the fraud categories, imposter scams are a $3.5 billion loss. Tech and customer support, it's 2.1 billion, sorry. Romance scams, 929 million. These are all numbers by the FBI, FYI. I'm not making these numbers up. Government impersonation scams are 798 million. Gift card scams are 250 million. That is a significant amount of losses. I mean, okay, let's just say this. All right. Bitcoin ATM fraud represents 1.9% of total internet crime losses reported to the FBI in 2025. Those are the numbers for 2025. The same regulators banning Bitcoin ATMs haven't moved to ban wire transfers. So there was 3 billion in BEC losses. That's like the email stuff. Gift cards was 250 million, which or like phone-based bank impersonation scams that funnel victims to like crypto kiosks in the first place. So like none of these other people are getting banned when it's way more money. And what that tells us is that if you're banning an industry in which the fraud is so de minimis in comparison to traditional finance, that means that the banks are behind it. So did choke point 2.0 fully end?
Yeah.
And I think that that's also why you have like, you know, our CEO, one of our CEOs, Arjun Sethi, one of the things that he said is like, this is why clarity is important, because even though it's not written in a perfect way and no law is, it gives us a starting point. And because ongoing 4 years of regulation by enforcement during the Biden administration was absolute insanity. But that is to say, it is such a de minimis amount of fraud that occurs in the Bitcoin space. And when you see Elizabeth Warren say these things come out of her mouth, and you're just like, what are you talking about? But then you go and see like who funds her. You're like, oh, okay. I mean, have you guys seen like all the propaganda advertisements that they started to do against the Clarity Act? It's crazy because it's all about Trump, and it's crazy because crypto and Bitcoin is about money, and I'm not really sure how the president has anything to do with that because the law does not involve the president, but that's like a separate issue. That is to say, when you look at like how our industry is treated with all of these things, and when you look at like what's going on and what the penalties are, and like this 3-page addendum and all of this, we're still under attack by the banks. And what I think is happening, and I can be wrong, and I'm open to being wrong. I've been wrong not that many times, but a fair amount of times. I think, and I think we've talked about this, Michelle, I think the banks are buying themselves some time. I think that the war that we're seeing right now is that they're buying themselves some time, because if you see, a lot of financial institutions have been acquiring smaller crypto exchanges, have been acquiring more rails or more rail infrastructure, or they've started, for the most part, a lot of them have decided to start building their own rails, which I find completely insane, because why would you build something when you have zero track record of building anything and the industry has a maturity of 15 years? Like, that can be a separate conversation. But when you look at like the banks getting more involved in Bitcoin, when you look at the banks get more involved in the addition of crypto rails, you're just like, okay, so these guys are clearly fucking with us, and they are clearly just buying themselves some time until they have their own rails up and running so that they can obliterate the crypto industry as a whole. and I'm referring into Bitcoin and crypto there because the obliteration would be entirely to everybody. And then the industry, they get rid of the industry. So there's no intertwining this world with that world. That world just comes in, steals, plunders, takes out, and builds their own thing. That's what I think. I can be wrong. I'm open to being wrong, but like, that's me. Like,
I hope you're wrong, but I will tell you there's a lot of things happening that support that thesis. You know,
like what?
Every couple weeks we get a partnership or an absorption. There's lots of M&A happening, and if you look closely, every time one of those moves is made, it sort of obliterates or makes unnecessary a little piece of the ecosystem here or there. Somebody built an amazing product, and now, oh, the banks are doing it themselves, or this institution. I think it's very accurate to say that they're buying time so that they can build and absorb and coordinate and line their chess pieces up to ultimately win.
And there's ultimately like, listen, this has been the most pro-crypto administration we've ever had. And that's just a fact. Nobody can actually fight that. Nobody can actually have an intelligent conversation or argument with me and tell me that that's not true. That is a fact. This has been the most pro-crypto administration we've ever had. And we've made significant, like, we're significantly ahead. Now, there is something very funny when you've got, and I have many clients. I have many clients from many different companies. I have many clients from many different protocols. I deal with many people. It's like my favorite thing about my job is just the amount of people that I love because I've gotten to meet in the industry and they do so many cool and different things. And so like when you have your clients come and tell you like, hey, we've been trying to stop fraud, but the CFTC and the SEC are telling us to let the fraud happen because they want to be able to follow this and track the addresses that are doing this. You're just like, what? Like, you guys understand that there's a human being behind this, right? That money belongs to somebody. They've probably been accumulating this money for a significant amount of time. And you want us to like not stop fraud, not me, clients, right? And you want these clients to like not stop the fraud because of what you have going on here. That kind of has to make you think. I get it, but like, really, guys? We have to wait for the commission of the crime where we're probably not going to be able to recover that money and give it to the client. I don't know. That's just weird. And those are the things that happen that like people don't really talk about that we should be talking about because it's kind of messed up that the entity that's supposed to be assisting.
Ways to actually stop the fraud, why not implementing those? Because provable, easily implemented ways to stop the fraud that's happening. And we do a lot of that. So why are we being shut down? It's a very good question.
Michelle.
And I want to, I agree very much, Tracy, that this has been the most pro administration. You know, people like to like think shots online like, oh, I bet you regret your vote. No, you have no idea where we would be if we had gone. Like, we wouldn't be here having this conversation. This has 100%. Been a very pro Bitcoin and crypto administration, made strides, huge strides. There's just so many battles still to be fought. And our battles, like with the ATMs, is not necessarily in DC. It's part of the ecosystem on a state level, and it's being driven by agendas. I do think it's important to remind people of that because it could be a lot worse.
Oh, I think it will get a lot worse because when you're looking at it, like what is a Bitcoin ATM? It's an on-ramp. It's an on-ramp into crypto. So if you're taking this down, then the question is, what's the next thing you're going to go after? Because you clearly have an issue with people taking fiat and converting it for whatever crypto choice they have. right? Whether that's Bitcoin or Ethereum or whatever it is, doesn't matter. But
yeah. Yeah, and I think, you know, I've always said, like, look, there's a lot of focus on the anti-BTC efforts, and I think that's important, but it's a little bit of a false narrative because you get rid of the cash economy, you don't need BTC. You can control everything digitally. So I think, you know, the war on the ATMs is because they're cash on-ramps, and they don't want any cash out there. They don't want people to transact in cash or save in cash, convert cash directly into Bitcoin without banks involved.
Let's put on our tinfoil hat. Seems like we've already done that a little bit. I wanted to pull on that thread. So again, like when you say they don't want us to transact in cash, the average Bitcoiner might understand the why, but tell me a little bit more about why wouldn't they want us to transact in cash? Why do they want to stop on ramps? Not just ATMs, like all the different ways you can onboard into Bitcoin. Yeah, tell me more about that.
Yeah, as far as the cash piece, you know, last piece of the economy that they can't serve. So any move that you make from your bank account through a Visa debit card, a credit card, is all hyper surveilled. It can be controlled, turned on, turned off at any moment. And if you have cash, if you take some cash to the farmer's market, you buy eggs, you can buy milk, you could buy raw milk. Oh no. You can buy whatever you want, and they don't know. Right. And so that's the first and biggest problem is the surveillance state will not stop until they can surveil everything. And the economy in the transacting is the focal point for that. Right. You mentioned earlier, like complaints that made in the industry when fraud actually stopped because stops them from being able to surveil. And I think there's a lot of signal in that. We could speak a lot about that. The cash is what enables people to stay, I don't even want to say off the grid. It's just preventing people from having every move controlled. I mean, you do want to buy raw milk, right? Because that it's healthy, and maybe you're totally crazy for thinking, well, if all of that is done digitally, then just look at those transactions and say, here's a milk vendor, and this is approved by the FDA, so we're going to block all those transactions from happening. And that obviously scales to larger and larger problems, but I think it's a good example. And the nuclear option really is having cash and being able to buy a hard asset they can't inflate away. I mean, that's the heart of, that is really like sending into the heart of fiat currency, is the ability to do that. And so I really believe that that's why they cannot tolerate people do so.
I mean, if you go to Europe, there are a lot of places. I mean, in Amsterdam, they're not accepting cash anywhere.
Yeah.
It's all digital payments, all of it. This is why I don't do loyalty cards, by the way. This is why they're like, oh, 10% if you use the loyalty card. I was like, yeah, I'm good. I don't need to know when. I don't need you to know when and what brand of tampons I buy. Like, I'm good. We're all good here. You don't need to bombard me with advertisements and sell my data and do all of that. But what is interesting is that they absolutely want to get rid of cash, and it's slowly happening. And Michelle mentioned the whole CBDC thing. Listen, what is a CBDC? Okay, it is a central bank digital currency. Okay. Why do they want a CBDC? Okay, because a CBDC will allow them to do the same thing that they're able to do with a bank account, right? They call bank and they say, shut this bank account or give us this information or blah, 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 blah. And the banks go and do it. It's all Bank Secrecy Act. post 9/11 stuff, all of that. All right. What? There's a myriad of tokens that act like a CBDC.
Yeah. Oh,
We saw exactly. And we saw with the Canadian truckers what happened when all of the centralized exchange accounts were starting to get turned off because the government didn't like that they were protesting.
Yeah.
So like, but this happens within crypto, right? This also happens within Bitcoin, by the way, because if you have your Bitcoin in a centralized exchange and you're moving in that manner, they can shut down your account. Like, of course, if you're doing like unlawful activity, yeah, you're going to get your account shut, right? But they're moving everyone to this digital economy, right? Like stable coins and whatnot. One, to continue like printing dollars and backing dollars, and also to make sure that they're controlling like where you go, what you do. I mean, and are we going to get into like the, like the social credit systems like Palantir and Peter Thiel, and like how they're starting to centralize all that? I mean, how they bought like this massive chunk of like Aura Ring, and like all now of your data that you like an Aura Ring is now like partially like Palantir's. Like, you can't tell me that that is not setting things up for a social credit system.
Yeah, the evolution of X into everything app, the way that China has WeChat. I have been a big fan of Elon buying Twitter, and I think it's great for free speech. It's great that we can all connect, but I am absolutely not using X money. I don't want an every app.
Yeah.
No, I want a super complicated piece of technology that I don't understand how to get my Bitcoin off of. That's what I want. That's really what I want. I'm a very big fan of cash. I am a huge fan of cash. And I buy Bitcoin, of course.
Keep cash alive.
I love cash. I love cash. I dream of like one day running into like a big plot of cash at the beach in Miami. Cash, not cocaine, cash. And like just
washing up on the shore, like
just washing up on the shore and wrap and be like, oh, somebody sent me a gift. Yes, absolutely.
We can bury it in my yard, Tracy.
Well, no, I'm gonna be like, this is abandoned property. I'm just gonna it's abandoned property. So I'm just gonna if people can make that ludicrous argument with like dormant accounts on exchanges, then I can go and make that argument over cash that I find at the beach in Miami Beach. It's mine now. I'll just need to pay the taxes and then it's all mine. All mine.
Just consult the IRS. No, but it's so important. I think a lot of people like want to do the easy, convenient thing, right? And it's to like load up your phone and just do a little tapping and your dollars and numbers go through the matrix. But cash is so important. I'm based in Florida, and we, over the past few years, had these really terrible hurricanes. People were without power. I was without power for 10 days. The cell towers go out. And let me tell you how important it is to have cash in those cases. I mean, you can trade with other things, but cash is king. And when 100%. Everything goes down, it really shows. So it's important to maintain some cash, use some cash. I buy all my meat from a local butcher that prefers cash, and I prefer them because of that. So
cash is a good tool. Cash is a fantastic tool. Cash is also a way of buying Bitcoin. This is why we have ATMs, Bitcoin ATMs. But I think the biggest thing that's also like offensive here on the Bitcoin ATM stuff, to go back to it for a second, it's just like the Bitcoin ATMs, like the population that it actually caters to is a completely unbanked or completely like underrepresented population of people in the banking like system. Not everybody has a bank account. Even in the United States, not everybody has a bank account, especially minorities. tend to deal more in cash because they live paycheck to paycheck. So it's not like they have like a lot of money like in their accounts or anything. They like get their work check. They go to one of these places where they like get cash for it. And then they like operate with that cash throughout the week until like their next paycheck. A lot of the people that are utilizing Bitcoin ATMs are those people.
Yeah.
They're
The average
people.
buy is under $300. I mean, these are people that are saving everything they can in an asset that's not going to be inflated away.
So like that's I think what's like most offensive, because the mission of the industry, you know, or the original mission before a lot of people got lost in their journey, is to bring financial freedom to everybody in the world. So that what if there is no bank close to you? What do you do? How do you like transact? How do you like run a business? But then you see how like the attack of cash, I think, Michelle, I think you and I were talking about like how when you look at the QuickBooks application now, when like QuickBooks took away the tools for all the cash reporting.
Yeah, so we can do reporting, but when I went to work for Byte Federal, I mean, the industry was under attack, and I assumed that the problem was with Bitcoin, right? Well, we're a Bitcoin, a crypto company, but actually most of our problems are insane exponential expenses are because we are a cash-based business. We've been debanked over and over and over, not necessarily because we deal with Bitcoin and crypto, but because of cash. We use QuickBooks for accounting. Yeah, I had told Tracy this earlier. There are certain features within QuickBooks that they disable simply because you are a cash-based business. That should be criminal. That is the actual crime, is claiming that the simple use of cash is a crime, because it's not. A lot of people are completely unbanked, and those people still matter, right? They do run businesses. They are a huge part of the United States. We can't forget about those people. Yeah, we
You're also incentivizing people to commit a crime, because if I don't have the tools to report all this cash, what do you want me to do?
Right.
Oh, okay. The more complicated you make it, the more people are going to be like, you know what? Fuck it. Hide it under the mattress. We're just not reporting it. I mean, and that does happen. I live in an island. I live in Puerto Rico. I'm from here. Every time we have a hurricane, like Michelle said, you need to deal with cash. So like, there's all these cash transactions happening everywhere. There's a whole ecosystem of it. And there is like no way of doing things then properly because the tools are being taken away. And you have to think that. And I know, Jake, you asked me, like, do you think that this was made specifically for like the crypto and Bitcoin industry? And I was like, well, I don't know if it was done specifically, but I think that it was done with the intent of forcing businesses to then not accept cash because the mechanisms for reporting those earnings isn't there.
Question. So I think a lot of times I see the disconnect between like the average retail, like pleb, I'm just a Bitcoiner, I don't care about anything else, and then the institutions and like Bitcoin companies that operate in the space. They hear that, and to me, I see the direct connection. It's like if the regulators make it difficult for Byte Federal to run their business, the downstream effect is all of these unbanked people are unable to on-ramp. And so what would you say to the person that goes, I don't care about the institutions, I'm just a Bitcoiner, not for me? What would you say to them when there's challenges with the institutions and how that actually the downstream effects will reach them?
It's a good question. I think if they are absolutely not going to stop with Bitcoin ATMs. You might not buy your Bitcoin at an ATM, but if we don't fight for everyone to be able to access Bitcoin, if we don't defend all of the on-ramps, they're not going to stop here. once they successfully shut down the cash ramps, they're going to go after something. I don't know exactly what might be next, but they're going to continue to increase the bullseye, right? And if you just say, oh, I don't care, affect me, I don't care, that doesn't affect me, by the time you get to the point that it does affect you, there's going to be no one left to fight for you. You know, there's that famous saying, they came for me, and then there was no one left. And so, you know, I think we all need to take a step back and remember why we're here, remember why we got into Bitcoin, and take a look around and realize that it's worth fighting for. All of the on-ramps are worth fighting for, whether it's an institution or a tiny little ATM at a gas station in the middle of nowhere. Everyone in this ecosystem matters. I don't know if that answers your question, but
it matters. And it also, like, we're in this because we know that the world is going to hell in a handbasket. And at some point, and it's going to happen, and we all know it, it's why we're so frustrated by the situation. We don't know who's going to be in the next admin, or the next one after that, or the next one after that, or who's going to be in the Senate, or who's going to be in the House. And we got into this because we know that in a weird way, a social credit system is coming to the United States. It's more challenging to implement in the United States because of our Constitution and because, you know, I think we're a country of hotheads. And so, like, we'll probably, like, go to war on this. But the whole point of this thing is that when they decide, we don't like what you say, we don't like your opinions, we don't like what you think, the only way that we know to punish you is through your pocket.
Yeah.
Because we're already causing inflation. Oh, and you know what? We're going to take now all that devalued money that you have in your account, and we're going to shut it down. We're going to shut it down until you change your opinions or until you're just quiet and don't talk about anything, right? And they'll monitor you because we're already being freaking monitored with these things. They're already listening to everything that we're saying. And that's not a lie. You see it every time you talk about something. I mean, I guarantee you, I mentioned tampons earlier. Jeff, let me know later in the week how many tampon advertisements you get on your account if your phone was close by. Like, but it's the reality. So we Bitcoin because we want to make sure that when all of that happens, we can still feed our families. Yeah. And we can still help our friends. And we can still have our own community and survive whatever apocalypse whoever is in power is going to bring down against us. That's why we Bitcoin. That's why this thing is worth fighting for. That is why when we see a 3-page addendum that makes no sense because the traditional finance industry is treated completely different. We are still being discriminated against, and we still have a fight. Now, is the fight significantly less? And are we now better equipped? Yeah, of course. We absolutely taught everybody a lesson in the last election. So we have power as an industry and as a community. But to continuously label us as criminals is irresponsible and should be criminal. It should be. Because you're putting a target on everybody's back in this industry when all we want to do is make sure that when all of y'all out there mess up, we can still feed our families and help our communities.
Yeah, I think that's a good place to wrap. Michelle.
Oh, great. We're not going to get into the flop cameras. Awesome.
We'll say that for the next one, and we'll make sure we bring our tinfoil hats. Before I let you guys go, Michelle, where can listeners find you and where can they learn more about Byte Federal?
Yeah, so they can find me on X. I am only on X. I do have a no star that's mine, but I'm not active there. So it's just Michelle Weekly on X, and you can find Byte Federal there as well. I do have a fraud website where you can learn all of this. We're keeping track of all the FBI statistics, and it's a really great resource for anybody who is in the industry and maybe wants to understand either what's happening or how their little niche part of the industry can fight fraud. And so I'm and keep cash alive.
Tracy.
I'm Tracy Hoyos Lopez. On X, I am Tracy Hoyos Lopez. I work at the awesome, most amazing company out there, Kraken. And I am the head of strategic initiatives for Kraken Institutional. If I can ever be of any assistance to anybody, whether that's in my division or anywhere else, it would be my pleasure. I love my company. I love Kraken. I love our vision. I love where we are headed. This is still the future. It doesn't matter that we're in a down market. Bitcoin is still worth fighting for.
I love it. Ladies, thanks for joining me today.
Have an amazing day.
Thanks for having us.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin Corporation, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
Okay, all right, cool. Well, let's start with just some brief introductions. Amanda, tell us a little bit about yourself.
Hi, everyone. My name is Amanda Fabiano. I'm the COO of Nakamoto.
Hey, everyone. Oh, wow. You got some cheers already.
Yeah.
Thank you.
Hey,
I like that.
Hey, everyone. I'm Jeremy Allman. I'm the CEO of Paystand. We are the largest business payment network built on the Bitcoin blockchain. 1 million customers, 20 billion in volume, 2% of all the US economy built on the Bitcoin blockchain. Woo!
Hi, everybody. I'm Johnny. I am the co-founder of OnNexus. We build on-chain solutions to allow treasury companies, institutions, Bitcoin holders to earn a yield on their Bitcoin self-custodially on-chain.
All right. Thank you. Johnny also has the coolest name in the world. Johnny Himalaya. It's amazing.
Cheers.
We're going to get to know him a little bit more. All right, we were talking about Bitcoin treasuries over the next decade. So I want to start just by having our panelists paint a picture or cast a vision of what the next 10 years look like. So let's fast forward. We're at 2036. What does our industry look like? What are some things that people maybe aren't anticipating that you're seeing as an operator behind the scenes?
That's a really interesting question because I feel like every 4 years in Bitcoin seems like 35 years. So hard to think about a 10-year time frame. We've just seen the market continue to evolve over the years, and I think we'll still continue to see that. I think we're going to see more of a convergence of traditional finance and Bitcoin worlds. I think from a treasury perspective, you'll see more companies going towards an operational model or focusing on the capital market optimization. It's I think when people think about Bitcoin in the future, they always think about a price target, but I always think about what are the businesses that are going to exist in the future. And I would hope that a lot of the companies that are being built in this era will continue on into the next decade.
Yeah, I think it's true. You're going to have more and more increasing Bitcoin business adoption. It's crazy to me that this treasury conversation has actually like crossed the chasm. A few years ago, the idea that corporations were using as treasury would be a crazy notion. Now I'd say we already have momentum there. So I want to talk about what's past that, which is Bitcoin being used in the real world for businesses to fuel their operations. Because Bitcoin, and one way to look at treasury is it's digital capital, but capital in general is just fuel for your business. If you simply have great capital in your business and your business doesn't do anything, it's not a very good business. So what I really want to plant in your guys' minds is actually Bitcoin as digital capital becomes the fuel for a more efficient business. Businesses that actually can run cheaper because they have lower cost of capital, businesses that can move their money faster and quicker, so that makes them more competitive, and businesses that don't need to use the traditional financial system, which means that they're going to lower their cost, that they can put that back into more jobs, more business creation, and more GDP growth, which is good for our economy, and it's ultimately good for the world, and that all starts with businesses using Bitcoin.
Johnny?
Yeah, I'd like to piggyback a little bit off of what Jeremy said as well. I think if we go 10 years down the road, I think the dreamer's point of view would be that if hyper-Bitcoinization truly happens, I think the concept of a treasury company will probably be over because every company will just have Bitcoin, as you were saying, operationally. So this whole strategy of, being a treasury company to put Bitcoin on your balance sheet purely for treasury will be a moot point because people will have Bitcoin, companies will have Bitcoin because they use it in their day-to-day operations. They're getting yield from it, etc.
Yeah, I think that's a great point. I think about this with Bitcoin meetups too. Like Bitcoin meetups are a thing right now because we're trying to propel adoption forward. But in 10 years, there's no dollar meetups, right? So I think it's kind of along similar lines. We're just going to see that Bitcoin is just embedded in everything. So it becomes a little bit redundant. So what sort of headwinds do we anticipate over the next 10 years? So Bitcoin's experience and pushback from whether it's regulators or even like what we're seeing with topics or MSCI. There's probably some cultural headwinds, some narrative work, some marketing work that we need to do. But what do you see as potentially problematic that maybe people in this room aren't anticipating over the next 10 years?
I think that regulatory will always be an up and down. I think that there will be different things that are built that we might see traditional industries push back on because it might affect their portion of how they make money. So I think that will consistently be something that will be coming around the corner at every market cycle. I think growth and adoption and just like the storyline of Bitcoin, just explaining that, we probably, to your point, could do a better job. Bitcoin is a lot of different things to different people. And so you can explain Bitcoin differently to whatever crowd you're talking to. I think that's one of the most incredible things about it. It can be whatever you want. It could be your savings account. It could be your spendings account. It could be something that businesses uses. It could be something that businesses hoard. So I think how we explain Bitcoin, and there is no Bitcoin marketing department. So how we explain it, I think, is really interesting because depending on who the clientele is, how they adopt it can be very different. So I used to work at Fidelity, and how you explain Bitcoin to Fidelity was very different than how I explained Bitcoin to my mom. And so I think, us all doing our part there would be super helpful. But yeah, I think regulation is something that we're always going to have to think about around the corner. And that just goes with the wind of where things are going.
Yeah. Jeremy, what kind of headwinds do you anticipate?
Yeah, I think one that's like less obvious right now is, you know, the stablecoin adoption around the world is growing faster than any financial infrastructure in the world. Stablecoins in general have more volume in certain places in the world than Visa and MasterCard combined. And so when you talk to the clientele that we do, which is generally large corporations, we service the largest Fortune 500, we service the largest banks, we service the largest portions of the economy. And what you find is, unfortunately, their conversation is not starting off with, how do I Bitcoin? Their conversation is starting off with, how do I stablecoin? Now, here's the problem with that. The vast majority of stablecoin volume is not sitting on the Bitcoin blockchain. And so what it's really doing is making more TradFi, traditional financial infrastructure, more efficient, but it's doing nothing beyond that. And so the question for us is, how do you actually marry the two, where stablecoin maybe is the bridge to Bitcoin, but on its current path, stablecoin volume is actually sitting outside of Bitcoin, and we don't think that's a good thing, because Bitcoin is freedom money, it's digital access for people around the world, it's infrastructure that lowers the cost for global remittance around the world, and Bitcoin is the single most important invention in our lifetime. And so it's incumbent for us to be able to create really good use cases. And so what we want to do is say, take all of that energy and infrastructure that's going on stablecoins, but is really just perpetuating the traditional dollar, and put that on Bitcoin that has no owner, no individual that can hold you back, and that can be used anywhere in the world, instantaneously, automatically, and globally. And so we want to marry those two things, because if we don't, we're going to be in a world where stablecoin eats Bitcoin, and it's not the reason most of us got involved in Bitcoin in the first place.
Very interesting. Yeah.
I would say in terms of headwinds, we have a small bit of like not an identity crisis, but different Bitcoin communities view what hyper Bitcoinization looks like in different ways. So if you go way back to the old school, it was all about like, no counterparties. You don't need to trust the bank to be able to send value from one person to another. And, that philosophy still exists in certain communities. But then, in the new age of hyper Bitcoinization, you obviously have institutional involvement. So, where the banks are actually getting involved in the Bitcoin economy. So you can look at it like two different ways. Do we look at the banks getting involved as friction, or do we welcome it? And Bitcoin is a disruptive technology, and like any disruptive technology, there's always incumbents who end up, being faded out. Like the internet music streaming got rid of the record industry in a large way. And does hyper Bitcoinization get rid of an industry, or does the industry take it on board and try to gel with it? So I would say it really depends on what your view of hyper Bitcoinization is. Is it a completely sovereign, self-custodial financial system that doesn't need any banks or institutions? Or is it a new hard asset that the whole financial system can benefit from? And I think once you answer that question, you can kind of decide on what the headwinds are.
Well, Amanda, I feel like you.
I think that one thing that's kind of interesting, we were just on a panel with Kraken, and we were asking Kraken about how they're working with traditional banks, and Gurpreet, who is the head of institutional there, said something that really stuck with me. He said, it's easier for us to learn traditional finance than it is for traditional finance to learn Bitcoin. And so right now, I think you have this really interesting time where we can see some of these companies that have built over, the last decade really come out on the other side and maybe take a little bit more ownership of the where finance is going compared to the traditional banks. I don't know. I guess it's a race that we'll watch over the next decade.
Definitely. And Kraken is coming up next also. So just a quick commercial. And also, I just want to reset the room a little bit. I see a lot of people standing in the back. Sorry, putting my MC hat on real quick. If there's an empty seat next to you, will you do me a favor and scoot in so some of these people can get seated? It is a little bit chaotic in here. We love to see it. Welcome. We're glad you're here. And we're going to keep going here with this conversation. Okay, so over the next 10 years, what is it going to take for some of these legacy companies who are sitting on millions or billions of dollars in cash to wake up to what's happening? I mean, it feels like we're almost at a point where it's like a fiduciary obligation almost to be paying attention to what's happening in the Bitcoin space, and ignoring it is going to potentially have some consequences. But what do you think is going to happen in order for some of these large companies to capitulate?
I mean, we do see some large companies with Bitcoin on balance sheet that have them for a while. So Fidelity has been mining Bitcoin since 2013. They hold a large Bitcoin stack long before Bitcoin Treasuries was a thing. You have Tesla that has a lot of Bitcoin on balance sheet. I think you're right. It is, at some point an obligation to say, hey, what is this thing and does it make sense for us? But every company has their own risk framework and what makes sense for them. This goes back to the educational piece and just where and how we think about how Bitcoin exists in the world. I think there's more Bitcoin on balance sheet than I would have expected at this point, which is kind of surprising and nice. But I do think that over time, as people learn more about it, that's great. But we love Bitcoin, obviously. But when you think about it as an asset, it is extremely volatile. So as a CFO or a public company, you do have to think about the risk of holding that. The volatility of Bitcoin is difficult to explain versus holding cash. So I think as we see these volatile waves kind of get compressed, maybe there will be more and more adoption in the future.
Yeah, I think one of the hard parts, though, in my journey is oftentimes you start off with Bitcoin, and the farther you get, you want to orange pill people, and you want to tell them all about the economic model and the financial model, and people kind of just their eyes glaze back. And what I found over time is the best way is actually just to have people use it and touch it in different experiences. And so one of the things, Saylor's done such an incredible job at educating the market around Treasury. We went a different route. We actually, we've been in business. We're probably the first Bitcoin or second Bitcoin payment processor in the world. But over time, what we learned is we talk less and less about Bitcoin. We service most of the largest Fortune 500 companies. The way we talk about it is actually just hey, don't you think your money and your capital should move at the speed of light at zero cost and completely automatically and agentically? And then let's figure out ways for your business to actually engage so you can get Bitcoin Treasury, but you don't need to go get the board approval, because Bitcoin Treasury on one dimension might need the board approval, especially if you're a public company. So for example, what we have is a corporate card. The corporate card, you just spend in dollars and fiat like you do in your normal corporate expense when you bought your airplane ticket here or whatever, but then the rewards points go back into the corporate balance sheet instead of just some Amex points that I have no fucking clue what it does. So that all of a sudden gets it on the balance sheet, but in a completely Trojan horse way. The CFO has now got it, has to determine what do I do with it. Turns out most of the time, because they effectively got it for free, they keep it on the balance sheet, and then that becomes the entry point for them to be able to start increasing their treasury position. So the point is, Bitcoin's actually being adopted more and more in both the real world and in the business landscape, but maybe not straight head on.
All right. Yeah, in terms of what we need to achieve greater adoption, et cetera, I think as the products become more mature, whether that's a software product or a financial product, we have a lot of innovation obviously now with with Stretch and the different things that Strategy are doing. And as this marketplace matures and as the volatility, as Amanda mentioned, that right now Bitcoin is still seen as a very volatile asset, but over time the consensus is that it will become less and less volatile. So then it's seen as less risky in order to put Bitcoin on your balance sheet. And once that volatility is dampened a little bit, you'll start to see more and more innovative products. And this is how you can use your Bitcoin now. If there's that demand that, all right, it's not as volatile anymore, I'm willing to hold it. Now what can I do with it? Can I make payments? Can I earn a yield? Can I market make? Can I borrow? Can I lend? And once all of these products come on board, I think there will be a snowball effect that everyone's oh, you can do all of this with Bitcoin?
Yep.
Let's go for it.
Definitely. I love that. Okay, well, we can't talk about the next 10 years without talking about AI. I know it's very buzzwordy. We had a panel earlier about AI, but I do want to talk about what you're seeing that's already emerging. I mean, we already live in a different world today than even 6 months ago, right? I don't know about you, but I'm at a point where if Claude is down, I'm a little bit panicked. I'm well, what do I do now? I forget how to work in the old sense. But so far, it doesn't seem like AI is coming for jobs or some of the scary narratives that have been out there. But how, as operators, as visionaries, how do you see AI continuing to be integrated into the Bitcoin corporate space, if at all?
Yeah, I think whenever there is something new like AI that comes out, the real scary thing that the narrative happens is every job is going away. The same thing happened with Bitcoin mining, right? When Bitcoin mining became more and more institutionalized, jobs are going away, mining is eating all the grid. But what ends up happening is that there's different industries that get created and how people work ends up being different. So I think that's what we'll see for us, maybe there would be agentic AI with Bitcoin being the currency. That could potentially be something that I think we'll see. I think we'll see more people using AI for being more efficient at their job, not necessarily taking over the job. I don't. People, when you still have to edit anything that exists today, and maybe that will adjust over time, but we still need people's brains to make sense of things. AI, I think, just makes you a little bit more efficient at this point.
Definitely.
Man, I feel like I'm being like the spicy one right now with the opposite takes. So our headquarters is in Silicon Valley, and I would say most Silicon Valley CEOs I know, they radically think it's going to transform jobs. I think the two most important changes in our lifetime, at least in the last 100 years, if not longer, is the transformation of Bitcoin, transformation of money, that's Bitcoin, and the transformation of labor, that's AI. Those two things are changing how society operates. In Silicon Valley, every CEO I know is saying that like 50% of staff is going to change how they do their own business. In our own company, we're not huge, we're 400 employees-ish. I'm thinking about the next stage of our growth. I would normally think about going from, let's say, 400 employees to 4,000 employees. I think we'll go from 400 employees to 500 employees and 5,000 agentic digital employees. Now, that's already happening in our organization. Probably within the next quarter, we will be one digital employee per actual human. That's exponentially growing every single quarter, and we're not the only company that's doing that. That's how fast we're growing and how much leverage we're happening. It's happening in the financial stack with products and services, and it's happening in every part of our operation. Now, here's the key point. How do those digital employees and those agents actually do commerce? Commerce is the fundamental piece of human society. They need a way to be able to do it through digital money. We believe it's extremely important that they do it through digital money that's done through Bitcoin and freedom and open access money. Bitcoin will be the thing that the agents will prefer. And the reality is labor is transforming, and digital money is the perfect transformation around digital labor.
Well said.
Yeah, perfect. Yeah, us being a software company, we've been like on AI since the get-go. So we actually have all of our coders are using Claude Code to help them with their code, and we've got different agents running different workflows in our company, and you know, so we're very much in tune, and we have a blueprint for what the future of Bitcoin looks like with AI agents, and I think everybody would agree. You know, an AI agent can't own a bank account, an AI agent can't KYC to an exchange. So like, how are AI agents going to transact? You know, so I think it almost becomes common sense that they're going to use some form of cryptocurrency. And then obviously the most trusted and battle-tested cryptocurrency is Bitcoin. So I see a future where absolutely all AI agents are communicating with each other, transacting with each other on the Bitcoin blockchain. And what's interesting to note is that while some people think Bitcoin is a slow network compared to other networks, you know, block times are 10 minutes. In terms of communication, the Bitcoin blockchain is one of the fastest communication layers in the world. If you think about how Bitcoin miners propagate transactions amongst each other, this happens at the speed of light. And if you're into networks, any message can be passed from one miner to another in less than 2 hops. So you can represent agents as nodes on the Bitcoin network and have them communicate and transact with each other using Bitcoin, not only for payments, but also for high-speed communication. And that's what I see as the future of Bitcoin and AI.
Amazing. Well, as we wrap up, I want to invite you all to give some final thoughts, 30 seconds, next decade, whatever you want to talk about, go.
Oh, man. I think obviously Nakamoto owns Bitcoin Inc., owns this event, and we put it on, and we also own UTXO, which is a financial services and asset management group. What I think is really interesting with AI too, which kind of dovetails into this, is like the human connection starts to become even more important. So like meeting someone versus understanding if they're an AI, I think that the event world is really cool. So for me, like that's one thing that I've been thinking about when it comes to that. I think that like in-person events will become more interesting as the world goes to AI agents, and you don't know if you're talking to agent or someone over email. So that's something that like I'm looking forward into what we're building. Yeah, I think that Bitcoin is going to continue to gain adoption. I think we'll see different trends pop up like that we can't even really imagine. I think that it's going to be really cool when like in 10 years we look back and we say, wow, none of the things that we said on stage actually happened. They're totally different, right? And I think that that continues to happen. Obviously, everyone here has been in Bitcoin for a while, and I don't think that any of us had a crystal ball. So I can't say I have a crystal ball on what comes next, but I'm really excited to watch it play out.
Amazing. Jeremy.
All right, so like I'm excited because we've spent so much time in my world just trying to make Bitcoin usable to businesses around the world, and this is this is an example of how much the world has changed. And so, I guess I'd chill if you're interested in business products from everything from cross-border payments, payroll, et cetera. Paystand.com is a great place. What we're excited about to announce, we've been announcing this with a bunch of launch partners this week, is something called USDB, which is the first stable coin that's built on Bitcoin natively, built for businesses, built for bots, and enabled for the agentic infrastructure, because we believe that connecting the two worlds, traditional companies, traditional commerce, to global commerce on Bitcoin is the most important thing we can do to transform our economy.
Johnny Himalaya, bring us home.
Yeah, I'm just super excited for the innovation that we're going to see over the next 10 years as companies have Bitcoin on their balance sheet. The last year was all about like treasury companies just accumulate Bitcoin, but I think it's obvious with the way these treasury companies have been priced that no, you got to do something with that Bitcoin. You got to put that Bitcoin to work. So I'm super excited to see the mix of financial products that are made plus software products that are invented and the actual combination of the two, where you can have Bitcoin wrapped in a financial product, but also using some software product that puts it to use, earns it yield, makes it productive. I'm just really looking forward to seeing how the next few years of those combinations work out.
Awesome. Well, thank you guys so much. I really enjoyed this conversation. That's all the time we have for this panel. Please help me thank our panelists.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
Everything you guys do, Bitcoin Corporation, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
Thank you, George. I appreciate that. I'm Stephen Pollack. I'm excited for this panel today. Thank you all for being the first ones up and Adam this morning here. We're really excited for the conference this week. Excited to introduce the panel here. We're going to get it kicked off. We have a lot to talk about. I have to my left, John Regan, CEO of Moon Inc. I have King Wee, CEO and founder of Treasury. And I have Gary Kruglikov, head of Bitcoin strategy at Affinio AG. Thank you, gentlemen, for joining us this morning. We have a lot to talk about, and it's really interesting. We have a cross-section of Bitcoin companies from all the corners of the globe here, from Netherlands and Germany to Hong Kong, and so I think we can really dive in and get a cross-section of sort of the regulatory environment and where we are today, where we've come, and where we're headed in the future. So, guys, let's start off here. I think we have like 5 or 6 questions. We have Bitcoin companies here, like we said, from all over the globe. In 60 seconds, can you just give us a quick update of what's been going on in your business, sort of any kind of innovation, anything new that's been going on, what you've been working on, and then an update on the regulatory environment that you operate in. Let's start here with John, and we'll just work down the line.
Sure. So John Regan, CEO of Moon Inc., listed on the Hong Kong Stock Exchange. And so you can kind of think of Moon as the Bitcoin treasury company for Greater China. Really, Hong Kong exchange listed company, we see as the best way for mainland China eventually to get access to a Bitcoin proxy. So we're building a Bitcoin balance sheet and then building a Bitcoin business tied to our existing legacy business of telecom. So SIM cards, data, and we're adding Bitcoin card products into the mix there. So adding Bitcoin on our balance sheet as a treasury asset, and then also as inventory for our products, and giving China, first Hong Kong, and then China exposure to Bitcoin via that HKEX company.
Hey, thanks, Stephen. Good to be here. So King Oei from Treasury in the Netherlands, Amsterdam. We're preparing a listing on Euronext Amsterdam, which would make it the first on a main exchange in Europe. We raised capital last year, about $150 million, backed by the Winklevoss twins, Nakamoto, and a couple of other institutional investors. And we're preparing our listing in Amsterdam. If you think about a regulatory environment, it is all fairly new for the Netherlands, anything Bitcoin crypto related. So there's a lot of education that needs to be going on as well.
Yeah, Gary Krakow, my name. I've done the first Bitcoin treasury in Germany, a market that you would think should have one way back, because we, for instance, host the longest standing Bitcoin meetup, I think, outside the US. But funny enough, no one was crazy enough to go down that path. And in terms of regulatory concerns or updates, I think Mika is doing a good job. One thing I think for Germany, but also probably Netherlands and other jurisdictions, would be harmonizing that, maybe finding better ways where it's clear what are the pros and cons being in Europe versus outside, and in general, more capital market understanding, I think, of the treasury model is something I'm personally very passionate about.
Excellent. And Gary, we're going to stay there with you. You just touched on this a little bit, but the next question we want to hit. So how have you seen banking relationships sort of evolve with your corporate Bitcoin accumulation strategy, across Europe specifically, and then Europe and then Asia? We'll come on down the line back to John. And then how does sort of openness from banking partners connect to broader adoption?
Yeah, the good thing is Affinio had and has certain banking licenses, for instance, a payment institute license. So, for example, talking to the regulator was never really of a concern. And I thought always this is a big advantage over, just going with some shell company, etc. On the other side, even then, talking with investors, talking to shareholders, they still cannot really grasp the idea of Bitcoin sometimes. So you really have to start with first principles, which is crazy with especially financial professionals or people that should be knowing this better. So this is the one thing that was extremely surprising. On the other hand, being in Europe, I think, and Germany, it's one of the largest markets, capital markets in the world. I think the fourth, fifth, and there's way more potential there if you start then, offering capital market products that could be high yielding, for example, so something like Stretch. In Europe, we do have something similar by a strategy called Stream, but it was only available for institutional investors. That's something that I think would make a lot of sense to now propagate and start thinking how can you place certain private credit or then public fixed income yielding products backed by Bitcoin. So this is something I think that we'll see happening very soon.
Yeah, King, what are you seeing? I know you guys are both in Europe, right? We have Germany and Netherlands. Compare, contrast.
No, I think the interesting thing about a treasury company is you need to deal with all the institutions around you, the regulator, the exchange, banks, right? You need to bring it all, Bitcoin basically institutionalize it. And I think what we're seeing is that certainly Mika, as Gary mentioned, has been a very positive development. At least there's a regulatory framework and all these institutions know that it is there, it's coming, and you need to deal with it. We're certainly seeing in the Netherlands a lot more pro-digital assets behavior by especially the banks. So that's certainly developing, driven by also this regulatory environment. And to be clear, as a treasury company, you don't actually have customers, so you don't fall under MiCA, but still the fact that it's there is very positive. Certainly from our side, what we're doing also is for instance, working on a lobby group to make sure that all these people sit around the table, compare notes, compare risks, compare issues, concerns. It's very important because, again, we keep saying it, a lot of it's about education.
Exact same in Hong Kong, right? No differences.
Yeah, Asia's totally different, and it's kind of interesting to be sitting at Moon because we've also seeded some of the first and largest treasury companies around Asia, in Korea with BitPlanet, and Thailand with DB8. And so we've kind of seen, from the front row, the different dynamics of working in other markets outside of Hong Kong also. I'd say the main thing about operating in Hong Kong is that the Hong Kong exchange, not necessarily the SFC or other regulators, it's mostly dealing with exchange listing rules when it comes to doing something that's a little bit innovative, like building a treasury strategy. And we're seeing similar things in Korea and in Thailand. We sell products into those companies, into those countries, and the main thing that you deal with there is just capital controls, which isn't as much of an issue in Europe with how everything is so much more meshed together and built together. And so, we feel like each of these companies has kind of developed a moat based on being a first mover there. We feel like that's kind of the position we're in Hong Kong, and then we can all sort of work together to play to the strengths of each country when it comes to the products that we offer, when it comes to the services that we can help each other with. That's kind of the plan for Asia, is to have a network of these companies leading treasury business in each market and play to each other's strengths.
Fantastic. Appreciate this, gentlemen. So I guess the next question then would be regarding Bitcoin exposure through public equities. In your region, are regulations and legislators, I guess, making it easier or more difficult for traditional investors to sort of gain exposure here? What are you seeing, and how is that changing? Is it getting any easier, or is it getting more difficult?
I can kick it off.
Yeah, please, King.
I mean, the interesting thing is in Europe, most people don't know, but as a European resident, you can actually not buy the IBIT ETF. You cannot buy Bitcoin ETFs. So that's already in itself a huge constraint to get easy Bitcoin exposure in your brokerage account, right? You can clearly open an account in exchange, but it's different. And that's why a Bitcoin treasury company itself is a real sort of product market fit. It's easy access in your brokerage account, it's easy for taxes, it's regulated to access that. So that in itself is a big positive. Away from that, we don't necessarily see a huge amount of, let's say, encouragement for people to buy digital assets. I think switching a second to the institutional side, we're certainly seeing a slow but steady increase in institutional interest in the space. And that's very similar. It's actually not that easy to get access. So an equity is a solution there as well.
Yeah, Germany is, funny enough, in love with fixed income products, just due to pension funds, insurance funds, and you have one of the biggest in the world placed there. So there's already natural interest there on a capital market side of things. And regulatory-wise, funny enough, it's actually not as bad as one would think. Germany has some fairly broad rules about listing requirements. There's been basically Bitcoin-focused listed company in Germany around for almost 10 years. It's an exchange that happened to have like a balance sheet of, I think, €500 million worth of crypto assets, and they're publicly listed. So the regulator already knows this model. It wasn't called a Bitcoin treasury or a DAS, but the model is not new. So that was the easier part. The harder part is then structuring the right financial products, issuing anything but common equity, raising the threshold, how many shares you can raise in a certain given amount of time just because of corporate governance or corporate law. So those are more the trickier things, and the regulator doesn't understand why should they, and probably shouldn't understand even, or maybe should, but they definitely don't really care that much, because if we on the one side say we're similar to any other publicly listed company, but at the same time, can you change the rules for us because we have Bitcoin on our balance sheet? That's unfortunately not gonna work with them. So we kind of have to adhere to the old traditional rules that are fairly good in Germany, at least. It's not hard to get listed, especially if you have an operating company and if you kind of know the process. But yeah, understanding corporate law and then making it easier for non-European investors, that's really actually the tricky part. So for example, it's extremely hard for a US investor to buy European shares in general. And but that's has something more to do that the American regulator doesn't want people take their money or take the business somewhere outside the States.
Perfect. John, easier or more difficult?
I think generally it's easy for investors in Asia to access Hong Kong exchange-listed companies. I think close to 5% of our investors now are actually on Futu, which is kind of the Robinhood E-Trade super app in Asia. And so we've seen investor growth from a lot of different countries. It's nice to be in kind of Metaplanet's neck of the woods also. So we hear from a lot of Metaplanet investors saying, hey, let's get some exposure to what's kind of the Metaplanet in Greater China. And then really the story for investor access for Hong Kong is the Stock Connect listing, which gives exposure to Hong Kong exchange-listed companies for mainland investors. And so that's kind of the end game for us is reach kind of the thresholds that allow institutions in China and retail in China to access Moon with RMB. So that's the next piece of exposure that hasn't really been tapped into yet. And that is I think the biggest demand that still exists that's untapped, and that's the end game in Hong Kong.
Perfect. We have about just less than 10 minutes left. We have a couple questions, and so plenty of time here for these. This is not meant to be a trick question, but I think it would be interesting if you guys could name a piece of legislation or sort of regulatory change in any country that would most help your business in the next 12 months, and please explain, why that would be important as well. And John, let's just go right back to you, and then King, and then Gary.
Sure. For Moon, we're hitting that Stock Connect long-term trajectory. So that'd be the biggest thing that we could, for us, that could happen in 12 months. And then sort of to Gary's point on just kind of listing rules and how you operate with raising funds and issuing equity. Some easing up of that for treasury companies around the world, including in Germany and Hong Kong, I think would be on that list too.
I think for me it's interesting looking at the European landscape. The first country in Europe to actually buy Bitcoin on its balance sheet with a sovereign wealth fund is Luxembourg. And that in itself creates a huge amount of positive momentum around the space, right? Because from there on, you see the regulator, you see the different ministries acting sort of in concert. So I think, if anything, is as always, putting your money where your mouth is will be a big positive for us as well in the Netherlands.
Yeah, and I think to my point earlier, access to the U.S. capital market for non-U.S. domiciled companies, I think that would be the single biggest driver of growth and access to capital that also wants to, be invested in those type of businesses and industries, but due to local U.S. regulatory constraints, that's not gonna be easy. Like also exchange and rules, like you cannot hold a certain ISIN in the U.S. brokerage account. You have to open local brokerage accounts in Europe, and especially if you're American, that's extremely difficult. So yeah, that will be a massive difference.
Gentlemen, you guys are doing great work. You're really pioneers. I hope you realize that, pioneers in the industry and within the countries and regions that you're operating in. And I know it's very difficult at times, and so I just want to say that as you sort of reflect here for our last question, we've got 5 minutes left here. Last question. As you look at your time and what you've been working on and all these sorts of things we've been talking about, and a number of things that we haven't had an opportunity to yet, what's one thing that you know now about running your business that you wish someone had leaned over and whispered in your ear and told you before you began? Like, what's something that you've learned that you wish you would have known, before you began all this? And King, if you don't mind, would you kick us off, and then we'll go Gary, and then we'll come over to John to finish.
Sure, and just going with my own background, I've been in traditional finance for a long time, and I had a few startups, and obviously this, and I think some of the things, on the one hand, you're in a traditional finance business, which you need to work as regulators, everything is super important, right? It's got to be pristine. But secondly, you're running a startup, right? You're starting with a lean team. You got to make decisions quickly. You got to move very fast. And I think with all of that, those two can conflict sometimes a little bit, right? Because the regulator has its own timeline, right? It's like 20 business days for you to get an answer. In the meantime, you're running 100 miles an hour with your team. So I think that sort of conflict between startup and super sort of institutional, that's something that I hadn't fully grasped beforehand.
Yeah, I guess really the level of knowledge about Bitcoin. It comes to a surprise, how there are some people you would never imagine to be Bitcoiners end up telling you, oh, I've been a Bitcoiner for years, but I never talked about this with anyone, etc. And then at the same time, board member, like on a board level, for example, and then the extreme opposite, a board member that thinks, oh, this is amazing, but then ends up saying, actually, I thought it's a hype, and because the price went down 15, 20, 30, 40%, I think it's gone, it's like dead. So, this spectrum of people, that's still surprising that you still have to encounter and engage with on a shareholder level and on any type of level. But it comes naturally, you need to have diamond hands when you're in this business as well, and patience. And I think patience will reward a lot of companies that are still going strong.
I would echo both of you, and then maybe one thing that surprised me a little bit was how much education we would be doing with exchange, with regulators in Hong Kong, including with some of your previous colleagues at BPI, at Hong Kong LegCo, talking about kind of how this development and others have been positive in other markets. So kind of the education aspect, we came out of the gates a little bit hot, announcing our first Bitcoin purchases and strategy, and had to slow down a little bit. That also allowed us to develop more of a strategy around our actual business and adding Bitcoin products into that traditional business line, which is something that regulators wanted to see and was something that we were able to do successfully, and also kind of develop a moat around our business as Greater China's Treasury company because of that. So it turned out to be okay, but the education factor is important. These sorts of conferences help a lot. The Bitcoin conference coming to Hong Kong every year is a benefit. So the education piece.
Fantastic. Gentlemen, great being with you this morning. Let's give a hand for these gentlemen who came in from all over the country, and for Bitcoin for Corporations.
Bitcoin for Corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
Everything you guys do, Bitcoin for Corporations, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
Now, full disclosure for our audience, I'm on the board of directors for Strive, so this is very much a Strive-centric panel.
Here's my boss.
And a very happy boss. I mean, when I look at kind of what Strive has accomplished over the past 6 months, it's just phenomenal. So, but I want to rewind and kind of hear from you, Matt, kind of the journey for Strive and becoming a Bitcoin Treasury company.
Yeah, so as you know, Pierre,
I'm a longtime Bitcoiner on a personal basis. Basically, I've had my entire net worth in Bitcoin for getting close to 10 years. Getting old very quickly, it feels like. But was loving capital markets, capitalism when I was at CalPERS, and seeing a disconnect of fiduciary duty there that led me to strive to fight back against some of the overreach of the ESG movement to restore in American capital markets unapologetic capitalism. I saw it as an existential risk. We have a retirement crisis in this country. And so version 1.0 was attacking it with fighting back against ESG. And I think broadly speaking, our view on that is that that went from a contrarian position to a consensus position. Not to say that it's completely won, but it's largely been won. That house of cards that I think most people in corporate America didn't even agree with has collapsed, and we're embracing capitalism, and now we're moving more towards a conversation as a nation around AI, around the debasement risk, around scarcity versus abundance. But still at Strive, as we've moved to a Bitcoin Treasury company, and we can talk about all the different layers of success we've had there, when it comes to the retirement crisis, digital credit, I think, is the best answer that you actually can have. You think about, as an example, a pension fund. Well, what does a pension fund look for returns? Most pensions look for around 7% returns. They construct a portfolio of safety through income and then capital returns through equity. And typically, the income is less than 7%, and then they hope to earn more than 7% on the public equity and the private equity and blend it together to earn 7%. Well, intradigital credit, paying 11 to 13%, whether you're looking at stretch or SATA on an effective yield basis, well, now income potentially can move from a defensive trade to an offensive trade, right? Like that actually earns greater than your hoped return on the public equity or even private equity side, which I think is a completely different game changer for this equation. We can talk through kind of where we are in that evolution, track record building, and how building track records, 3-year track records, opens the door for institutional adoption. But I think, to quote Saylor, this is the iPhone moment. I actually truly believe that. But I also, he's talked about, even on stage, the iPhone 1 didn't really take off. It actually took a little bit of time, and I think you'll see a similar thing where, it's funny, I was on a panel with Fong, and I had a fireside chat, and we both agreed that digital credit was quickly headed to $30 billion. He called that exponential growth, and I called that linear growth. I said, that's because my expectation for where I think this is going is so high. Like, this is a $300 billion, multi-trillion dollar opportunity because of the yield opportunity where we're going, and we're really in like inning 1 of this.
Now, fundamentally, what enables a Bitcoin Treasury company like Strategy, like Strive, to pay those dividend rates? How did the economics math out?
Want to start?
Yeah, so I think this has been one of the anomalies that people really have been wrapping their heads around. Is going, what is the trade that you're putting on, and how do we model that internally, which I also think is very important. And so when you have a thesis around an asset like Bitcoin, and we look at it as probably the best expression of the debasement trade out there, you can effectively think of what's happening out there as a perpetual carry trade, right? We're going perpetually short the dollar, perpetually long Bitcoin. And the thesis is that debasement isn't going to be able to stop. We're seeing an acceleration of the debt crisis in the United States, which we don't really see a solution for. I've heard Matt say over and over again, the biggest risk that we have to Bitcoin is the US government solving the debt crisis. And we don't believe that to be a high probability. And so when you look at that, you're taking an assumption, and for us, it's a 30-year or a 30% CAGR, year over year, effectively in perpetuity, and we're able to carve off a portion of that overall return. So in our instance right now, we're at 12.5%, and so the excess on top of that accrues down to the common shareholders. And you're really looking at it in that lens. So we look at what would a worst case scenario be for a Bitcoin Treasury company. And the worst case scenario would be that you have to sell the Bitcoin to pay the dividends. And so when you're building out the risk models, and I'm sure Jeff will talk about this a lot, we always work with that as the base assumption. Assume that that's what you have to do, that the market doesn't allow you to go in and issue equity, to issue any more preferred equity, and you have to rely on the assets on your balance sheet. Does that trade still play out over the long term? And the answer when you model it, and we've run it through a million Monte Carlo simulations and a bunch of different ways of looking at this and stress testing it against past drawdowns and what we expect for future drawdowns, because we still believe Bitcoin's going to be a volatile asset. But no matter how we've modeled it, the number of times that that does not work out is incredibly small. And so we're very comfortable with that trade, and we believe that the market is as well. And we're starting to see that when you see the liquidity building around these products. You know, people don't always understand exactly what the products are that are out there. You know, volatility as a product is kind of a new concept. And I don't think people understood how valuable that is when you think about how it enables the returns that some of these institutional investors and these portfolio managers have to obtain. A lot of times they're not focused on the price of things. They're focused on movement of things. It was what we saw with Strategy when they started launching the convertible bond models, and they found out that there was this pocket of capital that was completely attracted to that because the underlying equity behind that debt paper moved so much that they could do their trading activities on a hugely accelerated basis from what they used to be able to do. And so when people look at, well, where is the demand coming when a company like Strategy is issuing this equity out to the market? Well, they're selling a volatility product into the market. And there's huge demand for volatility because volatility is what enables those returns for all those institutions, as well as for, you know, retail investors as well that have a long-term outlook, or they're traders, right? If you have a long-term outlook that spans a decade, while you can absorb a lot of volatility, if that's within your risk profile, you expect those returns to be far greater over time. So when you're building an amplified version of Bitcoin, that's what you're focusing on. But there was a massive cohort on the other side. And you go, what's the other killer app product that a treasury company, or we view ourselves actually as a structured finance company, you know, what could a structured finance company offer out into the market that brings the value of Bitcoin and takes it to people who don't want to stomach that volatility? And when Matt mentioned the retirement debt crisis, that product is a credit product. You know, fixed income is becoming more in focus every day as we get to this aging population that's all transitioning into the retirement phase of their life. That 60-40 portfolio that everybody used to talk about, that fixed income component, becomes so critical because that's the difference in your quality of life through retirement. You know, if you're a retiree and what you really want to do is go spend time with your grandkids and you want to be able to take that extra trip to Disney, if you can average up the fixed income portion of your portfolio by 1%, that's a very material difference in your quality of life all throughout your retirement. And because of that, we think we found the combination of products to bring to the market as a structured finance company that meets the needs of both. You've got the people that really want the volatility to enable everything they do, and you've got the credit product that's going to provide that security and a lower volatility instrument that a large portion of the population is searching for right now.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for corporations, is so high quality.
Bitcoin for corporations brings together, you know, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for corporations may be the highest quality professional association in the digital asset space.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin Corporation, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
The Fed just changed the rules of inflation, and almost nobody caught it. Not the banks, not the analysts, which means that almost everybody is positioned on the wrong side of the market right now, and they don't even know it yet. If we just look just at this week, we can see that this morning, the biggest inflation drop in 6 years, down 0.4% in a single month. And just 24 hours earlier, oil jumped 9%, and Wall Street started betting on rate hikes. So it's the same data, but opposite directions. So half the comments here say that the numbers are fake, right? And look, I'm the first one to say they're fake, right? I've been calling CPI, CP lie for a long time, but this one, it's real. The other half says that oil's back up, so the Fed, they have to hike. They have to start raising. Well, those are the easy answers, but they're both wrong because that Fed, they don't exist anymore. The new Fed doesn't care where inflation comes from. It only cares if it spreads. Buried in this morning's report is one number that says it isn't. The number everyone strips out and ignores is now the only number that moves policy. So I'm going to show you all this. I'm going to show you the rule change that Wall Street hasn't priced in, why the rate hike bets are about to break. I want to show you the one number to watch so you're positioned before they figure all this out. You ready? Let's go. All right, let's get into this. And just real quick, the reason why this matters is because we need to know the price of money. So we know where the money supply is going. So we know where asset prices are going. That's why this topic's important. And by the way, if you like this topic, click that like button and subscribe to this channel so you can get more of this as we break it down. Okay, so the government, they dropped the number. The June inflation report came out and headline CPI, as I said, typically CPI, it fell. It fell 0.4% in a single month. Now, I know that sounds minuscule. It doesn't sound like a lot, but it's the biggest monthly drop since April of 2020. Now, think about that. April 2020, that was right when the depths of COVID came down, the lockdowns, all of that. And it was the biggest drop since then. And we saw inflation went up 4.2% down to 3.5%. Now, the thing that catching everybody off guard here is that Wall Street expected the opposite. They expected a drop of barely 0.1%. So they got 4 times more drop than what they expected. And so when you open up the report, the source is pretty obvious. Why did CPI drop? Well, energy fell 5.7% in 1 month. Gasoline, what you pay at the pump, dropped 9.7%. Hopefully you felt that a little bit in your pocketbook, but that's what did the work here. Now, real quick, I decided to make this video because everybody online is calling this data fake, right? The Fed's faking it. They just want cover so they can start lowering rates again and all of that. And again, like I said at the intro, I'm the first person to call them out. CP lie, as I call it. They change the basket all the time. But this one matters. This print is telling the truth this time anyway, right? And the composition is how you know. Gas prices collapsed in June, right? And you saw that. You noticed gas prices coming down, hopefully. And the report is just finally catching up to what you see, your own life. And nobody's saying, of course, that your gas is cheap. It's still pretty expensive. Energy's still up 15.7% from a year ago. But the question isn't whether prices are high. The question to be asking here, if you want to know where asset prices are going anyway, is which direction the prices are moving. And then more specifically, why. Now, 24 hours before this report dropped, oil jumped 9.4% in a single day. Again, this is the biggest one-day move since April. Then the ceasefire with Iran, it broke down on July 8th. We saw tankers getting hit in the Strait of Hormuz, and the market instantly started to flip. We went from pricing rate cuts in to all of a sudden a better chance, a 1 in 3 chance that the Fed is actually going to hike this month. But look, this is still the same economy. It's the same week. The inflation data says the one thing, and the market is betting on the opposite. So everybody's picking a side here. Half the comments say the numbers are rigged. The other half say oil's going back up, so inflation has to come back up. So then, of course, the Fed has to hike. So both sides are arguing about the same number. But what people seem to be missing is that the referee in the game, the referee got changed. The Fed that everyone seems to be modeling, the one that reacted, in the past to every headline, they got replaced in May. And the new referee, the new Fed, they're playing a completely different game. They're playing by a different set of rules anyway. Now, for the last, let's say, 4 years, the Fed ran on one single doctrine. Any inflation from any source, it demanded some sort of response, right? Jerome Powell, he would stand up and go to Jackson Hole like he did back in 2022, and he told you exactly what that meant. He said, fighting inflation would, quote, bring some pain to households and businesses. Okay, it sounds pretty bad. This means that pain was the tool, right? If the Fed would raise rates, making money more expensive, then they could crush demand. And that demand got crushed because people like you and I were broke. And all of a sudden, those people, well, lots of people were put out of work. And so they were broke. And so demand dropped. Now, whether the inflation came from too much spending or a broken supply chain, the playbook, it didn't care. It didn't care where the inflation came from. The response was always the same. But that's the old rules. And here's what happened to those old rules. The referee changed. Kevin Warsh took the chair on May 15th. At his very first meeting on camera, he rejected the entire framework. He called the inflation versus jobs trade-off a cruel choice. Like, why do we got to make people broke here? It's cruel. And he's right. He said that the Fed doesn't have to make that choice. Now, I did make a whole other video. I'll link to it in the description down below. I made a whole video on that moment, the regime shift change and how the Fed was going to act. And then he did something that got almost no coverage at all. He launched 5 task forces to rebuild how the Fed operates. Now, one of them is re-examining the inflation framework itself. And buried in his comments is the line that matters most. Warsh, he drew a distinction between prices the Fed can't control, oil, eggs, and the Fed's actual job, stopping those shocks from spreading into everything else. You see, the old Fed, they responded to the source of inflation. But the new Fed, they respond to the spread of inflation, right? That's the entire regime change right there. Sources versus spread. Now, watch how clean the proof is here. This year, we've seen it play out 3 times. The experiment ran 3 times. We saw late February, we had war break out with Iran, right? The Strait of Hormuz closed, and that was roughly about 20% of the world's oil. Now, of course, when that happened, supply shock, inflation runs up to 4.2% by May. But then June 17th, we got a deal signed. The U.S.-Iran signed a deal, and then oil round trips all the way down to the pre-war premium. WTI actually closed below where it sat the day before the war had started. Now, 3 weeks later, you get the biggest inflation drop in 6 years. Then July 8th, well, the ceasefire collapses, and then war breaks out again, and oil jumps 9% in a day. So we saw 3 doses, and we saw 3 responses. But as you can see, the inflation rate of the United States has been tracking one single waterway, the Strait, on the other side of the planet. So, I mean, of course, no demand story is going to survive that chart. The economy, though, here in the U.S., it didn't overheat in March. It didn't cool off again in June. It was the Strait closed, and then the Strait opened again. So if the Fed can't control the Strait, if the Fed can't control oil, then what's the new trigger? Well, there's one number: core inflation. Everything except food and energy. The number analysts use to strip out and nobody talks about, right? This morning it printed 0.0 for the month, which means, of course, it was flat. Now, year over year was about 2.6%. And the context here, it makes it land. At the June meeting, the Fed's own projections feared core running at 3.3% this year. And that fear was, of course, the oil shock. They thought the oil shock would leak into everything else in the economy, but it's not. It's not leaking. You see, but under the old rules, today's report is ambiguous. Headline collapsed, but oil spiking again. So I don't know. Who knows? But under the new rules, it's a green light. The shock isn't spreading. It's not spreading into the rest of the economy, into the rest of the prices. And that's the only question that the new Fed, the Warsh Fed, is asking. Now, I've been on record, making a lot of these videos, I've been on record since Warsh was nominated, that this framework right here would, and the change that he was going to make was coming. And this print is the first live fire test that we've seen it, right? We've seen his call. And it came back exactly the way the regime change said it would. Okay, but with all this, which, I don't know, seems pretty obvious, it seems like Wall Street still hasn't gotten the memo. Bank of America flipped its forecast from just a few weeks ago. They're now calling for 3 quarter-point hikes this year in September, October, and December. And that would take the Fed from today's about 3.5% to 3.75%, and maybe up to as much as 4.5%. Now, at the June meeting, the Fed's own dot plot flipped. Hawkish, too. Nearly half the officials penciled in rate hikes by the year end. Only one of them saw a cut. And the moment that crude spiked again on the Iran headlines, Fed funds futures started shifting from pricing no move to, again, pricing real odds of a rate hike. Now, every one of those bets runs on the same logic, right? Oil goes up, so headline inflation goes up. So then, of course, the Fed has to respond. But again, that's the old reaction function. They're modeling a Fed that got retired with Jerome Powell back in May. But here's the thing. Those dots were submitted in June when the Fed's own projections had core inflation running at 3.3% this year. Now, the whole, hike case was built on the oil shock leaking into everything else. But this morning, core printed 2.6 year over year, which is again down from 2.9% in May. And it's still drifting lower. So the thing that they were afraid of happening, it's not happening. Right? Within hours of the print, some economists were already saying multiple hikes look overstated compared to what futures are actually pricing. Now, Kevin Warsh, he's on Capitol Hill this week, and his message is basically that this isn't mission accomplished on inflation, not yet. Now, when people hear that, they think it's really hawkish, right? But it's not. It's not a hike signal. It's a new chairman that's guarding the Fed's credibility here. So don't listen for his tone on oil. Listen for the standard Fed keyword, whether he says the shock is broadening into core or is it staying contained, all right? That's the word, that's the tell. But let's play out both parts here. If the war premium in oil unwinds again, you already watched this once, right? Crude gave back most of its spike in June. The headline number flips soft right behind it, cuts unlock, and the repricing happens fast. If the war drags on, then headline inflation, it gets noisy again. But again, under the new Fed rules anyway, noisy, it's not part of the policy. The Fed would hold, core keeps deciding, and governments finance wars through credit and liquidity, right? Just as they have for a long time. So there's 2 different paths, but they both go to the same destination. Easier money, that's where they're going. The only difference right here is timing and how bumpy the ride is, which means that the trade was never predicting the war. It's front-running the moment that the market reprices the new Fed. Now, the next Fed meeting is July 28th, and that's where the crowd starts figuring out what you already know. Until then, one number. The core prints the all items less food and energy index that the Fed actually runs its projections on, not oil headlines, not sound bites from hearings, right? That's the number that decides. And look, knowing what's coming, of course, that's one piece of it, but knowing how to sequence your own balance sheet ahead of the liquidity run that's coming, what to hold, in what order, against what, that requires a full system, a wealth system, and not just a tip. But let's look at the playbook for this new Fed regime in 3 moves. And look, knowing what's coming is one piece of this, but knowing how to sequence your own balance sheet ahead of this liquidity turn, like what to hold, in what order, against what, that requires a wealth system and not just a tip. But let's take a minute and let's look at a playbook for what this new Fed regime does. Let's look at it in 3 moves, okay? So move 1 is reprice your own framework, right? Stop reading inflation reports like it's 2022, because it's not. The headline number is now noise in the system. The composition is the signal. That's what we're looking for. So every report from here, you open the table and you check one thing. Is the shock spreading or is it staying contained? You just learned to read the report better than most of the people covering it. All right, now move 2, position before the confirmation, not after. Now, June showed you the speed of the move, right? Oil unwound, the print flipped soft, and the entire rate conversation turned inside of just 1 month. So when the market reprices the new Fed, maybe July 28th, maybe the meeting after, the commentaries, they're gone, right? The window is the gap between what you know now and what the crowd figures out later. So that gap, that's the whole trade. Okay, move number 3, own what front runs liquidity. So when markets start pricing easier money, well, capital starts moving ahead of it. And where does it go? Well, it moves into hard assets, right? Gold does this. Real estate does it a little bit slower. Of course, the most liquid sensitive asset on the planet is Bitcoin. So it's the smallest of all of them, which means it reprices the fastest, carries no earnings. There's no board of directors, none of that to like muddy the signal. So it's the purest expression of the liquidity turn. Now, one thing I'll say about Bitcoin, I think it's worth saying at this point, is that everyone's been talking about this 4-year cycle of Bitcoin, right? It seems to happen like magic on a calendar, right? The high comes in about 18 months after the halving. The low is 12 to 18 months after that. So based off the calendar, the low should be somewhere around September, October of this year, like it's magic, right? And then, you know, the number goes back up. But the calendar was never the mechanism, right? Markets, they don't know what calendars are. They don't keep calendars. The cycle is a liquidity cycle. Every major Bitcoin bull market lines up with the global liquidity turn. And of course, the last, 14 minutes watching this video showed you how the next liquidity cycle gets unlocked. And so the cycle timing, that's not the reason to act. It's the confirmation that the mechanism is running on schedule. And you don't have to pick Bitcoin over gold or land or real estate or business or whatever you want. It's the same question. Who owns real assets when money gets easier? Now, Bitcoin's just the fastest horse in the race. Now, the Fed changed the rules. The market hasn't repriced it yet. And the number that settles it prints before the mainstream crowd is even watching. Because, of course, the crowd watches headlines. Owners watch the reaction function. So decide which side you're on before the next Fed meeting, which is July 28th. And if you want to see how the Fed is doing what no other Fed chair could do for the last several decades and what this means specifically for your wealth, you probably want to watch this video right here, and I'll see you over there.
Michael, since your May 5th earnings call comments, odds that Strategy sells some Bitcoin by year end have spiked from around 30% to 84%, and odds of a sell by June 30th are at 66%. Critics say stretch dividends and a narrowed MNAV premium are forcing your hand. How wrong is the market?
You know, I think we enjoy keeping everybody guessing. It definitely makes X a lot more interesting. Our view is business as usual here. We're kind of matter of fact about this. The goal of the company is to drive Bitcoin per share and to increase its Bitcoin and increase the enterprise value continuously forever. We'll make decisions about how we fund our liabilities week by week, day by day. Sometimes we make them minute by minute, to tell you the truth. We set algorithms where we're looking at what is most long-term advantageous to the company. Are we managing our credit risk? Are we creating Bitcoin per share? And are we best off to pay a liability with cash, or to pay a liability by issuing equity, or to pay a liability by issuing credit, or to pay a liability by selling Bitcoin? We've done a lot of multivariate models, and in all the models, what we find over the long term is that by far the best thing for the company is to engage in a mixture of those 4 instruments. Any model that we put together that's limited only to equity or only to credit or only to Bitcoin always underperforms. So ultimately, the way to think of it is 7 years out, we would like to have maximized our Bitcoin per share. And what is it that we should be doing now that's going to maximize and optimize the company's performance so that we've maxed out Bitcoin per share 7 years from now? And I think it's not unlikely that we'll sell some Bitcoin between now and the end of the year. I don't know how much. We still consider these things. But it's also likely that we'll sell a mixture of equity, a mixture of credit, We'll manage our USD, our cash positions, and we do it in a very thoughtful, programmatic fashion where we're running our multivariate models, and we're literally running them. We're making trading decisions. To say every minute might be an understatement. We oftentimes make trading decisions every second, and we'll continue to do that.
Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Yes, indeed, fellas, you read the title correctly. Bitcoin is going to explode. I wanted to make a very fun video for this Friday evening for those of you who are feeling down in the dumps about the Bitcoin price performance lately. We are smack dab in the middle of a bear market. Everybody is depressed, but don't worry. Daddy Wizard is here to give you some excellent news. I want to show you one of the strangest Bitcoin setups I have ever tested because the headline here today comes from an actual statistical experiment rather than some vibes-based seance conducted over a candlestick chart at 3 o'clock in the morning. There will be no astrology for men here today, folks. I'm here to tell you why today is bullish for Bitcoin. Bitcoin is sitting around $63,418 as of filming this today. Now, obviously, we are going down to the $62,000 a little bit today. Regardless, when we look at the 4-year moving average, it is slightly over $62,000. $62,064 right up here. That is a 2% premium to the 4-year moving average of Bitcoin and the 60-day volatility, 28.6%. So we have this very bizarre combination. The price is hugging a brutally slow long-term trend floor up to the right over time, while the asset does still have enough volatility to launch itself through drywall. Now, in relation, relatively speaking, to Bitcoin's price history, this is pretty low volatility, but people often forget what it's like to have a quickly compounding asset like Bitcoin paired with even this level of volatility. People don't even do the math statistically about what that can mean for variance in price moves. So the question I'm going to answer today is very simple. When Bitcoin has historically occupied a state that resembles this one today, what does the forward return distribution actually look like over the next 6, 12, 18, and 24 months? Because rather than assume some fixed 40% or 50% compound annual growth rate and then build a retirement calculator for psychopaths, I built a state-conditioned historical Monte Carlo. This model uses real Bitcoin behavior, real crashes, real rebounds, real volatility clustering, and a moving state that changes inside every single simulated path. And then I tried to murder the result with stress tests, and the results lived. So you guys are going to love the results, because what I tried to do was model what Bitcoin tended to do after market states, resembled today throughout history, and then we let those paths evolve using blocks of Bitcoin returns. Every probability, therefore, therefore belongs to that framework with uncertainty carried rather than buried under decimal point theater. If you are bullish on Bitcoin, you are going to love this video. If you're bearish on Bitcoin, you're going to love this video too. Do me a favor, like the video, subscribe to the channel. If you have not, you can support the Bitcoin Wizard by doing so. And look, if you're listening to the Bitcoin Wizard, I'm going to go out on a limb and assume that you are bullish on Bitcoin over the next 5 years. What if I told you you could book a Bitcoin investment for 5 years with full principal protection? That's right. That's what my friends at Solvana.io are building. Every single dollar of your investment being secured by a title insured recorded lien on U.S. real estate. You split the upside with the property owner whose home equity is back in your own investment. If you've been waiting for a way to buy Bitcoin or MSTR that allows you to sleep at night, this is it. And honestly, what better time to lock in a 5-year position after the information that I'm going to be telling you today? Go to Solvana.io/capital to get started. Scan the QR code. This is fantastic. You will love what my friends at Solvana have waiting for you. And you guys know how excited I get about Bitcoin treasury companies and the insane level of institutional adoption that we are seeing. But do not lose sight of the fact that the #1 revolution, the most important strategic reserve, is your own 100% self-custody of your Bitcoin. Run a node, become a sovereign Bitcoiner with the Bitcoin way today. After this latest cold card hack fiasco, essentially, you gotta partner with somebody who knows what they're doing. And my friends at the Bitcoin way had 0 client funds lost after this latest hack. Schedule a 100% free introductory call today using this QR code or go to thebitcoinway.com/Adam to get started. Do not delay, your freedom depends on it. So starting with the setup itself, Bitcoin trading at that 2% premium to the 4-year moving average, almost directly on top of a trend line that moves with the urgency of a federal permitting office. Now, all of these numbers matter together. I just went over them on the last slide, but obviously you have to view everything in context here. A 4-year moving average compresses an absurd amount of history into one slow signal. Obviously, if you take a 4-year snapshot of Bitcoin, that snapshot absorbs bull markets, bear markets, exchange failures, rate hikes, ETF launches, leverage explosions, minor capitulations, panic, euphoria, and of course several thousand television signals announcing Bitcoin's death. So we're about 50% below the all-time high, sitting on that 4-year moving average trend line. Yet, Bitcoin's 90-day momentum is now down 19.8%, and 4-year average growth is still running around 21.2% year over year. So that is going to create the core hypothesis. Maybe the 4-year moving average of Bitcoin is acting less like a magical support line and more like a state variable identifying periods where long-term monetization has caught up with the price. If that state historically carried better forward return asymmetry than some random Bitcoin day, we should be able to measure it. So I built the test around state similarity rather than male astrology. What I mean is chart squiggling nonsense. This is a test around state similarity versus where we're at today. And here is the machinery, because this is where the experiment becomes very interesting. First, I calculated the market state. The broader diagnostics of this scenario, we are factoring in all of these different variables about where Bitcoin is right now. And then we are going to search historical regimes that looked most like today, finding analog episodes, and then I sampled real return blocks using actual 14-day Bitcoin return blocks so the fat tails and volatility clustering survive. And then I recomputed every single path, then stress test the conclusion. So this is some very exciting stuff here. Don't want to bore you with the exact details, but after each 14-day Bitcoin return block, the simulation recalculates the price, the 4-year moving average, the volatility of Bitcoin, the price momentum of Bitcoin, the drawdown, and the rest of the state. And then it searches the history again from that new simulated condition. And I ran 20,000 simulated paths for 731 days forward. So these are the findings of this model. This is what got spit out in my CSV file. Now it is giga bullish. The raw state condition model produced a 6-month median price at around $76,000 Bitcoin, a 12-month median price around 101,000 Bitcoin right here, the 18-month median price at around 142,000 and the 24-month median price at around $179,000 per Bitcoin. So at 2 years, 24 months, the median total return was about 182.6%, which translates to a median annualized compound annual growth rate of 68.1%. The middle of this distribution to me is already absurd, and the tails obviously are more entertaining. The 10th percentile range starts at 79,000 and the 90th percentile range is $402,000 per Bitcoin. The raw probabilities came out at 96.7% for finishing above today's price, 83.2% for exceeding a 20% compound annual growth rate, a 67.8% chance of at least a doubling of Bitcoin's price, and a 45.3% at a tripling of Bitcoin's price. Now, those numbers are insane, but they also require discipline because a Monte Carlo gives you a distribution implied by this historical sampling process. So I treated the raw output as my first layer of evidence. It is giving me some powerful directionality, this enormous modeled convexity of Bitcoin, and a giant flashing sign that was telling me to keep digging. Now, this probability matrix shows the evolution from raw excitement to something I would actually defend in public while being sober. At 6 months, this model gives a 74% positive return probability right here. Now, around 12 months, that rises to 87.6%, 18 months, 93.5%, 24 months, 96.7%. The raw probability of beating that 20% CAGR rises from 62.1% to 83.2% over those 2 years here. And then I applied 2 different reality checks. The first is a brutal annual return drag, which I will hit on in the next slides here, but next comes the rolling origin calibration. I reran the model from 12 semi-annual historical starting dates between 2019 and 2024. And every single historical forecast could only use information available at that starting date. This is the important part. Every single forecast lived inside of its own historical information set. The time machine stayed in storage, kids. So using the coarse empirical calculation, today's 24-month positive return estimate falls in the roughly 73% to 77.4% range. So this slide answers the question that actually matters. Does being near that 4-year moving average of Bitcoin actually improve the distribution, or is Bitcoin simply bullish in every Monte Carlo because Bitcoin has historically gone up? I ran an unconditional recent history comparison using the same general machinery while removing the state conditioning exchange. Over 24 months, the unconditional model produced an 80.5% probability right here of a positive return. The state condition version actually produced a 96.7%. So for a CAGR above 20%, we're talking 83.2% conditioned versus 66.3% unconditioned. And this is the important part for all of you who are bearish on Bitcoin over the next 2 years. The downside comparison is where my eyebrows left the building. An arbitrary recent history start produced an 11.6% probability of finishing at least 25% below the starting price after 2 years. Under today's state condition setup, that model probability collapsed to 0.2%. That is the real signal, kids. 0.2%. This is dramatically compressing the terminal downside tail while preserving Bitcoin's right tail insanity. So think about what this actually means, okay? This model that was trained on history, okay, looking at states that look like today, the model still expects chaos along the journey. Bitcoin is still volatile. The price continues to get punched, obviously. But clearly, there is terminal asymmetry when we are seeing a condition 96.7% likelihood of a positive return versus a 0.2% likelihood of being down at least 25% from here. Now, obviously, that's really bullish, so I wanted to abuse the bullish thesis. First, I imposed a deterministic 30% annual drag on every single sampled path here. That is a savage haircut, kids. Imagine taking this historical return engine engine that I have created, this thing right here, and then strapping a cinder block to it and then throwing it into a lake. The 24-month median still came out around $115,000. Yes, after a 30% annual return drag here. And then I removed every single 2023 observation. Why did I do that? Because that was essentially the starting points after that terrible 2022 bear market. Today's exact state has very few historical matches. That strongest cluster lives in 2023. So with 2023 removed, the 24-month median case is still $185,000 Bitcoin. I also changed the return block length, 7-day, 14-day, 21-day blocks. They produced 24-month median CAGRs from 64% to 68%. The model is sensitive, but obviously the signal remains stubbornly alive here, like a cockroach funded by venture capital. Obviously, we got to talk about the price of the upside. People say that volatility is the price that you pay for performance, and that's actually literally true in the math. Because using Bitcoin's volatility today, even though it's very historically compressed, well, roughly 26.2% of those 20,000 simulations produce a 50% plus or more drawdown. About 9.2% of them experienced a 60% drawdown. So this yellow line right here, probability of a 30% drawdown, actually goes up to a 93.3% over 24 months, okay? So if you're waiting 2 years, chances are 93% you are going to see a 30+% drawdown. The median maximum drawdown, though, actually over 2 years is 42.7%. And because we're actually over a 50% from the all-time high, this tells me that the bottom is close to being in if we're not already. And then the probability of a 50% drawdown is in red here. That's only 2.3% over 6 months, but 26% over 24 months. So I really don't think that we are actually going much lower than we are today, just given how volatile Bitcoin is right now. This is telling us that you could buy Bitcoin near the 4-year moving average, watch the thesis work over 2 years, and still endure a drawdown large enough to make your relatives send you Dave Ramsey clips. This is why volatility and expected return have to be discussed together. This model is saying that the asymmetry looks very exceptional, but the median max drawdown still 42.7% over a 24-month period. So we are looking at the asset that's sitting at a 2% premium to the 4-year moving average. The volatility has compressed quite a bit, but remember, the average itself is growing between 20 to 30% every single year, year over year, even since 2020. The stress tests say that the conclusion survives severe punishment. The calibration says that my probability claims are civilized. So my takeaway is very simple, kids. It's literally just math. It's statistics. This looks like one of the most statistically asymmetric Bitcoin setups that we have ever seen. The upside distribution looks like a clerical error, kids. And of course, the path there looks like a hostage situation. Welcome to Bitcoin. That is to be expected. My name is Adam Livingston. I am the Bitcoin Wizard. I am buying Bitcoin because the likelihood of positive forward returns from this point in history seems like a no-brainer to me. Have a terrific day, everybody. Do not party too hard. Class dismissed. This video is sponsored by Solvana, and if you are interested in gaining Bitcoin upside while keeping your principal protected, Solvana may have built the most aggressively bullish product available for people who still enjoy sleeping at night. Yes, you as an investor can receive 50% or more of Bitcoin's appreciation with uncapped upside, while the structure is backed by the Bitcoin position itself and a lien on U.S. investment real estate. Basically, Solvana is putting Bitcoin in body armor. You still get the moon math while your principal has a rental property standing behind it with a baseball bat. If you are interested, scan the QR code or use the link below. Solvana will help you every single step of the way. They will answer your questions and explain exactly how the structure works. Requesting information carries zero obligation or commitment. Go to solvana.io/capital to buy Bitcoin and MSTR MSTR with full principal protection. And you know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it.
and welcome. I'm Natalie Brunell, author of Bitcoin is for Everyone and host of the Coin Stories podcast, and I'm very happy to be back moderating Strategy's second live investor Q&A. We're live today on X and YouTube, and over the next hour or so, we will get to as many of your questions as we can. They were submitted directly by retail and institutional investors through the company's official question form and on X. We received dozens and dozens of submissions covering a range of topics, and my job today is simply to put those questions to the company's leaders and keep us moving so we can cover as much ground as possible. If you're watching live, you can continue submitting questions in the replies, and my colleague Alex Devani will be looking out for new topics and angles that haven't already been covered by the submissions we received over the last week. And if you can't stay for the entire hour, don't worry, the full replay will be available on Strategy's platform along with mine. Now, before I introduce our guests, a brief disclosure. Some statements made during today's presentation regarding future expectations, plans, and prospects may constitute forward-looking statements. Actual results may differ materially due to important factors, including fluctuations in the price of Bitcoin and the risks described in Strategy's SEC filings, including its quarterly report on Form 10-Q filed on August 3rd, 2026. This presentation is for informational purposes only. It is not an offer to sell or a solicitation of an offer to buy any securities, and it is not investment, financial, legal, or tax advice. Any offering of securities will be made only by means of a prospectus, and additional information about Strategy is available at strategy.com. So with that, let me introduce Michael Saylor, the founder and executive chairman of Strategy, and Phong Le, Strategy's chief executive officer. Michael and Phong, great to have you back.
Happy to be here.
Thanks for having us, Natalie.
All right, well, we have a lot of questions to get through, so let's jump right in. The first one came from several investors, and it's directed to you, Michael. You recently posted a chart on your X page where you outlined a digital asset monetary spectrum that included digital capital, digital credit, digital money, and digital currency. What is SR-STRC-USX, which you describe in that visual as digital money? And do you disagree that Bitcoin is money?
I think if you're using the theoretical term for money, then you would say money is a non-sovereign store of value bearer instrument like gold. But that's a classical Austrian economist view of money. The current conventional view of money is that money is a US dollar equivalent or a fiat currency equivalent asset like the US dollar that holds its peg against a fiat currency. So I think that 99% of the world thinks that money is a fiat currency and a money market is a fiat currency that generates yield. I think that there's 1% of the world that are Austrian economists that think that money is gold. Some of them think money is silver and money is Bitcoin. But I think that's an academic debate, and there's not much point in getting mired in an academic debate because about 0.1% of the capital in the world, or 0.1% of the economic value in the world, is actually invested in the Bitcoin network right now. 99.9% of all the capital, all the money, all the stuff of value is invested in stuff other than the Bitcoin ecosystem right now. A lot of that's equity capital, a lot of it's real estate capital, some of it's metallic capital like gold, some of it is credit, hundreds of trillions of dollars of credit. So I think that if you want the Bitcoin network to grow by a factor of 10 or 100, then you're going to have to attract capital from the traditional finance establishment, and that means attracting equity capital flows or credit capital flows or money market flows. So for the people that have not yet bought Bitcoin, the ones that we're actually working to serve, their view is that money is a medium exchange, a unit account, a store of value, and they would think that that's the Japanese yen in Japan or a yen money market in Japan. They would think it's a US dollar money market in the US. They think it's a euro money market or a euro in the European Union. And and so the TradFi or the Keynesian view of money is a fiat currency or a fiat currency equivalent that pays yield. The chart that I'm illustrating is the digital assets taxonomy. We think that Bitcoin is capital, and so digital capital is Bitcoin, and Bitcoin competes against gold, real estate, equity capital, credit capital, or money markets held as capital, or art. Those are all the things that Bitcoin competes against. 99% or 99.9% of the economic value of the capital in the world is not Bitcoin. So if you want to get it, you need to compete against those things. You need to tell people why Bitcoin is better than gold or art or real estate or equity like the S&P index, or bar gold. STRC is digital credit. We've extracted a credit instrument from capital. It's semi-volatile. It's not as volatile as Bitcoin, but it's more volatile than a fiat currency. And the next step is to take STRC and create something that looks like a digital money. And a digital money would be the mythical Bitcoin-backed stablecoin. It's a fiat currency stable asset, whether it's a stable dollar or stable yen or stable euro, but pays yield. So the difference between digital currency and digital money is digital currency is deemed to be stable coins. It's like Tether or Circle or any other digital stable coin in whatever currency system is out there. Digital currencies don't pay yield. So digital currencies are the winners of medium exchange and the crypto ecosystem and the digital assets ecosystem. I think that that's there are some fundamentalist Bitcoin OGs that wish that wasn't the case, or they've been hoping it wouldn't be the case. But I think that at this point in the year 2026, we can see that substantially all the prices in the world, if I were to say 99.999999% of the prices in the world are in fiat currency, I might be understating the case. It's just, to somewhere between 6 and 100 significant digits after the decimal place. All the prices are in fiat currencies, which means that the medium of exchange is generally the US dollar. If you're holding stable coins, they don't pay a yield, though. It makes a good medium of exchange. It makes a very poor store of value or a weak store of value. The idea behind digital money is to take the best of digital credit and the best of digital currency and merge the two together and create something which is generally stable to a fiat currency but pays a yield. And so if you can actually create a yield on a stable currency instrument, then you've got something which serves as much better store of value. So that particular asset that I put in my chart, that's the first example. Well, one of the first examples, maybe the first example of someone creating a digital money asset. And they're creating a digital money asset by engineering a stable asset that actually has yield. The yield comes from digital credit, and the asset is stabilized through some financial engineering to be stable to a US dollar. I expect there'll be dozens, if not hundreds, of different types of monetary assets that people build. So it's not the only one. I think there's about a dozen different organizations that are building digital monetary assets in the digital assets ecosystem. And I don't think digital money be limited to tokens. I actually think that you'll see digital money funds created as ETFs in the United States and probably as ETPs and other types of publicly traded funds that trade on exchanges all around the world. And I also think that we'll see private funds, just like there are money market funds that are private that don't trade publicly. There are money market funds that are public that trade as ETFs, and there are monetary instruments like currencies that are stable coins. So the thing that we think is really important is that if Bitcoin is going to grow by a factor of 10 or a factor of 100, we need to facilitate capital flows from the credit markets and the money markets. And right now, what's going on, if you took away STRC and you took away the digital money tokens that are now starting to develop, then what you have is fiat currency flowing into the stablecoin market, and it's all backed by currencies, by fiat currency like US dollars. And then you have capital flowing into the capital market that actually supports BTC, but there would be no capital flows from the credit markets or the money markets into this ecosystem. If we create good credit, then we will be able to create monetary instruments on top of it. And the companies that create digital credit, like Strategy and Strive, will have equities, and the equities will attract capital flows, which will also flow into Bitcoin. And companies that create digital monetary instruments, the instruments that'll be on top of digital credit, they'll have equity as well, and they will attract capital flows into the ecosystem. So we think that the economy will grow if we actually create credit instruments, money instruments, currency instruments, and equity instruments, all of them that are tied in or backed, but either backed by BTC or tied into the Bitcoin ecosystem. So that was an example of the first of what I think will be many digital money instruments. It's not the only one, and certainly I'm not endorsing that particular one as an investment. It's a security type investment, but I think that it's a seminal event in the same way that when people first created money market funds, that was a pretty important event, and when people created ETFs backed by money market funds, I think that's an important event.
All right, let's turn now to the equity side, to the common stock MSTR. We have a question from Rob. He said, I have 3 children and I invested $73,000 each into MSTR, believing in the long-term potential. Today, that $73,000 is worth $20,000, and the long-term potential is now a function of getting back to break even. MSTR common shareholders seem to be your lowest priority. You defend STRC and pay down converts using MSTR at the market offerings. Achieving BTC per share yield doesn't do much for my kids. I have a decade-long perspective, but I'm worried that you will ATM so much that we'll never get back to $3.25 a share. Have you considered paying out a dividend to MSTR common shareholders simply to do something right by them in the near term?
I can start on that, and Mike can add. And Rob, thanks for being a shareholder and investing some money into MSTR for your children. Of course, the common shareholders and MSTR is our most important priority, and creating value and increasing the price of MSTR is our #1 priority. How do we do that? We do that by outperforming Bitcoin. And since the beginning of our strategy of putting Bitcoin on our balance sheet, that was August of 2020, Bitcoin's been up 32%, MSTR has been up 41%. So we've outperformed Bitcoin over time, and I understand that you came in later and haven't seen that outperformance. What happens over time, right? When Bitcoin's up, we tend to go up more because we have more Bitcoin per share, and we do that via historically leverage, and we've done that more recently via amplification. What that does mean, and what you've experienced, is when Bitcoin goes down, we tend to go down more. So Bitcoin's seen a drawdown of 50% from all-time highs. MSTR has seen a drawdown roughly of 75% of all-time highs. Because Bitcoin's our underlying asset, increasing Bitcoin per share increases the value of MSTR when Bitcoin goes up, and we'll see sharper drawdowns. So how do we increase Bitcoin per share? We increase Bitcoin per share historically through leverage, through convertible bonds, and more recently through what Mike talked about, which is digital credit and amplification through stretch. And so ultimately, if we want the common to go up, we have to increase Bitcoin per share. And increase Bitcoin per share means making stretch work, which is why it may seem like we're talking primarily about stretch right now, getting stretch back to par, but that's what gets Bitcoin per share to go up and MSTR, the common, to go up over time. We're not going to pay a dividend. That's not really the best deployment of capital. The best deployment of capital for us is to get stretch to work, to buy Bitcoin and put it on our balance sheet. And that's ultimately the objective of the company. And so over time, if you believe in the underlying asset Bitcoin, and Bitcoin starts to rise for all the characteristics Mike had mentioned before, then MSTR will start to rise over time. And that's ultimately the goal of the company.
Michael, do you want to weigh in at all on that?
Yeah, what I'd say is if you want a dividend, you should buy one of the preferred stocks, like STRD pays like almost like a 15% effective yield. So if you're looking for a stable instrument that pays a dividend, then I would look to STRC or STRK. They were designed to pay dividends and give some upside. If if your time horizon is less than 4 months, you probably should own a money market. If you are making an investment and want the money back, or want to see a good return on your investment in 4 months to 4 years, you're probably a credit investor, and you ought to consider one of the credit instruments. If you're holding the equity, then you need a time horizon minimal of 4 years, right? Ideal 7 to 10 years. Bitcoin was an all-time high about a year ago. So when we're in a bear market, you're going to get more amplified Bitcoin. So if Bitcoin's down 50%, we're going to be down 75%. And in a bull market, we expect to outperform Bitcoin. So, when you're buying MSTR, you're getting amplified Bitcoin. When you're buying Bitcoin, you're getting on a roller coaster. So if you are going to get on a roller coaster, then probably you want to use a metric that's like a 4-year blended metric. So when we look at Bitcoin, we look at the 200-week simple moving average. And that way we take a 4-year cycle view and we consider how is it trading versus the 4-year average. I think that MSTR is going to be more volatile than that. So I think the whole point of the equity is to generate the amplification. And so if we were to pay the dividend, we would be actually undermining the equity value proposition, and we'd be undermining the credit value proposition. And the reason that the equity is so volatile is because we sell the credit. And the reason that we're working hard to build a balance sheet is because the company's future is based upon the credit. If we can sell $10 billion a year worth of STRC, and if BTC outperforms our hurdle rate, it's about 10%, 10.5% right now, then the $10 billion of credit that we sold starts to look like net income to the common stock equity holders. So that being the case, you'll get a multiple on the credit sales. If there are no credit sales, then there isn't anything to multiply. And so the single most important thing is for us to stabilize the credit business and to build the most sustainable, highest quality credit business that we can. And so the equity will actually come later. Right? We're in investment mode to build the credit. If we do the things that are good for the equity in the near term, they're bad for the equity over the long term. And on the other hand, if we do the things that are good for the credit in the near term, that will be good for the equity. So ultimately, the product of the company is the credit. And the better the credit is, the more valuable the company is. And we think the company will be very, very valuable if we make the credit, especially STRC, successful. So we're making a long-term investment. It's not unlike Netflix or Amazon. When Amazon was building out Amazon Prime, they were providing cheap shipping and or free shipping for a long period of time, and people thought it was not great for the equity. But at the point where everybody in the country is subscribed to the product and they all use the product, then Amazon won the market. And our view is the same. We want to win the digital credit market, and ultimately we want to create the world's best credit. And if we do that, then the primary beneficiaries will be the equity holders, of which I'm a big one. I have more than 19 million shares of the equity. So I feel your pain, but I think we have to be prepared to have difficult years. It might be 1 year, it might be 2 years. We wouldn't think it would be 4 years, but we might have to actually ride through some number of months or a year or two in order to get to the point where things start to work to the benefit of the equity.
Multiple investors pointed out that you recently sold Bitcoin and you recently purchased back STRC. Are there any plans to buy back MSTR?
I think we're open to buying back MSTR if it trades at a discount to NAV, or if it's the right thing for the company to do. We evaluate all these programs week by week, day by day. Right now, STRC is trading at a discount to par, so it's a pretty obvious thing for us to do. And MSTR is not trading at a discount to NAV. So we're prepared to do it at some point if we needed to. If MSTR is trading at a very, very deep discount to NAV, then probably you would see us do something like that. But right now, it's not the highest priority of the company. The best thing we could do right now is fix the credit. If we fix the credit, the equity premium should expand, and that will be good for the equity. If we take the capital that we could use to fix the credit and start buying back the equity, that would be equity, that would be credit negative. And if it's credit negative and the credit business weakens, then even if you were trying to buy the equity in the open market, it would be weakening, because the fundamental question is the credit business worth $100 billion or $1 trillion? If there is no credit business, the answer is no, it's worth zero. But if there is a credit business, then there's just a debate over whether or not it's worth 50 billion or 100 billion or 250 billion or $1 trillion. And so the single most important thing for us to do is make the credit work. And right now we're allocating our capital to doing that.
Okay, so fix the credit, fix the equity. Fong, this question is for you from Johannes Schmidt. CEO Fong Li has cited JP Morgan as a model for how strategy should evolve for digital credit. Yet Bitcoin's entire philosophy was designed as a direct alternative to the centralized, trust-based banking system that JP Morgan represents. Doesn't modeling strategies business, including STRC, after a centralized institution like JP Morgan contradict the decentralized principles that Bitcoin was built on? And how do you reconcile pursuing a JP Morgan style corporate structure while staying true to Bitcoin's founding philosophy?
Yeah, let me address that, but I do want to follow up on the previous question, because I think there is this misconceived notion that issuing our equity is dilutive to our shareholders. If we sell digital credit, STRC, and we issue equity to pay the dividend, it's highly accretive to our shareholders. If we issue